Hi. Yes, we are coming up with the marathon video now. So, yes, people, we are starting with corporate accounting marathon. Okay, we are starting with corporate accounting marathon. That is paper number 4, part A. Okay, sir, what are the things will be covered in that? Before that, corporate accounting will be for 60 marks. Done. I will be only handling corporate accounting here. FM content, if you are waiting for in this video, you won't get a FM content. Okay, let me be clear. Later, don't put comments. Or FM is not there. Only 10 chapters are covered. Yes. So basically, there are 10 chapters in this. There are 10 chapters in the particular part where you can get 60 marks. Okay. In that, sir, are we covering everything, sir? The answer is no. Then what and all we are covering, sir? This particular chapter we are not covering. Chapter number 3, accounting standards, we are not covering because that is vast chapter which carries 5 marks and you have to like theory for almost 100 pages. So we are not looking into that thing while revising because it will be time waste for revision also, time waste at the time of revision. So all other things are we going to discuss, sir? Yes. All other 9 chapters we are going to discuss. Yes, sir. I haven't studied once also, sir. Can I watch it? Yes, you can watch it. Will I be able to clear, sir? That depends on your effort. How much you are going to put efforts on. Conceptual wise, we are going to cover everything. Questions wise, we are going to discuss. We are not going to solve. Here we are going to discuss few questions whichever is required for the concepts. Almost all the questions of ICSI material. And other questions we are going to discuss here. Okay. Sir, my exams is in June, sir. I am confused whether to go for the class or no. So I want to know how the class works. Shall I watch it? Yes, of course. Feel free to watch. Yes. So these are the certain things. So let's not waste much time. Of course, the content will be of around 10 hours. Marathon will be of around 10 hours. Okay. So we'll start with our subject now. Corporate accounting. First, before going for a corporate accounting, let's understand what exactly is accounting. Later we'll go to corporate accounting. So we'll go for a introduction of accounting. Okay. Yes. So what is the meaning of accounting, sir? Basically, people, accounting is a process. Okay. Accounting is nothing but a process. Process of what, sir? It is a process of recording, classifying, summarizing, analyzing, interpreting and communicating to the end users. What you are going to communicate, sir? You are going to communicate financial information to the end users. So it is process involving certain factors or processes. What are those, sir? It involves recording. That is recording of journal entries. That is recording of journal entries that could be done in a general journal entry or it could be done as a special. Special means nothing but your subsidiary books. Subsidiary books. General journal entry means, people, you are going to write everything in a same journal, whereas special means you are going to keep separate journals, separate books for each and every kind of transaction. Like sales will be recorded in the sales book, purchase will be recorded in the purchase book, cash transaction will be recorded in the cash book. Other than all any other thing which won't fall under special book, everything will be pushed to the journal proper. Like that, we are going to record, that is journal. Classifying means these recorded things are going to classified into ledgers. Cash transaction one place, sales transaction one place, purchase one place, different debtors one place, different creditors one place, capital one place. Like this, we are going to prepare a ledgers. That process is called as classifying. After that, of course, at the end, while preparing financial statement, we can't go and check the balance from each and every ledger. So what we will do, all ledger balances, we'll bring it to one single place that is known as trial balance. We are going to summarize all the ledgers and we are going to prepare financial statement using a trial balance. Then we will analyze what is happening this year, what happened last year, etc. then we will interpret, that is what might happen in future, then we will communicate it to the end users. We'll communicate it to the end users. So who are end users? End users are stakeholders. It could be a owners, it could be a management, it could be an investor, it could be a employees, banks, government, competitor, debtor, creditor, etc. Generally speaking, from this chapter, so far it has come for 2 to 3 marks only, so I am not spending much time on it. Okay? Yes. But basics is required for accounts, so I am teaching all these things. So what you are going to record, sir? You are going to record transaction and events. Transaction and events. What do you mean by transaction, sir? Any activity done in organization, which involves movement of money or money's worth. Any transaction done in any activity done in an organization which involves movement of money or money's worth. So try to understand, in accounting we are not going to record a qualitative aspect, we are going to record only and only we are going to record quantitative things, that too in terms of money. Done. What do you mean by event, sir? Result of such transaction is known as event. Result of such transaction is known as event. For example, you making some expenses is a transaction. Earning some income is a transaction. Because of this, we'll get a result of profit or loss. This is an event. You purchasing inventory is a transaction. Selling inventory is a transaction. Result of this, getting closing stock is a event. So result of the transactions are known as event. Okay. So bookkeeping and accounting are the same, sir? No, sir. Bookkeeping means just recording the transaction in a significant and orderly manner. That is basically significant and chronological order. We are going to record the transaction. That is bookkeeping. Whereas accounting involves analysis, interpreting, communicating, so many things. Bookkeeping is just keeping our records in a chronological order. That is day-to-day basis, time basis. Okay. These are the certain things. Now, what do you mean by accounting concepts, sir? What do you mean by accounting concepts, sir? Accounting concepts means, people, certain assumptions what we do while preparing a financial statement, that is known as accounting concepts. Assumption on what basis financial statement of the organization are prepared, those are known as accounting concepts. And you keep on doing the same thing again and again because of the tradition. That is, due to the certain practices, over the time you are following certain things while preparing a financial statement. Those things are known as accounting convention, but we are not going to differentiate between concept, convention and principle. We are going to treat everything same. Okay. There are certain concepts you should keep in mind. One is entity concept. What do you mean by entity concept, sir? Business is separate, owner is separate. So although owner had invested a money in the business, still is a outsider. Or she is the outsider. They are not considered as a owner. Business. Business is separate from its owners. That's what entity concept is. That's the reason whenever capital introduced, we pass the entry as to bank to capital. Capital also treated as one more liability, but which is particular only. Capital is also liability only. That's why we will credit capital to the organization. From the organization point of view, capital is also liability, but as it's a owner's liability, towards the owner, we are going to rename it as capital. That is because of which concept, sir? Entity concept. Next is money measurement concept, people. Whatever we are going to record in financial statement, everything should be in terms of money. And one more point to remember, everything should be in uniform currency. That is, if it is in rupees, everything should be in rupees. If it is in dollars, everything should be in dollars. It can't be one thing in rupee, one thing in dollars. It should be uniform currency. Going concern, sir, generally we are going to assume that, boss, our organization will go for a long time. We don't have any intention of closing down the organization soon. So the assumption what we make, that is known as going concern. Because of going concern, the periodicity concept will come. What is that, sir? We are planning to run our business for 100 years. But we should check the results, no? We should keep the control now, which means we should keep on checking what is happening in the organization. So what we will do, this 100 years, we can divide it on the, let's say 3 months basis or 6 month basis or 1 year basis. Now this is known as periodicity concept. This is known as periodicity concept or accounting period concept. So what we will do, once in a year, for example, we are going to check what is our performance, what is our position, like this. This is as per periodicity concept. That is the business indefinite period is divided into smaller portion to ascertain the financial position and performance. Position means it talks about your liability and assets. Performance means it talks about your profit or loss. Okay. So if they ask position, then what is going to be useful? Balance sheet. If they ask performance, what it is? P&L. Because performance means what you have done at that point of time. Position means where you stand with your asset and liability at that point of time. So that is the periodicity concept. Next is matching concept. So while checking the performance, your expenses of the period is matched with the income of that particular period. Your incomes of that particular period is matched with the expense of that particular period to get the profit or loss information. Because you can't match everything. For example, let's say I bought a machine, okay, costing 10 lakh rupees, which is having 10 years of life. Now this year I made a revenue of 11 lakh. This year I made a sale of 11 lakh, sale of goods. Now I can't tell my income is 11 lakh, my expense is 10 lakh. I can't compare and tell my profit is just 1 lakh. Why, sir? Because people, this 10 lakh is there, no, 10 lakh. That is not for only this year. It is there for, benefit is there for 10 years. So what you will do, instead of 10 lakh, you are going to treat only 1 lakh as an expenditure. Because that's what the real expenditure is. So depreciation, you are not going to charge the whole amount of machinery. Instead, you are going to charge only depreciation, how much is relevant for that period. That is as per nothing but matching concept. One more important concept is accrual concept. That is, boss, expense whether you paid or you don't pay. Whether you paid or you didn't, it won't matter. Expenses, whether you paid or you didn't pay, didn't matter. Whether have you incurred that expenditure in this period, that is expenditure of this year. Whether you have incurred that this year. If at all you paid this year, but that is of last year, then don't consider that this year expense. You paid this year, but is of next year, don't consider this year expense. That is your accrual. Income, boss, you received not received doesn't matter. You received, not received, doesn't matter. Whether you earned during the period, then treat it as an income of the period. Whether if you have earned during the period, treat it as a income of the period. That is what accrual concept is all about. Next you have cost concept. Cost concept, that is nothing but it tells your asset should be valued at cost, not your market price. Because your asset you are not planning to sell, you are planning to use it. When you are planning to use it, why you want to record it in market price? For example, if I ask you, what is the value of your house which you are staying? Can you guys tell? Are you going to keep the market, information all the time? Every day you go to broker and ask, boss, our house, at what price it might go? You do this exercise for 1 week, later your father will throw you out of your house. Because we will be planning to sell your house, correct? So, because we don't ask what is the value of our house every month once, every year once. The reason is pretty simple. We are not planning to sell the house. Then why I want a market price? Same way, assets, we are not planning to sell them. We are planning to use them. Then why you want market price? So what cost concept tells? Boss, record it at a cost. Dual aspect concept tells for every debit there will be credit. Because of this we can tell asset is equal to liability plus capital. Basically asset is equal to liability. For every debit there is a credit, which means one should be equal to other. So asset is equal to liability, but liability can be divided into two parts. No, outsider liability, owner's fund. Owner's fund is capital, outsider liability is liability. That's it. Conservatism, sir, one more important concept, conservatism. That is, it tells, boss, anticipate future losses and expenses, not gains and income. That's what we apply in our day-to-day life also. No, if something good is going to happen, we are not going to tell it to anyone until that good thing happens. But if something bad is going to happen, we are going to tell everyone, boss, I am going to die, something bad is going to happen. But if good thing happens, till it happens, we are not going to tell it to anyone. So that is conservatism, people. That is, whenever you expect some future income and gains, until you realize it, please don't record. But if you think in future there could be some loss, in future there could be some expense, then right now immediately you should show that thing in your financial statement. Either you can show it as a contingent, or either you can show it as a actual, depend from situation to situation. This is your conservatism concept. Remember this conservatism concept very carefully, because it's going to be useful while doing a issue of debenture chapters. Okay, debenture, I mean all the chapters important only, but in there it is particularly very important. Next is consistency. Boss, whatever accounting principle you apply 1 year, please follow it throughout. Don't change your concepts. That's what the consistency concept talks, right? So, sir, we can't change it at all. Of course, you can change it. When we can change it, sir? In 3 situations. In 3 situations, we can change it. Which are those 3 situations, sir? Lab. We can tell it as lab. One is when it is required by law, when it is required by statute, you can change it. When it is required by accounting standard, A. When it is required by accounting standard, you can change it. B. That is when you feel that if you change whatever the policy principle you are following now, then you are going to get a much more true and fair view in your financial statement, then please feel free to change it. That is your consistency concept. Materiality is, boss, of course you have to record everything. You have to record even 1 rupee transaction. But are you going to disclose everything in your financial statement? Pencil purchase 3 rupees, eraser purchase 5 rupees. No. You're going to show it as a stationery purchase 10,000. Try to understand what does that mean, sir? Certain items, whether you disclose it, don't disclose it. I repeat, whether you disclose it, don't disclose it. If it won't change the decision of the users. If you disclose, for example, investor. If you disclose, investor might invest. If you don't disclose that information in your financial statement, investor might not invest. If that is the case, those are known as material. That is, if you disclose or if you don't disclose, the decision is going to change. Those are material things, material items. Whereas certain items will be there, certain things will be there, certain expense income will be there. You should record it. Recording is different, disclosing is different. Disclosing is showing this particular thing in financial statement. You are not going to show eraser, pencil and all. Instead, you are going to show it as stationery, not going to divide and show and all. Right? So, disclosing it or not disclosing it, if it won't change the information or if it won't change the decision of the user, those items we call it as a immaterial items. Those items we call it as what? Immaterial items. Okay. So you should make sure all your material transaction, all your material items are disclosed in the financial statement. There are fundamental accounting assumptions. What do you mean by fundamental accounting assumption? It is assumed that any business would be following this. Any business will be following this unless and until they tell, boss, it is not followed. Unless and until they tell, boss, it is not followed, then it is assumed as followed. For example, you don't have to tell every day, I had a breakfast, I had a lunch, I had a dinner. Those nibba things is different. That you leave. But still, so you don't have to tell that no every day. Because it is assumed that you had a breakfast, you had a lunch, you had a dinner. Correct? You don't have to tell all the time. Mela babu ne tana taya, all those things are not required. So try to understand. So now that is fundamentally assumed. Boss, if you are not telling that you didn't have a breakfast, you didn't have a lunch, you didn't have a dinner, then it is assumed that you had it. No, it's assumed that you had it. So Fundamental accounting assumptions are those kind of assumptions, those kind of concepts which you have used it, but you don't have to disclose that you have used it. If you don't tell that that I have used it, still we are going to assume you have used it. If you particularly tell that I didn't use it, then we are going to assume you didn't use it. All other time we are going to assume that it has been followed. What are those, sir? Going concern, accrual, consistency. Going concern, accrual, consistency. These are the three fundamental accounting assumptions. We are going to assume that these are followed if in the financial statement nothing is mentioned about it. If it is mentioned that these are not followed, then only assume these are not followed. All other accounting principles and all, you should disclose particularly that, boss, these things have been followed. Clear? What do you mean by financial statements, sir? Financial statements are nothing but a statement prepared by an organization to ascertain the financial position and performance and communicate it to the end users. Position means what you are going to prepare, sir? Balance sheet. Performance means P&L. These are the certain aspects. There is something called capital expenditure and revenue expenditure. What do you mean by revenue expenditure, sir? Expenditure which we did to run the day-to-day activities of an organization, which means we are going to charge it to P&L. Capital means what, sir? Capital expenditure are those expenditure which are not to run day-to-day. It is not in recurring nature. It's a non-recurring nature. It is incurred to generate a revenue. Not by selling it, by using those things. Basically, purchase of an asset is a capital. Are you going to write off in P&L, sir? No, only depreciation of it will be written off in a P&L based on the usage of that capital item. Okay, that is it. Contingent asset and contingent liability, people. Contingent asset means it is not at a asset. In future, it will be an asset. So there is a present possible asset is there due to past event. That is your contingent asset. So are you going to show it in the asset side? Of course no, sir. Why? Conservatism concept. So it won't form part of your financial statement. Then where we should show, sir? You should show it in a board of directors report. Telling that we might get some future asset. For example, let's say our ArivuPro name, some other brand is using it. Some other person is using this particular name. So we have filed a complaint. So court might give us a compensation of 1 crore. Now it might not yet decided. Judgment is not yet come. So now try to understand. Now for this 1 crore will be contingent asset for ArivuPro. Not yet asset, because in future it's going to come. Yes. So we have nothing to lose. If we gain. If we nothing. No lose and all. So now we treat it as a contingent asset. Where it should shown, sir? Whether in financial statement? The answer is no. It should be shown in board of directors report of ArivuPro. That is your contingent asset. Contingent liability, sir? Future liability, future obligation. So yes, sir, contingent asset won't come. So contingent liability also won't come. No, the answer is no. Conservatism again. If there is a future losses, future expenses, please disclose it in a financial statement. So future loss, of course, we are not going to show it as a liability. Instead, we are going to disclosing it as a contingent liability in the notes to accounts. In the notes to accounts, we are going to show it as a contingent liability. Example, sir, think from that point of view. One more institute which use the name of ArivuPro. For them, they might have to pay the 1 crore compensation in future. Not yet decided, judgment is not yet come. But they might have to. Now, this 1 crore is contingent liability for them. This is your contingent liability things. Okay. And all other things are there. Now, journal entry, basically we are going to use dual entry system, people. That is debit and credit. For every transaction, we are going to do two aspects. One debit aspect, one credit aspect. So accounting equation is nothing but we are going to treat asset is equal to liability plus capital. We are going to treat it as asset is equal to liability plus capital. Okay. So how to account, sir? How to decide what to debit, what to credit? How to decide what to debit, what to credit? We have two approach for it. One is traditional approach, also known as English rule. One is modern approach, also known as American rule. One is traditional approach, also known as English rule. One is modern approach, also known as American rule. Okay. What do you mean by traditional approach, sir? As per traditional approach, we are going to divide accounts into two. Personal accounts, impersonal accounts. Personal accounts, impersonal accounts. Whereas impersonal account could be further divided into two. Real account, nominal account. Real account, nominal account. Okay, what do you mean by this, sir? Personal account, any account which is relating to person. Any account which is relating to person is known as a personal account. Other than account relating to person is a impersonal account. What do you mean by person, sir? Person could be a natural person, person could be an artificial person, person could be a representative person. Person could be a natural person, person could be artificial, person could be a representative. Okay. What do you mean by natural person, sir? Any human being accounts, Ram account, Sham account, Rahim account, Robert account, all these accounts is known as natural person account. What do you mean by artificial person, sir? Any account which is relating to which is relating to artificial person, like company, LLP, trust, society, where law has given a recognition as a person. For example, Companies Act. Companies Act treats company as a person, right? Now we are going to do the transaction in the name of company. You are going to sign the contract in the name of company. You are going to enter into loan in the name of company. So that kind of things we call it as artificial person. That account also will come under a personal account only. Example, ArivuPro Educational Consultancy Private Limited, Reliance Limited, Tata account, all these. Okay, done. Representative person, sir. Account which represents the one more person. Account which represents one more person. For example, to my employees, let's say Satish, Surya. These are to my employees. Now to them I have to pay the salary of this month. I haven't paid it yet. So it is outstanding. It is outstanding. Now I am not going to open Satish account and Surya account separately. Instead, what I am going to do, sir? I am going to show it as a outstanding, single outstanding salary. Now this outstanding salary is representing these two people, Satish account and Surya account. That is your representative person. Real accounts are all the impersonal accounts which are assets. All the impersonal accounts which are assets are real account. Nominal accounts are all your expense, losses, incomes, gains. All your expense, losses, income, gain will be your nominal account. Okay. How to treat it, sir? How to treat it? Golden rule of accounting. If it's a personal account, people, if it's a personal account, you should debit the receiver of benefit, credit the giver of benefit. If that person is receiving benefit from us in that transaction, debit that person. If that person is taking benefit from us, credit that person. That is your personal account. Real account, sir. Real account is relating to assets. No. Debit what comes in, credit what goes out of the business. Debit what comes into the business, credit what goes out to the business. Everyone will be knowing this because whatever the transaction it is, forget about real, personal, nominal, everyone will apply only this. Correct? So nothing like that. Only for real account you should apply this. What does real account tell, sir? Debit what comes in, credit what goes out. Debit what comes in, credit what goes out. Whereas nominal account, it is relating to expenses and losses and incomes and gains. Nominal account relating to expenses and losses, incomes and gains. So all the expenses and losses you should debit. All the incomes and gains you should credit. Expenses and losses debit, incomes and gains credit. Expenses and losses debit, incomes and gains credit. Okay, sir. Okay, sir. Fine. Debit, expense, credit, income. Correct? Yes. Real account though we have it in our sleep also we can tell, sir. Debit the receiver of benefit, credit the giver of benefit. But personal account is a doubt, sir. What to do? Very simple. You can do this. Listen. Receiver, giver. Receiver, giver. Take your eraser. If you erase half of the R, it will give you D, which means receiver, debit. You erase half of the G, it will give you C, which means giver. So debit the receiver, credit the giver. This is your golden rules, traditional. Modern is what, sir? Modern is your accounts are divided into 5 parts. Your accounts are divided into how many parts, sir? 5 parts. What are those 5 parts, sir? Asset account, liability account, capital account, income account, expense account. I repeat. Asset account, liability account, capital account, income account, expense account. Asset account, liability account, capital account, income account, expense account. How to remember this, sir? How to remember this? Hope you guys remember the Bangalore spelling, correct? Bangalore, correct? Take only this, not G. Take only this. Asset A means asset, L means liability, O means owner's capital, R means revenue, E means expense. A means asset, L means liability, O means owner's capital, R means revenue, E means expense. So asset what you should do, sir? Debit increase in asset, credit decrease in asset. That is, if the asset balance increases, debit it. If the asset balance decreases, credit it. Liability, sir. If the liability increases, credit it, decreases, debit it. Capital, sir. Of course, liability and capital are same. No, always. I told you, it's just a name given to one more liability. That's it. So, capital it is, sir. Debit means when you should debit, decrease in capital. When you should credit, increase in capital. Income. That is debit decrease, credit increase, expense, debit increase, credit decrease. Sir, how to remember this, sir? Listen. There is one logic. Listen. These 5 fingers. Asset, liability, O means owner's fund, capital, R means revenue, income, E means expense. Do your hand like this. Salman Bhai, sir. Yeah, Salman Bhai. Do your hand like this. Listen here. This is your asset. This is your expense. Correct? ALORE. Asset, expense. Both are and you know this. Right hand side of your ledger. Imagine ledger. Right hand side is, this side of the account will be debit. This side of the account will be credit. This side of the account is debit. This side of the account is credit. Correct? Think from the account book point of view. Books. I'm a books. Imagine in front of me ledger. This side debit is there. This side credit is there. So right hand debit side. So see this. Do like this. Right hand upside. Asset and expense. Asset and expense are looking upside, which means increasing. So all 3, that is owner's capital, revenue, as well as liability. Owner's capital, revenue, liability, they are looking downward. So asset and expense, they are increasing when it is debit, because right hand is debit, I told, no? So when it is debit, asset and expense are increasing. So when it is debit, liability, capital, and your revenue, liability, capital, and revenue are decreasing. So decrease in liability, decrease in capital, decrease in revenue, debit, increase in asset, increase in expense, credit. Okay. Now do like this. Your left hand. Spider, web and all won't come. Okay. Now quickly. This is your asset. This is your liability. They are looking downwards. Your capital, your liability, your income looking upwards. Credit side. So credit side people, decrease in asset, decrease in expense, credit it. Increase in liability, increase in capital, increase in income, credit it. Okay, sir, done. So these are the certain things, people. And there will be two kind of discount. One is cash discount, one is trade discount. Trade discount means what, sir? At the time of purchase, that is or sale, it is given, which means it is known at the time of purchase or sale. Cash discount means it is given for the prompt payment. It is given for the prompt payment. Cash discount will form part of your books of accounts. Trade discount won't form part of your books of accounts, because, for example, if one goods they tell 10,000 rupees / 8,000 rupees, now the 2,000 is a trade discount given at the time of transaction. Now what you are going to do, sir? Now you are going to write that particular transaction as 8,000 only, which means you are taking is net of trade discount. But cash discount is like, okay boss, 8,000 you have to pay within 3 months. If at all you pay within 2 months, you have to pay just 7,000. Now if you pay within 2 months, 7,000 you have to pay 1,000 extra discount you got now. That is cash discount, that you have to record in your books of accounts. Hope it is clear. These are the certain basic aspect as per accounts. And there is trial balance and all is there, people. Trial balance is nothing but a statement prepared just to check accuracy, not a account. That doesn't mean the trial balance is matching. That doesn't mean that your accounting is correct. Okay, there could be a mistake also. But debit credit amount, both the side you have written or both the side you haven't written. That's the meaning of that. It could be done on three ways. One is balance method, where you will take only ledger balances. You are going to write debit credit. Total method, you are going to take both the total debit side total of that particular account, credit side total of that particular account. Both will match. Balance and total method, both balance you will take, total will take. Generally, which one will follow, sir? Balance method. That is, we are going to take balances of that account. And always remember, if the asset is like this, okay, there is, let's say, some transaction are in the debit, which is 20,000. There is some transaction in the credit, which is 15,000. Now 5,000 is the balance, correct? 5,000 is the balance. Now as it is a credit side, it's a credit balance, correct? The answer is wrong. People, it is debit balance, because debit side is more. Always remember, balance means which side is more, that balance it is, not balancing figure side. So this account has debit balance of 5,000, not credit balance. Keep that thing in mind. Okay, these are the basic aspect of introduction to your accounting and all. Okay, not much important, but you should have an idea of it when we are doing a lot of other chapters. Hope you guys understood this basic. That modern approach, traditional approach, you should keep in mind always while solving or while doing journal entries. Those are very important factors. Yes, now it is introduction to corporate accounting. People, what do you mean by corporate accounting, sir? Pretty simple. Corporate accounting means accounting for corporates, accounting for companies. Accounting for companies is known as a corporate accounting. Okay, now we'll go only to Indian companies, okay, or companies operating in India. See, there is Companies Act 2013. And what does that say, sir? In the chapter 9, section 128 to 138, around 11 sections are relating to maintaining the books, okay. So schedule 2, schedule 3, all these things will be there. As per section 128, that is first section relating to maintenance of the books, what it tells, sir? All companies should prepare and maintain its books of accounts. So it's not like any other entities, any other kind of different form of entities. If you are a company, how small you could be, you have to maintain the books of accounts. So it is compulsory. Sir, maintaining books of accounts compulsory to everyone? No, it's not. So if you're small and all, why you want? As per tax also you don't want. As per companies, if you're not a company, then you don't want. But if you're a company, you have to maintain your books of accounts compulsorily, because you have to get your books audited compulsorily. So auditing is like getting audited is compulsory as a company. So if you want to get an audit done, there should be something to see. No, there is nothing but books of accounts. So maintenance of books of accounts is also compulsory. So as per section 128, people, all companies should maintain the books of accounts. Books of accounts. Sir, a company has HO, a company has branch, two different companies, or same company, HO and branch. Then, sir, although you have branch, including branch, you have to maintain the books of accounts. No exemption as such. For branch also, you should maintain the books of accounts. Okay, on what basis, sir? Cash basis. That is, when cash comes, I will treat it as income. When cash goes, I will treat it as a expense. The answer is no. You have to treat it under accrual. Accrual basis. What is accrual? Whether expense is paid or not paid. Amount relating to expenses, paid or not paid, doesn't matter. Boss, if it is incurred during the period, treat it as expense of the period. Income received, not received, doesn't matter. If that income is earned during the period, treat it as income of the period. That is your accrual basis. And you should maintain it under a double entry system. You should maintain it under double entry system. Debit and credit. You can't tell only debit, only credit. You have to maintain under double entry system. So come on, as per section 128, all the companies registered under Companies Act 2013 or prior to that should maintain their books of accounts. Yes. On what basis? Accrual basis. Which system? Double entry system. Okay. Sir, financial statement of the company will be including of what, sir? Financial statement of the company will be inclusive of 5 things basically. What are those, sir? Balance sheet, profit and loss, cash flow statement, notes to accounts, and statement of changes in equity. However, statement of changes in equity will come only when the equity got changed in that period. Otherwise, SOCE won't come, SOS won't come. Only these 4 things will be there. Which and all? Balance sheet, P&L, cash flow, notes to accounts. Done, sir. P&L and balance sheet, you know, sir. Cash flow is what, sir? Showing how much cash inflow happened during the period, how much cash outflow happened during the period. Anyhow, we have a separate chapter for this. We are going to discuss there. Great. Notes to accounts means we can't show everything in financial statement, no. So giving a explanation for the items in that financial statement like balance sheet, P&L and cash flow is known as notes to accounts. Okay. However, if you are a OPC, then you just have to prepare balance sheet, P&L and notes to accounts. No need to prepare a cash flow statement. That exemption is given. If you are a one-person company, then no need to prepare a cash flow statement. Okay. Now coming to section 129. In 128, we prepared a books accounts, right? Books of accounts. But in 129, it's about financial statement. See here. Section 129 of the Companies Act 2013 governs the preparation and presentation of financial statement of a company. It deals with preparation and presentation of what, sir? Financial statements. So it shall give a true and fair view of the company, and it should follow accounting standard which is prescribed under section 133. As per 133, certain accounting standards are prescribed to certain companies, so they have to follow those accounting standards while preparing a financial statement. Okay, you have to follow those things while preparing financial statement. Done, sir. Next. Also, you should do it as per schedule 3. You should prepare your financial statement as per schedule 3. That is, first equity and liabilities will come first. Below that, assets will come. Equity and liability again divided into equity, non-current liability, current liability, asset divided into non-current asset, current asset, like that. So this is schedule 3. Sir, all the companies should follow. Few exemptions is given, or few companies are not required to follow. Which are those, sir? Insurance company, because they are regulated under IRDA, correct? Then banking company, because RBI Act is covering that. Electronic company, electronic acts are covering that. So any other company which is notified by government, no need to follow schedule 3 completely. Okay, they are exempt from schedule 3. All other companies should follow schedule 3. What schedule 3, sir? Schedule 3 is nothing but doing the accounts, balance sheet vertically and all. Okay. Schedule 3 has two parts, sir. Part A deals with the balance sheet. Part 1 deals with balance sheet. Part 2 deals with statement of P&L. Part 1 balance sheet, if you see, you can tell equity, liability and asset. Two parts. First equity liability will come. Below that assets will come. In the equity liability, we have shareholders fund, SAMPA, that is share application money pending allotment, non-current liability, that is liabilities which you have to pay or which is due, not due for less than 12 months from the reporting period. For example, if I am preparing a balance sheet of 31st March 2025, then those liabilities which are not due by 31st March 2026, over and above this is known as non-current liability. If at all we have to settle it before 31/3/26, that is 1 year, within 1 year from the reporting date. Reporting date means balance sheet date. Then those are known as current liabilities. Okay. Assets, non-current and asset which has which has a benefit for more than one accounting period is a non-current, which is going to give benefit of not more than this accounting period, that is current asset. Equity and liability, shareholders fund, that could be further divided into 3. Share capital, reserves and surplus, money received against share warrant. SAMPA, non-current, it could be long-term borrowings. DTL, other long-term provisions. Current liability, short-term borrowings, trade payables, other current liabilities and short-term provision. Assets, non-current and current. Fixed asset, non-current investment, deferred tax asset, long-term loans and advance, other non-current asset. Basically here fixed asset, we call it as property, plant and equipment. We call it as property, plant and equipment. Here investment, current investment is there, inventory is there, TR is there, C&CE, short-term loans, other current assets. These are the certain aspects. Okay. Now, just look at the format of balance sheet and P&L. As questions are not there, so far they haven't asked question from that also. Anyhow, that things we are going to learn in consolidation once again. So no need to look here. Now going to XBRL. What is the meaning of XBRL, sir? Extensible Business Reporting Language. Earlier you used to use paper, no? Now no need to use the paper for filing your forms with your MCA. You can use a XBRL. No need to send in a paper, just fill certain forms. That language in which it will go is XBRL. Sir, it's not English, it's English only. But the reporting is known as XBRL for a communication. It's a language for electronic communication. Okay, sir. Who and all have to file their reports under XBRL, sir? Who can't give papers? They have to file XBRL. Following are the companies should file their financial statement and other document under section 137 with the company in e-form, that is XBRL AOC 4. So form name is what, sir? AOC 4. Here what we are going to record or what we are going to share? We are going to share financial statement as per which section? 139. As per section, 137. 139 is audit. 137. Okay. Which are the companies, sir? Companies listed with stock exchanges in India and their Indian subsidiaries. So companies whichever listed in the stock exchanges of India and their Indian subsidiaries, everyone should file their AOC 4 in XBRL with registrar. 2. Companies having paid up capital of 5 crore rupees or above. If your company has paid up capital of 5 crore or above, then you have to file it under a XBRL. Companies having turnover of 100 crore or more, you have to file it under XBRL AOC 4. If all companies which are required to prepare their financial statement according with the Ind AS. If you are a company preparing your financial statement under Ind AS, you have to file, and any other company which is notified by the government. This is one of the important question. This is one of the important question. Come on, what is again? Which are the companies? Which are the companies required to file their AOC 4 under a computerized form, that is e-form AOC 4? 1. Companies which are listed in India plus all the companies which are not listed, but if they are subsidiary of such company which is listed in India. 1. 2. Which are the company having capital of more than 5 crore or 5 crore? 5 crore is also included. 3. Which are the company having turnover of more than or equal to 1 crore? 4. Which are the company following Ind AS while preparing or required to follow Ind AS while preparing their financial statement, they have to follow they have to follow XBRL rule. And any other company notified by the government have to follow the XBRL format. This is all about introduction to your corporate accounting. So now we will be jumping directly into accounting for share capital. We have different segments so that we will discuss further. Okay. Yes. Now we will be discussing about accounting for share capital. Okay. Accounting for share capital. In share capital, many things will be there like issue, reissue, forfeiture, bonus, buyback, all those many things are there. We'll see one by one. Before that, we should understand what do you mean by share capital? Correct? Share capital is nothing but people, capital of the company which is limited by shares. Capital of the company which is limited by shares, that capital we call it as a share capital. Okay, sir. Such a share capital, when it is divided into small indivisible unit. What do you mean by that, sir? Share capital is divided into small units which are known as shares, and these shares cannot be indivisible, which means there cannot be 0.5 share, 0.7 share, 0.8 share like that. Share means it will be in 1, 2, 3. The reason is share should be indivisible. So capital of a company which is divided into small indivisible units, those indivisible units are known as shares. Okay. So as per schedule 3 or for the purpose of schedule 3, your share capital could be disclosed as following. One is authorized share capital, also known as nominal share capital. What do you mean by this, sir? Registered share capital. What do you mean by this, sir? This is the share capital which is mentioned in the capital clause of Memorandum of Association. So authorized share capital is the share capital which is mentioned in the Memorandum of Association. That is, this is the maximum amount of share capital that could be raised. Maximum amount of share capital that could be raised by any company. Sir, so after that you can't raise it at all. You can raise, but you should change your authorized share capital. You should pass a resolution and you should change your authorized share capital. Okay. Next is issued share capital. Issued share capital is what, sir? Out of the authorized share capital, how much you are offering to the public? Out of authorized share capital, how much you are offering to the public, that thing will be known as issued share capital. Okay, sir. What do you mean by subscribed share capital, sir? Out of issued share capital, for how much applications we got, how much public is interested, how much public subscribed, that thing is called as subscribed share capital. Out of the subscribed share capital, how much we ask them to pay. For example, our authorized share capital were 100 shares. We issued 90,000 shares. In that subscription was 85,000 shares. To these 85,000, we are asking rupees 6 now. Now this 6 rupees is a called up. Let's say share is of rupees 10. So we called it for 6 rupees. Now rupees 6 is called up. Rupees 4 is uncalled, which means you can call whenever you need a money. So out of rupees 6, how much we collected? That is your paid up share capital. That is called up share capital minus unpaid amount, which is also known as calls in arrears. That will give you paid share capital or paid up share capital. Okay, these are the certain things you should keep in mind. Yes. Now, sir, share can be issued for consideration. Yes. Consideration can be in cash or it can be in kind. Like asset and all you purchase. For that, you have issued a shares. Possible, sir? Yes, possible. Sir, shares can be issued at par. What do you mean by par, sir? Face value and issue price. Both are same. It can be issued at premium. Issue price means offer price. At what you offer to, at what price you offer to public. So it could be issued at premium. That is, face value is lesser than issue price or issue price is greater than face value. For example, 10 rupees share, face value share. If you issue at 10 rupees par, 10 rupees face value share. If you issue at rupees 14, issued at premium. 10 rupees share. If at all you issue at rupees 9, it is discount. So shares can be issued at par, premium or discount. However, no company can issue shares at discount. So issuing a shares at discount is not valid now. Issuing a shares at discount is not valid. Shares either that should be issued at par, either that should be issued at a premium. It cannot be issued at a discount. It cannot be issued at a discount. However, if you are issuing a sweat equity shares, then you can issue it at a discount. If at all you are issuing a sweat equity shares, then you can issue at a discount. Sir, what will be the entry, sir? Accounting for share capital, what would be the entry, sir? Let's say issued at par. Issued at par. Face value rupees 100, issue price rupees 100. Face value rupees 100, issue price rupees 100. Now try to understand. What happens, sir, when we issue the share capital? Inside the company, money will come, sir. Correct? Increase in the bank balance. Yes. Bank is an asset. Yes. Increase in the bank. Debit. So bank account debit. Okay. The other account is capital, sir. Capital of the company also will increase. Yes. Increase in the capital. Credit. So bank account debit to capital account. But here we call it as a share capital account. So bank account debit rupees 100 to share capital account rupees 100. Sir, what if it is issued at premium, sir? That is face value rupees 100, issue price is rupees 118. People try to understand, this 18 won't be forming part of capital. Always remember one thing, capital will always and always reflect the face value. The two called up face value, all those things I will tell later, but always remember capital will represents only and only face value. So this 18,000 premium, what to do, sir? This 18,000 premium shall be transferred to one special account called securities premium account. Securities premium account. So try to understand, bank is coming in. So bank account debit 118 to share capital 100 to securities premium 18. Bank account debit 118 to share capital 100 to securities premium 18. Okay. Sir, what do you mean by security premium, sir? Security premium is one kind of reserve. Reserves and surplus only. However, it is not free reserve, which means you cannot distribute a dividend out of it. You cannot distribute dividend out of it. Then what kind of reserve, sir? For what and all we can use it? You can use it to issue bonus share. You can use it to write off your preliminary expenses. That is beginning expense will you do now while forming a company. Those expenses, to write off the expenses relating to issue of securities like commission, discount on issue, etc. To write off issue related expense, you can use this securities premium. To provide a premium on redemption of securities like redemption of debenture and redemption of shares, to buy back its own securities. Come on, what and all? First one is to issue bonus share. Second, to write off preliminary expense. Third one, to write off issue related expense. Fourth one, to provide for premium on redemption of securities. Fifth one is buyback. However, the company which is following section 133 cannot use securities premium for point number 2 and point number 4. What is point number 2, sir? That is to write off a preliminary expenses. Next one is to write off a premium on redemption. To write off a premium on redemption, you can't use it, which means if at all you are a company which is following section 133, then you can use it only for 3 purposes. What are those 3 purposes, sir? 1, issue of bonus. 2, to write off the issue related expenses like discount, commission, etc. 3, to buy back its own securities, which you can't use, sir, to write off preliminary expense, to write off a premium on redemption. Sir, if the question is silent whether company is following section 133 or no, then assume it as company is following section 133, which means avoid avoid using securities premium to write off preliminary expenses as well as to write off premium on redemption of securities. Okay. Sir, which are the company following section 133? Section 133 is relating to accounting standard. Now, as I told yesterday, now all the companies have to comply with section 133. So, moral of the story is only provision wise it is 1, 3 and 5, 4 and 2. But practically speaking, 2 and 4 companies cannot use because all the companies should comply with the accounting standards. Okay. Sir, when shares are issued at discount, sir, I told you share capital will always and always be credited with face value. Issue price is 80, rupees 20 will be what, sir? Rupees 20 will be loss. So we are going to record, sir, bank account debit 80, discount on issue of account debit 20, to share capital account 100. Okay. Now, what are the steps involved in issuing, sir? First, you are going to issue the prospectus, then you are going to receive the application, then you are going to make them allotment and make the call when and where required. Make them call to give a money when and where required. Okay. Now listen. First one, what we discussed: issued at par, bank to share capital; issued at premium, bank account debit to share capital to securities premium; issued at discount, bank account debit, discount on issue account debit to share capital. But people, what if application money we receive first, after that allotment money we receive, after that call money we receive? I mean stepwise. You are not taking the money in a single shot. Instead you are taking it one by one. In that scenario, how you are going to deal with that, sir? That we are going to see now. Okay, that we are going to see. Okay. Now, sir, let's say it is issued at par, sir. Application 20 rupees, allotment 50 rupees, call 30 rupees. Application 20, allotment 50, call 30. In that scenario, sir, first how the process works I will tell. First we will receive the application. Okay. After application received, to whomever we allotted, we make the allotment, and we might send certain share application back also, that I will tell later. Done. After allotment, we are going to make a allotment call, I mean give us a money. After they make a allotment payment, then we will make the calls, first call, second call, like that. They keep on paying the money. This is how it works. Which means first application money we receive. In all other stages, first we ask them, then they give us. When we issue the prospectus, first we'll ask them a money, for application. We ask them for a application to apply for our company. But keep one thing in mind, this is not a financial transaction. That's why it's not recorded in books. In books, the recording starts only from the application stage. That is, once they give us the money, then only money and monetary exchange is getting exchanged. Correct? Okay. Now, issued at par, sir. First, application money we will receive. That is, we are going to pass the entry as bank account debit to share application account 20. Okay. Now, sir, you allotted it, which means from share application, you are going to transfer it to, share capital. So share capital, increase in a capital credit. So to share capital, share application debit it. That is, share application account debit to share capital account 2020. Done. Next, what you will do, sir? You will make a allotment. Entry will be share allotment account debit to share capital account, because you make a allotment, you call the money, right? Called up portion. After that, when they pay a money, entry will be bank account debit to share allotment account. Correct? After that, we make a call, respective call, first call, second and final call, third and final call, like that. So share call will do where we raise our capital, increase our capital. Later, we will receive the money. Entry will be bank to share call account. But if you notice here one thing, people, very carefully. If you notice one thing here very carefully, listen, first and second entry, debit share application, credit share application, I will take out. Third and fourth entry, debit share allotment, credit share allotment, I will take out. Fifth and sixth entry, debit call, credit call, I will take out. Now if you see carefully, credit side 20, 50, 30, 80 rupees are remaining. Debit side 20, 50, 70, 30, 100 is remaining, which means final entry what we are left out with is bank account debit to share capital account only, the first entry what we passed. But here everything is not happening in a single day. So what we are going to do, we are going to split it. Hope you understood. Now, sir, when the shares are issued at premium, sir, face value is 100. Okay, face value is 100. At application stage 20 rupees, allotment stage 70 rupees, call stage 30 rupees, which means 120 rupees. We are collecting 120 rupees, which means 20 rupees extra. How that 20 rupees extra, sir? Allotment 70 rupees, no? In that 50 rupees is a face value, 20 rupees is a premium. 50 rupees is face value, 20 rupees is premium. Always remember, if the question is silent, as to in which the premium is there, in which stage the premium is there, whether application stage, whether allotment stage, whether call stage. If they ask, if they know, don't give this, in which stage premium is there, then always remember it is assumed to be there in the allotment stage. If they particularly tell it is at the application stage, if they particularly tell allotment, call. If they don't give anything, then assume it as at a allotment stage. Okay. First, application piece, it is nothing to do. So straight away I am going to write it as bank account debit to share application account. We received a share application. Then we make them allotment, that is share application account debit to share capital. Right? Their application money transferred to share capital. Later we'll make them allotment. Entry will be share allotment account debit, but allotment stage we are receiving 70 rupees. Reason being 50 rupees towards share capital, 20 rupees towards securities premium. Both are in the nature of capital only, because reserves is also capital only, owner's fund. So entry will be share allotment account debit 70, to share capital account 50, to securities premium 20. Okay, sir. Later, when you receive this, entry will be bank to share allotment. You make a call, share call to share capital, share bank to share call. This is your premium when it is issued at a premium. This is the special entry you should keep in mind. Done, sir. Next. Okay. Now, subscription, that is how many people subscribe for our shares, how many people showed an interest in our shares. It could be par, that is we issued 1 lakh shares, subscribed is also 1 lakh. Practically speaking, not possible, but yeah, we issued 1 lakh shares, they subscribed also for 1 lakh. Next, oversubscribed. We issued 1 lakh shares, they subscribed for 110,000 shares. We issued 1 lakh shares, we got application for 1,10,000, which means application received is greater than issued shares. Under subscription means we issued 1 lakh shares, we received application for 95,000 shares. We issued 1 lakh shares, we received application for 95,000 shares. Now, sir, how to deal with this, sir? If it is issued at a par and subscribed at a par, that is application received is equal to issued number of shares, then whoever applied for them, you can make an allotment. Whoever applied, you can make them an allotment. If it is undersubscribed, just check whether minimum subscription criteria is satisfied or no. Just check whether minimum subscription criteria is satisfied or no. If the answer is yes, then whoever applied for it, for them, how much ever they applied, just give it. Whoever applied for that, how much ever they applied, give it. If it is not satisfied, then refund all those application money, because unless and until you satisfy minimum subscription criteria, you can't issue the shares. Okay, sir, done. Now, what if it's a over subscription, sir? So can I issue 1,10,000 shares? The answer is no, because your allotted shares cannot exceed issued shares. Allotted number of shares cannot exceed issued number of shares. So max to max you can issue is issued number of shares. In that scenario, what you can do, sir? You can do two things. One is reject excess application. That is, up to 1 lakh application I will keep. Other 10,000 application I will reject. Sir, now the 10,000 whose he will reject, sir? The people who applied first or the people who applied last? Nothing like that. Whoever management decides. Board of director decides. So whoever board of director decides, those application will be rejected. Or to be in the fair side, we can go for parota allotment. What allotment, sir? Parota allotment. Parota, no, not parota, it is pro rata, proportionate rate. That is, let's say you have applied for 11 shares. Application is 11 shares. Now what we will do is, boss, listen. When we got an application of 110,000, we are allotting in total 1 lakh. Correct? When we got an application for 110,000, we are allotting 1 lakh shares. Now we got an application for 11 from this person. To this person, how many shares we should allot? That is pro rata allotment. Hope you guys understood. Proportionate. That is overall. For example, 2 lakh application received. We are issuing 1,50,000. One person applied for 6,000 shares. How much we are going to give it? Answer will be 4,500, like this. Okay, done, sir. So you are telling that application excess will be there. Yes, but that money you took, no, sir. That money you took, no, application money, they didn't know how much will get allotted. They applied. Now their money we have received. What you are going to do, sir? We can do two things. One, refund the money, or you just adjust it to the next stages, like allotment, first call, like that. Okay. So if you refund the money, what will be the entry? When you received, what was the entry, sir? Bank to share application. Now, as it is not allotted, when you refund, entry will be share application to bank. Okay. Adjusted to next stage means, sir, from application you are going to transfer it to allotment. Because you can't keep it in application account, no. So in the application account, how much ever is required towards the share capital, that much we will transfer to share capital. Extra what we got, that we will transfer to allotment. Now, sir, allotment means you will keep for yourself. The answer is no. Next stage we will call, no, to pay them like asking them to pay the allotment money. That time we will not take full money. After adjusting this money, we are going to collect the money from them. So from share application, I will reduce. Share allotment, I will give a credit. So how many shares a company can issue, sir? Company can issue either maximum or least of minimum, least, whichever is lower, of actual application received or issued number of shares. Okay, that is this. Done. Let's see few questions. Okay, just let's discuss padapat. Then we'll get a clear picture of this issue. Issue is very easy concept. Every time they ask for 10 mark, issue, reissue and forfeiture together. So we can't ignore this topic. One of the easiest. Okay, we'll see one by one questions. Let's discuss as much as possible. Okay. Look at this question now. A company invited application for 10,000 equity shares of rupees 50 each. So 50 is what, sir? Face value. Payable on application 15, allotment 20, first and final call 15. So total 15 plus 20, 35, 35 plus 15, 50. 50 rupees is payable. Applications are received on how many shares? 10,000 shares, and all the applications are allotted because you issued 10,000, you got an application of 10,000. Moral of the story, subscribed at par, no over, no under. Done. And installment money was duly received by the company, which means all the money is received. First, what is the journal entries in the book? First, we will receive a share application. Correct? Entry will be share application account debit to share capital account. Sorry, bank account debit. We will receive a money. No? Bank account debit to share application account. Bank account debit to share application account. How much is the share application, sir? 15 rupees. 10,000 into rupees 15, which will come to 150,000. Okay. After that, when we are allotting, we are going to transfer every money to the share capital. Entry will be share application account debit to share capital account. Done. Next, we are going to make an allotment. After allotment, we'll make a allotment call, right? That is for 20 rupees. So entry will be due entry we should pass. Due entry. Share allotment account debit to share capital account. 10,000 into 20, which will come to 22 lakh. 2 lakh, correct? So share allotment account debit to share capital account, 2 lakh. Now we will receive the allotment money. Entry will be bank account debit to share allotment account, 2 lakh. Bank account debit to share allotment account, 2 lakh. Later we are going to make a first and final call. We are going to make first and final call. So due entry first. Share first and final call account debit to share capital account, rupees 150,000. Later we will receive this money, bank account debit to share first and final call account, 150,000. Simple. Second one, Jupiter Company Limited issued 35,000 equity shares of rupees 10 each at a premium of rupees 2 payable as follows. So it is issued at a premium. Second case. So securities premium account should get credited by 2 rupees per share. We issued 35,000 shares. Application 3 rupees, allotment 5 rupees, including premium. Moral of the story, it includes 2 rupees premium. Okay. Other 3 rupees is capital. Done. Balance is first and final call. So how much is the balance? 3 plus 5, 8, sir. Share is of 10 rupees, sir. So 2 rupees, the answer is wrong. Issue price is 12 rupees. In that, you are going to collect 3 plus 5, 8 in the first 2 stages, which means rupees 4. Rupees 4 is first and final call money. The issue was fully subscribed. All the money was duly received. Record the journal entries in the books of the company. So, first you are going to receive the application. So, bank account debit to share application account, 35,000 into rupees 3, which will come to 105,000. Later from share application, you will transfer to share capital. Entry will be share application account debit to share capital account, 105,000. Later you are going to make the allotment. When you made a allotment, you are going to make a due entry, that is share allotment account debit to share capital account to securities premium account, because here there is a premium. So to share allotment full 5 rupees, 5 into 35,000, which will come to around 175,000, to share capital, how much, sir? 35,000 into 3 rupees, which will come to 105,000, and to securities premium, it will be 70,000. And securities premium, can you give a dividend? No, you can use it only for 5 purpose. In that also, point number 2 and 4 is correct. What are point number 2 and 4, sir? Preliminary and writing off of premium on redemption of securities. Okay. Then other 3 are what, sir? First one is bonus issue. Next one is writing off of issue related expense like commission, discount, etc. Last one is buyback of securities. Done. Then you are going to receive that money. Entry will be bank to share allotment. After that, you are going to make first and final call. Entry will be first due entry, share first and final call account debit, 4 into 35,000, which will be around 140,000, to share capital account 140,000. Then you are going to receive the money, bank account debit to share first and final call account 140,000. See here, bank to share application to share capital, share allotment to share capital to securities premium, bank to share allotment, share first and final call to share capital due entry, then bank to share first and final call receipt entry. And keep that thing in mind. If it is equity share, you should mention it as equity share. Instead of not share capital, you should mention it as equity share capital. If it is preference, you should mention it as preference share capital, preference share application, preference share allotment, like that. Answer. See here. One more thing. On 1st April 2021, A Limited issued 43,000 shares of rupees 100 each, payable as follows: 20 on application, 30 on allotment, 25 on 1st October, 25 on 1st February. Okay, sir. So 50, 50, 100 rupees, 100 rupees. So issued at face value only. By 20th May, 20,000 shares were applied for. Moral of the story: under subscription. In case of under subscription, if it satisfies minimum criteria, then we can allot it to the extent of applied number of shares, that is 40,000. Done. And all the applications were accepted. Allotment was made on 1st June. So they are telling allotment was made on 1st June. All sum due on allotment were received on 15th July. Those on first call were received on 20th October. First money received on 20th October. Okay. Journalize the transaction when the accounts were closed on 31st March. Okay. Listen here. First we'll receive the application money. When, sir? We are going to receive application money by 20th May. Correct? So 20th May, I am going to pass first entry, that is bank account debit to share application account. How much, sir? How much application we are receiving? 40,000. 40,000 into 20 will come to 8 lakh. Okay. Later, on the day of allotment, that is 1st June, we are going to transfer this to the share capital, 8 lakh. On the same day, we are going to make the due entry also, that is share allotment account debit to share capital account. How much, sir? 30 into 40,000. 30 into 40,000, which will come to 12 lakh. Then when we are receiving allotment money, 15th July. 15th July, we are receiving allotment money. Entry will be bank to share allotment 12 lakh. Bank to share allotment 12 lakh. After this, what you are going to do, sir? After this, first call you are going to make on 1st October. Correct? On 1st October, you are going to pass the due entry. Share first call account, not final call. Share first call account debit to share capital account. 25 into 40, which will come to 10 lakh. And it is received on 20th October. So 20th October, you are going to receive the entry money. So bank account debit to share first call account. How much? 10 lakh. And on 1st February, you are going to make one more call. That is 1st February. Entry will be share first and final call account debit to share capital account. Again 10 lakh. If at all you assume that by 31st March it is received, so on 31st March pass the receipt entry. Otherwise, if you think that okay, it is not yet received, then keep it as it is. See here, bank account debit to share application money shall be transferred to allotment on allotment date. Keep this thing in mind. Okay. Then on 1/6 again we are going to make the allotment due. Then you are going to receive allotment money. Then you are going to make share first call. Then you are going to receive share first call. Then you are going to make share second and final call. That's it. Okay. Done. See here. One more. See here. Mona Earth Movers Limited See, in between ICI questions are there. That's why you are finding same question number. Fewer ICI questions, fewer ICSI questions. I mean, in regular class, what we do is we solve both ICA and ICSI because we will get majority of questions. In ICA material, we don't have majority of questions. No. Sir, in regular class also, you are going to solve like this. Of course, no. Right? That will be a class of 60-70 hours where we'll be solving each and everything. Right? So, but here I can't do that in around 10 hours. That's the reason I'm just taking you through. I would have just did a concept and went, but of course, you will understand concept better when you see some questions. Mona Earth Movers Limited decided to issue 12,000 shares of rupees 100 each, payable 30 on application, 40 on allotment, 20 on first call, balance on second and final call. So 30 plus 40, 70, 70 plus 20, 90, which means second and final call is how much, sir? Rupees 10. Application were received for 13,000 shares. Over subscription, which means you have two options. Basically, three you have. One, reject all the application, excess applications. Two, prorata allotment, that is prorata allotment. Three, both reject some application, for remaining application do the prorata. That is also possible. Okay, done. Now, the directors have to take a call. Now, the directors decided to reject the application of 1,000 shares and their application money is refunded in full. So, what directors decided? Boss, no parota and all, just remove some 1,000 share applications. We are not going to make them a allotment. Okay. Allotment money was duly received on all the shares and all the sum due on call are received except 100 shares. So, you are receiving all the money of this 12,000 shares except call money of first and final on 100 shares, which means only 11,900 people are paying, which means there will be a scope of calls in arrears. What is that? I will tell later. Okay, we'll go to that slowly, one by one. Now, first we'll receive application money. We'll receive it for how many shares, sir? 13,000 shares. Entry will be bank account debit. 13,000 into application money is 30, which will come to 390,000. To share application account 390,000. Share application we are going to refund to the extent of 1,000 shares, and remaining shall be transferred to share capital. You can do two entries or you can do merged entry. So we have merged it. That is, from share application relating to 12,000 shares will be gone to share capital. That is 12,000 into 30, which will come to 360,000. 1,000 share related will be transferred back to shareholders. That is, share application account debit 360,000 to share capital account 360. Share application account debit 30,000 to bank account 30,000. Then we are going to make the allotment. At the allotment stage, you are going to make allotment only for those 12,000 shares at rupees 40 on allotment. So entry will be share allotment account debit to share capital account, as it will be a due entry. 12,000 into 40, which will come to 4,80,000. 4,80,000. Later you are going to receive that money. So entry will be bank account debit to share allotment account 480,000. Done. Next, later you are going to make a first call. So entry will be share first call account debit to share capital account 12,000 into 20, which will come to 2,40,000. Correct? Share first call account debit to share capital account 2,40,000. Then you are going to receive the money. But here be very careful, people, because you are not receiving whole 12,000 shares money. You are receiving just 11,900 shares. So 11,900 into rupees 20, which means 100 shares you are not receiving, which will come to 100 into 20, which will come to 2,000. So out of this only 238 is received. That is bank account debit to share first call account 238,000. then you are going to make the second call. As the shares are not cancelled, they are still your shareholders. You have to make a call. Entry will be share second and final call account debit to share capital account 12,000 only, as the shares are not cancelled. 12,000 into rupees 10, which will come to 120,000. Again, when you receive a money, you are not receiving on everything. You are just receiving on 11,900 shares. So entry will be bank account debit to share second and final call account rupees 1,19,000. That's it. Okay. Now, there is something called as calls in arrears. What is it, sir? That is, you called for a money, they didn't paid. You called for the money, they did not pay for it. Now, in this scenario, if you see, first you made a first call. So you debited 240. Then you received a money. That time you credited 238. So don't you think in the share first call account already 2000 will be having which balance, sir? Debit balance, because we have to receive no. It will be treated as our asset. Okay. Next, share second call, debit 120, credit 119. Moral of the story, share second and final call account, rupees 1000, which balance, sir? Debit balance. Rupees 1000, which balance, sir? Debit balance. Now listen here very carefully. If you want to keep this 2000 and 1000 in their respective accounts, you can keep it, or you can transfer it to a special account called calls in arrears account. Okay. What is this calls in arrears account, sir? First entry you passed no here, share first call account debit 240 to share capital 240. Later, bank account debit 238, share calls in arrears account debit 2000 to first call 240, which means in the first call you are not keeping a balance. Instead of first call, you are transferring it to share calls in arrears. Second call again, when you are doing here, bank account debit 119, share calls in arrears account debit 1000 to share second and final call 120,000. Then again you are not keeping any balance in the share second and final call. So balance will only be there in the share calls in arrears account. People. Hope you guys understood this. Now that is called as calls in arrears, that you called for it but they haven't paid it. So listen here. How the entries will change, sir? Share first call account debit to share capital, bank account to share first call, then calls in arrears. The first call balance will be transferred to calls in arrears. Second call balance also will be transferred to calls in arrears. Okay, sir. Now when you receive, what would be the entry? Bank account debit to calls in arrears, because balance is there in that only. Bank in account debit to calls in arrears. Okay, sir. So it's asset? No, sir. We should show it in asset side, no balance sheet. The answer is no. Then you should disclose it in balance sheet like this. You should take called up share capital. Full. Minus, you should do calls in arrears. Then you should show actually how much is paid up share capital. Okay. Now, sometimes what happens, these are Jatre people. They don't have money to pay. Okay. These are Jatre people. There will be one kind of people, again, as I use always in class, showy people. Right? Show off people. They want to show off. How they will show off, sir? While making allotment money only, they pay the first call money. Or while we made a call for first call, they paid for second call also. Showing off. Getting it? Shoki we call it in Kannada. Huh? So first at the stage of allotment only, they might pay the other call. Or first call only, they will pay the next call. Which means before we making a call itself, they are paying it. So now that extra money what we received, that shall be parked in a special account called calls in advance account. That shall be parked in a special account called calls in advance account. And of course, in future we have to set it off when we make a call now. When we make a call for money, they already paid. We can't ask them again. Whatever they already paid, with that we have to adjust now. So right now we have a liability towards it. So we are going to treat it as a other current liability. We are going to treat it as a other current liability. Other current liability. Done? Yes, sir. So when you receive, entry will be bank account debit to calls in advance account, and when you adjust, calls in advance will be debited, respective call will be credited. Calls in advance will be adjusted, debited, respective calls will be credited. That is calls in advance. Calls in arrears means you called, please pay, please pay. They are Jatre people, they are not paying. They are broke already. Calls in advance is shoky people. You tell, boss, now don't want, but they are paying you already. Now, sir, if they pay us already, are we required to give them anything? Yes, you should give a 12% discount per annum. Sorry, 12% interest per annum. Is it, sir? Is it? Yes. From which date to which date, sir? From the date of they making a advance. From the date of they making a advance till the particular call become due. Till then, you should pay them interest. If you understood, great. No, when you see the question, you will understand. Sir, this is cheating, sir. This is cheating. When they pay in advance, we have to pay interest. When we call and they don't pay, that time no interest. No. That left to the company. That left to the management of the company. If you want to collect interest regarding calls in arrears, you can collect at 10% per annum. You can collect at 10% per annum, but it is left to company. Okay, sir, while paying also left to company, whether if you want to pay, we can pay, otherwise no. The answer is no. That is compulsory. Interest on calls in advance is compulsory. Interest on calls in arrears left to the management of the company. If they want to receive, they can receive. If they don't want to receive, they can leave it. Okay. Because one is income, one is expense. Sir. Till when, sir? Or how many, like 10% and 12%? What is our expense? 12%. What is our income? 10%. Period is what, sir? From the date of last date for the payment, due date for the payment, till they make a payment, you are going to collect interest. You are going to collect interest. Now, when we see the few questions, you will understand in a better way. Okay, we'll see that now. Concentrate on this question. The Delhi Artware Limited issued 50,000 equity shares of rupees 100 each. How many shares equity shares, sir? 50,000. 1 lakh preference shares of rupees 100 each. The share capital of the company was collected as under: equity on application 25 rupees, allotment 20, 45, first call 30, 75 and 2500. Basically, it is issued at a par. Preference 20, 30, 50, 20, 30, 50, 100. So both are issued at par. All the shares were subscribed. Great. How much they issued? 50,000 and 1 lakh? No. Everything is subscribed. Final call was received on 42,000 equity shares and 88,000 preference shares. But final call is there, no? That is just received on just 42,000 and 88,000, which means 8,000 equity shareholders didn't pay call money, final call money, and 12,000 preference shareholders didn't pay final call money. Prepare the cash book and journalize the remaining transaction in the books of the company. Okay. Now, see, prepare the cash book. So, cash transactions will come in cash book. Other than cash transactions will come in journal. Okay. Now, listen here very carefully. First, we'll receive equity share application and preference share application. Correct? So, what will be the entry, sir? Bank account debit, which means cash account is getting affected. Bank account debit to to equity share application account to preference share application account. How much, sir? 25 into 50,000, 1 lakh into 20. See here, equity share application account 12 lakh 50,000, preference share application account 20 lakh. After that, what you are going to do, sir? After that, you are going to allot a shares. You are going to allot a shares. What will be the entry, sir? Application money shall be transferred to share capital. Entry is share application account debit to share capital account. Moral of the story is nothing, sir. No cash transactions are involved. So cash book is not getting affected. Then what is getting affected, sir? Your journal. Equity share application account debit to equity share capital account. Preference share application account debit to preference share capital. On next is what, sir? Next, on allotment, you are making a call for 20 and 30. First is due entry. No entry in cash book, because entry is equity share allotment account debit to equity share capital account, preference share allotment account debit to preference share capital account. So see here, equity share allotment account debit to equity share capital, preference share allotment account debit to preference share capital. Done. Next, what you are going to do, sir? You are going to receive that allotment money. Entry is bank account debit to equity share allotment to preference share allotment, as you are receiving in full. Bank account debit to equity share allotment to preference share allotment. Done. Next, you are going to make the first call. Again, due entry, no entry in the cash book. Entry will be equity share first call account debit to equity share capital, preference share first call account debit to preference share capital. Equity share first call account debit to equity share capital, preference share first call account debit to preference share capital. Done. Later, sir, later you are going to receive that. Are you receiving in full? The answer is yes. Entry will be bank account debit to equity share first call account to preference share first call account. Equity share first call account, preference share first call account. Done. Next, what you are going to do, sir? Next, you are going to make the final call, due entry. So equity share second and final call account debit to equity share capital, preference share second and final call account debit to preference share capital. Equity share second and final to equity share capital, preference share second and final to preference share capital. Correct. Now you are going to receive the money. Are you going to receive full money, sir? The answer is no. You are going to receive 42,000 into 25, 42,000 into 25 and 88,000 into 30. Preference share second and final call, 48,000 into 42,000 into 25 and 88,000 into 30 to preference share second and final call. That's it. One of the simple question, but they have asked it in the examination. Okay, once they have asked it in the examination. In this chapter, all the questions are simple only. Sixth one is nice question. Sixth one is really nice question and last minute revision question. Before going to examination, you should solve it and go on. It's very important, in the sense very important. This might come to exam this time only. You never know. Okay. If at all it comes, thank me later. Okay. Yes. See here, JHP Limited is a company with an authorized share capital of 10 lakh. We have nothing to do with the authorized share capital. Okay. Rupees 10 each, which means we have around 1 lakh shares. Correct. We have around 1 lakh shares. Basically, it is not rupees. Okay. Just make a changes. We have around 10 lakh equity shares of rupees 10 each, which means around 1 crore rupees is the authorized share capital in amount. Done. Of which 6 lakh shares had been issued already, paid fully, which means moral of the story, out of 10 lakh rupees, 6 lakh rupees is done. Which means out of the authorized share capital of 10 lakh, 6 lakh has been issued already, subscribed already, paid up already. You have nothing to do with that. The company proposed to make further issue of 1 lakh of these shares at rupees 14 each. So now company is planning to issue 1 lakh more shares out of remaining 4 lakh. 1 lakh more they are planning to issue at the premium of rupees 4, which is at the price of rupees 14. So arrangement is as follows. What are those, sir? 2 per share is payable on application, which shall be received by 1st July. Great, sir. So we are going to receive 2 rupees per application. Allotment to be made on rupees 10 and further 5 rupees, that is including premium, is payable. So allotment stage 5 rupees we are going to receive, including premium of 4 rupees, which means at allotment stage 1 rupee is capital, 4 rupees premium. 1 rupee is capital, 4 rupees is premium. Done, sir. Next, the final call for the balance to be made and money received by 30th April. So final call for the balance will be made on so and so, and money received on so and so. So basically, how much is the final call money, sir? Application 2 rupees, allotment 5 rupees, 7 rupees, which means final call is also 7 rupees, because 14 rupees is the issue price now. Yes. Applications were received for 355,000 shares. Try to understand. You issued 1 lakh shares, but you are getting how many applications? 355,000 applications. Yes, sir. How you are going to deal with it? 1. Applicants for 5,000 shares are received allotment in full. These are like daughter and son of father-in-law, mother-in-law. Full, close. So directors are giving them full allotment. Boss, take and go. 5,000 is for you. How much you applied for? 5,000. Take and go 5,000. Which means now out of 355,000, 5,000 share applicants got 5,000 shares, which means you should give 95,000 shares to the remaining 350,000 shareholders. How it will be dealt further, sir? 2. Applicants for 30,000 shares received an allotment for 1 share for every 2 share applied. So try to understand what they are doing. If you for the next 30,000 applicants out of 350, next 30,000 applicants getting 2 shares for every 1 share applied, which means they will be allotted with 15,000 shares. Now, how many applicants left? 3,20,000. How many shares to be issued? 80,000, because 15 plus 5 gone. Done. And also they are telling the surplus on application being used to reduce the amount due on allotment. So application surplus is there now relating to these parties that will be used to reduce the allotment due. Correct? Okay. Next, applicants for 320,000 received an allotment for 1 share for every 4 applied. So 320 divided by 4, around 80,000, it will be proper. Correct? And also the money due on allotment was retained by the company and excess being returned to the applicants. Great, sir. The money due on final call was received on due date. So here money due, all those drama is not there. Here how you are going to do the parota allotment, return of money, all these question. Okay, just listen here. Rupees 14, in the 2 rupees is application, 5 rupees is allotment, 7 rupees is call. In the allotment, 4 rupees is securities premium, 1 rupee is face value. In the allotment, 4 rupees is securities premium, 1 rupee is face value. Done. We received 3,55,000 applications. In that, we are going to divide it into 3 parts. 5,000 applications, 30,000 applications, 320,000 application. 5,000 application getting allotment in 1:1. That is, you are getting allotted 1 share for every 1 share applied for, and remaining 30,000 share applicants getting 1 share for every 2 shares applied, and other 320,000 share applicants are getting 1 share for every 4 shares they have applied. Okay, done, sir. So allotment is how much, sir? For the first case, 5,000 is allotment. Second case, 15,000 is allotment. Third case, 80,000 is allotment. Application money received is how much, sir? 5,000 applications they have applied, 2 rupees they paid, 10,000 rupees. And how much shall be adjusted? How much shall be adjusted towards the application of allotment? Whole 5,000 is allotted. So application money relating to allotted shares is 5,000 shares into rupees 2, which will come to 10,000. Is there any excess application money, sir? Nothing. So allotment time, how much will be the due? 5,000 into rupees 5, which will come to 25,000. Is there any money left to adjust to the allotment, sir? No. Great. Going to the second case, where how much application money they paid, sir? 30,000 application, 2 rupees each, which will come to 60,000. Done. In that, they will be allotted in the ratio of 1:2. That is 1 share for every 2 shares applied. So if they have applied 30,000, they are going to receive 15,000 shares. How much is share application amount relating to this 15,000 shares, sir? 15,000 into 2, which will come to 30,000. So excess application money is, sir, 30,000 rupees. Correct? 60,000 received. In that, relating to allotted shares is 30,000. That will straight away go to share capital account. Remaining 30,000, sir, what they are telling in question, that will be adjusted towards the due amount of the allotment. So how much is the due amount in the allotment? Come on, 15,000 into 5. 15,000 shares, 5 rupees is allotment money to be received. 15,000 into 5, 75,000. And how much money to be adjusted to the allotment, sir? How much money is left to adjust? 30,000 will be adjusted, which means there is nothing left to refund and all. Allotment stage, instead of collecting 75,000, you are going to collect 45,000, because 30,000 you are going to adjust the excess application money. Done, sir. What about third case? 320,000, 1:4. So how much application received? Application received is 320,000. How much is application money received? 320,000 into rupees 2 comes to 6,40,000. Yes. How many shares allotted? 80,000. So out of 320,000 application, how many shares got allotted? 80,000. So how much is application money relating to 80,000, sir? 80,000 into 2, which will come to 1,60,000. 1,60,000. Now 1,60,000 is done, sir. Yes. Now how you are going to adjust this 1,60,000, sir? Try to understand. Out of 640, 1,60,000 shall be adjusted towards share capital relating to application. Remaining 480,000. First, how much is the money due on allotment for them? 80,000 into 5 rupees, 4 lakh. So whole 4,80,000 we are going to apply on that allotment. Still 80,000 excess is there. If the question was silent, we would have used it on a call account. But here the question, they are particularly telling that, boss, use it or refund it. Don't use it, refund it. If any extra amount is there after allotment, refund it. Sir, I got one idea. What is it? That 80,000 extra is there, no? That you adjust towards second party, no? This 80,000 extra, whatever is there, adjust to this guy, no? 75,000. Remaining 5,000 you can refund, no, sir? Fair enough. Array, who are these parties? How they are related? Are you going to give your money to some stranger? No. Then why these guys will give to this guy to adjust? So you should see it at a separate point of view. Got it? So in the third case, how much to be refunded, sir? 80,000. How much to be refunded? 80,000. See here, journal entries. We received application, bank account debit to share application, 3,55,000 into 2, which will come to 7,10,000. Later, we made a allotment. When we made a allotment, whole 7,10,000, in that, only 1 lakh shares got issued, correct? So 1 lakh into rupees 2. This is relating to share application relating to allotted number of shares. This 2 lakh will go to share capital. Okay. And if you see here, out of second person, out of the second class of shareholders, the 30,000 excess was there, that got adjusted to allotment, correct? That got adjusted to allotment. In this case, 4 lakh got adjusted to allotment. So 430,000 will be treated or transferred to share allotment account. To share allotment account, 430,000. First one not getting any refund. Second one not getting any refund. Third one is getting refund of 80. So to bank 80,000. To bank 80,000. This is one of the important journal entry. Done. Next, you are going to make a due entry for the allotment. That is share allotment account debit. How much, sir? 1 lakh into rupees 5. To share securities premium account. How much, sir? 1 lakh into 4. 4 lakh. To share capital, 1 lakh into 1 lakh. Okay. You are going to receive allotment money. How much you are going to receive, sir? First persons you are going to receive in full. That is 5,000 into rupees 5, which will come to 25,000. Second one, you should receive 75,000, but you already adjusted 30,000, which means you are going to receive 45,000. Third person, you adjusted allotment, still money left, so you refunded. So allotment stage, you are not going to receive any amount. So how much you are going to receive, sir? Total 70,000. First person 25, second person 45, total comes to 70,000. That is bank account debit to share allotment. Then you are going to make a final call. That is share final call account debit 1 lakh into rupees 7 to share capital. Bank account debit to share final call. Everyone is paying. So that's the entry. One of the important question. Please keep in mind. Hope you guys understood this. Next, Rashmi Limited issued at par 1 lakh equity shares of rupees 10 each, payable 2.5 on application, 3 on allotment, 2 on first call and balance on final call. How much is it, sir? 2.5 plus 3, 5.5 plus 2, 7.5. Balance is final call, which is 2.5. All the shares were fully subscribed. Great. Mr. Nair, who held 10,000 shares, paid full remaining amount on first call itself. So Nair is what kind of person? Shoky person. Why, sir? Because he is paying his second call also at the time of first call itself. He is paying second call also at the time of first call itself. Done. Next, the final call which was made after 3 months from first call was fully paid except shareholders having 1,000 shares who paid his due amount after 2 months along with the interest on arrears. So there are 1,000 shareholders who are the person who is holding 1,000 shares. So they are not paying immediately the payment towards second call. Instead, they are paying it after 2 months, which means along with calls in arrears interest. Okay. So give the journal entry. First, you are going to receive. See, till first call money due, no problem at all. After that, Nair will start acting weird. After him, one more person starts acting weird. Let's see. Now, you are going to receive a application, sir. Yes, sir. Bank account debit to share application account 1 lakh into 2.5. That share application account shall be transferred to share capital. That is share application account debit to share capital account. Done, sir. Next, what you are going to do? Next, you are going to make a allotment. Share allotment account debit. Share allotment account debit to share capital account 1 lakh into rupees 3 lakh. Next, you are going to receive allotment money. Bank account debit to share allotment account 3 lakh. Wow. Done. Next, you are going to make a first call due. What will be the entry? Share first call account debit to share capital account. How much, sir? 2 rupees into 1 lakh. 2 lakh. Now, how much you are going to receive, sir? How much you are going to receive, sir? This first call money to you are going to receive. First call money of rupees 2 lakh you are receiving. No doubt in that. Along with that, there is one person who is Mr. Nair. He is paying second call money also. That is 10,000 into rupees 2.5. So you are receiving 225,000. You are receiving 225,000. Whereas 2 lakh was towards share first call. Other 25,000 is calls in advance. Calls in advance. Okay. Done, sir. So listen here. Bank account debit 2,25,000 to share first call 2 lakh to calls in advance 25,000. Done, sir. Next, what you did, sir? The final call was made after 3 months from the first call. So final call you are making after 3 months from the first call means to Nair, how many months interest you should give, sir? 3 months interest you should give. 3 months interest you should give. Okay, done. So make a second call entry, share second and final call account debit around 2,50,000 rupees to share capital account. Share second and final call account debit to share capital account. Now you have to receive, no? You have to pass the receipt entry, no? But remember one thing, already calls in advance is there, correct? Already calls in advance is there. So listen here very carefully. How much you are going to receive? 90,000 shareholders and 10,000 shareholder. In this 90,000, I am further going to divide it into 89,000. That is people who are not giving us any pain, papa. And 1,000 people, jatre. 10,000 shoki, correct? How much is final call money relating to all these three? First one, rupees 25,000, correct? Next one, sorry, first one is 2,500. First one is 1000 into 2.5, 2,500. Next one is 25,000. So out of 250, so it is 222,500. Correct? 89,000 into 2.5, 222,500. Done. Now, this you are going to receive in bank because these people are paying on time, papa. This you already received and kept it in the calls in advance. So calls in advance was showing in your liability. Now you are going to make it debit. Done. Because last time you credited bank to calls in arrears 25,000. Correct? Yes. You are going to debit it. Remaining, this will be transferred to calls in arrears account. See here. Bank account debit 222,500. Calls in advance account debit 25,000. Calls in arrears account debit 2,500 to share first and final call. Then you are going to make the payment of calls in advance to Mr. Nair. How much it will be, sir? For 3 months you are going to make a payment of interest. How much it will be? So he paid extra how much? Only extra. He paid extra of 1,000 into 2.5, 25,000. So 25,000 into 12% no advance into 3 by 12. 3 by 12. Okay, calls in arrears, how much interest we should collect, sir? After 2 months they are paying, so 2 months interest. That is calls in arrears is just 2,500 into 10% into 2 by 12. So interest on calls in advance account debit to bank account. Then Nair thing is done. First we should make a due from the shareholder. So the entry will be shareholders account debit to interest on calls in arrears 41.67. Then they are going to pay you 2,500 due amount plus 41.67 towards interest. So bank account debit 2541.67 to calls in arrears 2,500 to shareholders 41.67. Peace. Simple. Here interest calculation to be kept in mind. Done, sir. This is one more important question which is there in your study material, ICSI study material. Okay. Yes. Arjun & Co. Limited issued a prospectus offering 2 lakh shares. Offering how many shares, sir? 2 lakh shares of rupees 10 each in the following way. Application 1 rupees, allotment 3 rupees. Out of 3 rupees, 2 rupees a premium, 1 rupee is a face value. First call, that is after 3 months from the allotment, 4 rupees. Second call, 3 months after first call, 4 rupees. Okay. Now what is the meaning of this, sir? Why it could be? Try to understand. If anyone paid their first call and second call money at the allotment stage itself, their first call money, second call money at the allotment stage itself, whatever the amount they paid towards first call money, that will fetch them 3 months interest. That is from the date of allotment till the first call. If anyone paid or if anyone paid first and second call money also, then their first call money will fetch them 3 months. Second call money will fetch them 6 months interest. So while calculating interest, be very careful. For the first call money, 3 months interest. For the second call money, 3 plus 3, 6 months interest. Subscription were received for 317,000 shares on 3rd April and allotment was made on 30th April as under. So subscription received how much, sir? 317. Allotment made is as under. So they issued how much? 2 lakh. Subscription received 317. How they dealt with the subscription? Shares allotted. Try to understand. In the previous question, the point was applied. They gave. Then we found out how much is allotted. Now, in this question, they are giving information about allotment. Using that, we should find out how much is applied. First one, allotment in full. So, for these people, allotment in full, that is, 2 applicants paid in full on allotment in respect of 4,000 shares each. Okay, 4,000 shares each. That is, 2 applicants are getting full allotment. How much? Sorry, applicant getting full allotment is 38,000. Applicants getting full allotment is 38,000. Whereas out of this 38,000, 30,000 are normal people. 8,000 is shocky people. Why shocky, sir? At the stage of allotment only, 2 people. At the stage of allotment only, they paid all the full money. That is first call money and second call money. Okay, done. Next. Allotment of 2/3 of shares applied for 160,000. Allotment of 2/3 of share applied for 160,000. So whoever applied for 240,000 shares got allotted with 160. That is 2/3. So if you reverse it, you will get how much it is. Okay. Next, allotment of 1/4 share applied for is 2,000. So whoever applied for 8,000 shares are getting 2,000 allotment. Cash amounting to rupees 31,000 being application money received with applicants from 31,000 upon which no allotment were made was returned to the applicants on 5th May. So remaining 31,000 shareholders are there. For them we are refunding the money. Okay. The amount due were received on due date with the exception of the final call on 100 shares. All the money was received on due date except one final call on 100 shares. These shares were forfeited on 15th November and reissued to IN on 16th November for payment of rupees 9. So that reissued portion let it be. I will explain before that. 12 rupees is a share price. In that 1 rupee is application, 3 rupees allotment, 4 rupees first call, 4 rupees second call. In this allotment, 2 rupees securities premium, 1 rupee is face value. 12,1344. Done. Now, 3,17,000 application received. How, sir? 31,000 got rejected. Other 38,000 got accepted full. Other 2,40,000 applicants got 1,60,000 allotment. Other 8,000 applicants got 2,000 allotment. Together it is 31 plus 38 plus 240 plus 8. Then application money. 38,000 into rupees 1. 38,000. Second one, they applied for 240,000, so they paid 240,000. Third one, they applied for 8,000, they paid us 8,000. Application money relating to allotted share. For the first one, we are allotting in full, so whole 38,000. Second one, we are allotting 160,000, so 160,000. Third one, we are allotting 2,000, so 2,000. Now, excess application money. First one, nothing is there because fully allotted. Second one, 80,000 is excess. Third one, 6,000 is excess. Allotment money due. In first one, complete allotment money is due only because nothing got adjusted. Correct? 38,000 into 3, 114,000. Second one, 160,000 into 3, 4,80,000. Third one, 2,000 into 3, 6,000. Application money adjusted to allotment. That is this line. Nil 1,80,000, sorry 80,000 because you got 240, but we adjusted only 160 towards application. Next one is 6,000. Refund to no one you are refunding. All money received, allotment money received in cash. First one complete will be received in cash. Second one, out of 480,000, 80,000 is already received, so 4 lakh will be received. Third one, nothing to be received. Got it? First, bank account debit to share application for 317. Out of this share application, account, 31,000 will be refunded. 31,000 will be refunded. That is share application account debit to bank account. Remaining 286,000 will be adjusted this way towards share capital 2 lakh, towards share allotment 86,000. First one is nothing. Second one 80,000 is excess, so that will go. Third one 6,000 is excess, that will go. Done. Later, sir. Later you are going to make a allotment due entry. That is share allotment account debit 6 lakh to share capital 2 lakh. That is 1 lakh into rupees 2 lakh. Share securities premium is 2 lakh into rupees 1 2 lakh. 2 lakh into rupees 2 is securities premium, which is 4 lakh. Share application account debit to bank account, that entry is done. Next, you are going to receive allotment money. First person should pay full, who is getting 38,000 allotment. So 38,000 into rupees 3 should be received in full, which will come to 114,000. Second person, out of 480,000, 80,000 excess got adjusted in the application, so other 4 lakh to be received. Correct? Third person, if you see here, not paying any money. Third person who is getting 2,000 allotment, not paying any money because excess 6,000 is already there. Correct? In that it will get adjusted. That is 2,000 into rupees 3, which is 6,000, that will get adjusted over there. Done, sir. Then at the application allotment stage only, there are two people who are holding 4,000 shares. They are making payment in full. So they are making first call money, second call money, allotment money rupees 8. So 2 share allotment, 2 calls in advance. Calls in advance is 8,000 into rupees 8. Then you are going to make a call. Share first call account debit to share capital account 8 lakh. Then bank account debit, calls in advance account debit, share first call, second call, all these things. Interest calculation you have to look. That's it. First, for the first 32,000, that is relating to 8,000 into first call money. How much is first call money? Come on. How much is first call money? First call money is 4 rupees. Second call money is 4 rupees. No. So 8 rupees into first call money. 8 into rupees 4. 32,000. For this 32,000, it is 6 months interest. 3 months interest. Second call money, that is again 8,000 into rupees 4 again. 32,000. For that again it is 3 more months interest. 6 months in total. Okay. Then this forfeiture I am going to tell later. Okay. Forfeiture, that entry I am going to tell you guys. With that, the basic issue thing is done. So now we are going towards share forfeiture. Okay. Sir, what do you mean by forfeiture? Forfeiture means cancellation. Sir, here what do you mean by forfeiture? Sir, forfeiture of shares means, people, you are going to cancel the shares. You are going to cancel the membership, going to cancel the shareholders name from your shareholders list due to non-payment of the called up portion. You ask them to pay, they didn't pay. So what you did? You cancelled their name. The process is called as forfeiture. Okay. And one important point you have to remember is, okay sir, you forfeited. For example, due to the non-payment of last call, you forfeited. So will you pay back our application money, allotment money, first call money? The answer is no. So one thing you have to remember is, people, when the shares are forfeited, paid up money will not be returned to the shareholders. Paid up money won't be returned to the shareholders. And paid up portion of the forfeited shares shall be transferred to the account called share forfeiture account. Whatever is there in the share capital, no, to the extent of paid up. I repeat, whatever is there in the share capital to the extent of paid up portion, that shall be transferred to the share forfeiture account. Share forfeiture account. Okay. Journal entries will come two types, sir. One, when the shares are issued at par. The other one is when the shares are issued at premium. When the shares are issued at par, when the shares are issued at premium. First, let's discuss when the shares are issued at par. Try to understand. Share capital, whenever the due entry came, that is allotment due, first call due, second call due, we kept on crediting it. Correct? We kept on crediting it, and allotment, first call, second call, we used to debit based on the receipt of money. So these things used to get credited based on the payment, whereas share capital account used to get credited based on the called up portion, because even due entry we used to credit our share capital, if you remember, which means share capital used to get credited irrespective of they paying, not paying, irrespective of shareholders paying, not paying, which means it used to get credited with called up portion. But now what you are going to do, sir, you are going to debit it with the called up portion, because you are cancelling. No, cancelling means share capital decrease means you should debit it. So debit with what, sir? Whatever you credited. How much you credited? You credited called up portion. So share capital account will be debited with called up portion to share forfeiture account. How much, sir? How much is paid up? That one paid up face value will be debited. Remaining things, if you see, before forfeiture, let's say what we have done, share first call account 100 to share capital 100, later bank to share first call 90, which means 10 rupees is not received, right? So this which will be having which balance, sir? It will be having debit balance, because debit is 100, credit is 90, it has a debit balance. You are going to write off this, right? So what you are going to do, you are going to credit it. You are going to credit respective call account. You are going to credit respective call account. So what will be the entry? Share capital account debit to share forfeiture account to share respective call account. If at all the respective call is already transferred to the calls in arrears, then respective call won't be having any balance. Correct? To take off the balance only, we transferred it to calls in arrears. So you are going to instead of respective account, you are going to credit calls in arrears account. Okay. What if it is issued at a premium, sir? If it is issued at a premium, what you have to check is whether premium money is received. Premium money is not received. Premium money is not received. Let's say, example, application money 2 rupees, allotment money 5 rupees, call money 5 rupees. Application money 5 rupees, allotment money 5 rupees, application 2, allotment 5, call 5 for a 10 rupees share. Now, how much is called up, sir? Whole 10 rupees is called up. Share capital, face value. Correct? Because face value. So, share capital I am going to debit. Share forfeiture. How much you have received, sir? You have received 7 rupees. So, are you going to transfer whole 7 rupees to the forfeiture account? The answer is no. Which means, if at all you received premium already, then don't reverse your securities premium account. If at all you received the premium money, don't reverse your securities premium account. Let it be there. Which means, treat it just like it is issued at par. So share forfeiture also will be 5 only. To share respective call or to share calls in arrears will be 5 rupees, which is not received. Let's say premium money is not received. Then then reverse the share for securities premium account because it is not backed by any money. So try to understand, if the securities premium is received already, then don't reverse it, just treat it like issued at par. If the securities premium is not at received, then reverse it. When you have credited, debit it. See, so share capital account rupees 10 called up portion, securities premium account 2 rupees unpaid portion, 2 share forfeiture, that is only application money is received, these two things are not received, so 10 rupees will be treated as not received. 10 rupees shall be treated as not received. Excess money of application. See, sir, one doubt, sir. What if excess money of application is there? We adjusted towards allotment. Whole amount of allotment is not. For example, 2 rupees is excess money available. Allotment 3 rupees is there. Allotment 3 rupees is there. Whereas face value is rupees 2, sir. 1 rupees securities premium, sir. Now, this 2 rupees, whether you are going to adjust to securities premium and face value or face value and securities premium, always remember, first it shall be adjusted towards face value. This 2 rupees, if excess is there, then towards the allotment. Excess is there, then towards allotment. See there, excess money of application first should be adjusted towards the face value, and if any excess is there, then towards the securities premium. Okay. Sir, what you are going to do with those shares, sir? What you are going to do with those shares which you forfeited? You can reissue. You can reissue based on the director's decision, and the restriction on issuing a shares at discount is there only on issue, not on reissue. Moral of the story, you can reissue the shares at discount. So reissue can happen at par, reissue can happen at premium, reissue can happen at discount. However, one point you should keep in mind, that is when the reissue is happening at discount, you should make sure that discount amount will not exceed forfeited amount. For example, one share 6 rupees is paid up, other 4 rupees is called up but not paid, so we forfeited. So in the forfeiture account, how much is there? 6 rupees is there. Now, when you are reissuing that share, you can't give a discount of over and above 6 rupees. Up to 6 rupees you can give discount, not over and above. Okay. Now, when it is issued at a par, what would be the entry, sir? Bank account debit to share capital account. When it is issued at a premium, what will be the entry, sir? Bank account debit to share capital account to securities premium. When it is issued at discount, bank account debit, discount account debit to share capital. However, discount we are going to write off against securities premium, share forfeiture. So instead of discount, you can use the term share forfeiture. Okay. One more thing, very important. To the extent of shares reissued, I repeat, only to the extent of share reissued. For example, 1000 shares were forfeited. In that, 800 is reissued, 200 is not reissued. 200 is not reissued. Try to understand, whatever share forfeiture account will be there, no, only relating to this 800. Only relating to this 800, whatever the share forfeiture amount is there, after adjustment of the discount, if any, shall be transferred to capital reserve. Only and only reissued share portion. Not whole 1000. Not whole 1000. Only to reissued share portion, it shall be transferred to capital reserve. Okay. So to the extent of shares reissued, balance in share forfeiture account after adjustment of discount, if any, shall be transferred to capital reserve. Only to the extent of reissued shares, reissued share. Sir, what about this not reissued share, sir? That will be there in the share forfeiture account only. That shall be there in the share forfeiture account only. Hope it is clear. We'll see few questions. With that, share issue concept will get over, because anything extra is not there. Everything is covered in this. Okay. Yes. So, A Limited forfeited 30,000 equity shares. How many shares they are forfeiting, sir? 30,000 equity shares of rupees 10 fully called up, held by Mr. X for non-payment of final call money of rupees 4 each. So the face value was 10 rupees. and rupees 4 of the final call is not paid, which means rupees 6 is already paid. However, he paid application money of 2 rupees, allotment money of 4 rupees. These shares were originally issued at par. Give the journal entry. Very simple. Share capital account to the extent of called up portion, because it got credited with the called up. Now you have to debit with the called up portion. Okay. Share capital account debit. Face value is 10 rupees called up. How much face value or called up face value? Called up face value is 10 rupees. So 30,000 into 10, which will come to 3 lakh. 2. Share forfeiture. How much, sir? How much, sir? How much ever we have received? How much ever we have received other than premium. How much ever we have received other than premium. Because if premium is received, just treat it like issued at par. Correct? No reversal. So 6 rupees. 6 into 30,000, 180,000. To share final call account, 4 into 30,000, 120,000. If at all calls in arrears is opened, then the entry will be equity share capital account debit 3 lakh, to share forfeiture 180, to calls in arrears 120. Done. Next one. X Limited forfeited 20,000 equity shares of rupees 10 each. Only 8 rupees is called up. So share capital should be debited by how much, sir? 8 rupees, not 10 rupees, because it got credited with called up portion. No, not full portion. It got credited with called up portion. Now debit with called up portion. For non-payment of first call money of rupees 2, application money of 2, allotment money of 4 have been already received. So share capital account debit 8 into 20,000, 160,000. To share forfeiture account 2 plus 4, 6. 6 into 20,000, 120,000. To calls in arrears account, because assume that all money is transferred to calls in arrears. To calls in arrears account debit. If at all calls in arrears, it is not transferred to calls in arrears, then first call. Correct? So to calls in arrears account debit 20,000 into rupees 2, 40,000. Look at the next one. X Limited forfeited 5,000 equity shares of rupees 100 each, fully called up. It is fully called up, which was issued at a premium of 20%. Okay. Amount payable on share were application 20, allotment including premium 50, first and final call 50. Only application money was paid by the shareholder. Moral of the story, securities premium is not received. If the security premium is not backed by the money, then cancel it. How to cancel it, sir? Earlier you credited it, now debit it. Earlier you credited it, now debit it. How much, sir? 5,000 into fully called up. So 5,000 into 100 comes to 5 lakh. So equity share capital account 5 lakh. To securities premium you have to debit because it is not backed by the money. How much, sir? 5,000 into rupees 20, which will come to 1 lakh. To share forfeiture account, how much, sir? How much you received? Just 20 rupees on application you received? No. So 20 into 5,000, 1 lakh. To share allotment account, 50 rupees you debited. Now you credit 50 rupees per share. 50 into 5,000, 2,50,000. To share first and final call, again 2,50,000. Simple. See here. This is one nice question. Mr. Shami has applied for 1,000 shares of company XYZ Limited, paying application money of rupees 2 per share, but has been allotted only 600 shares. Okay. So he applied for 1,000 shares, he got allotment of 600, which means 400 shares were excess. The shares have a face value of rupees 10, premium of 2 per share, which was payable, allotment 5 rupees including premium. So in allotment money, 3 rupees is towards face value, 2 rupees is towards premium. Now in case Mr. Shami doesn't pay allotment money and final call and the shares are held forfeited, the following entry shall be passed. Try to understand. If Shami doesn't pay the allotment money, and final call money, then what happens, sir? Try to understand. Application money, how much is received, sir? 1,000 shares he applied at the rate of 2 rupees, 2,000. How much is allotted? 600. Relating to that, how much is application money? 600 into 2, 1200. How much is excess application money, sir? Excess application money is 800. Now, this 800 shall be adjusted towards allotment. Adjusted towards allotment. So what, sir? Nothing. In allotment, face value is also there. Securities premium also there. First priority towards what, sir? Face value. So try to understand. 600 into 3 is face value, 600 into 2 is security premium, 1800 and 1200. Now 800 excess first shall be adjusted towards face value. So how much is the due amount of face value? 1000. Due amount of securities premium 1200. Now, is this the question of securities premium received? The answer is no. It is not received, which means treat it or reverse the securities premium. Reverse the securities premium. Share capital account debit with the called up face value, which is 600 shares into rupees 10, which will come to 6000. Securities premium account whole 1200, 600 into 2, 1200. 2 share forfeiture. How much, sir? 600 shares. Application money of 2 is received plus allotment money of 800, which got adjusted. That is also received only, no? So we received 2000 that we are keeping with ourselves. To share allotment, sir, 1000 rupee face value is not received plus 800 securities, 1200 securities premium, 1000 rupees face value, total 2200 is not received. Out of the 2000, 3000 receivable, in the 2200 is not received, so credit it. Share final call, nothing has been received. 600 into 5, 3000. Okay, listen here. Mr. Long, who was the holder of 2000 preference shares of rupees 100 each, on which 75 per share has been called up, could not pay his dues on allotment and first call money each of rupees 25. So try to understand. 75 rupees is called up. In that, first call is rupees 25. Allotment is rupees 25. Moral of the story, application money is also 25. Correct? Yes, sir. The directors forfeited the above shares and reissued 1500. Everything is not reissued. Only 1500 shares of reissued to the short at rupees 65, where paid up is 75, which means they are giving a discount of 10 per share. They are issuing it as a 75 rupees share at 65 rupees. Try to understand. First called up portion is whole 75 rupees. Correct? 2000 into 75, 150. So preference share capital debit 150. 2 share forfeiture, he paid 25 rupees per share for 2000 shares, which will come to 50,000. Yes. Allotment money he didn't pay, so whole 50,000 is not paid. First call money he didn't pay, 50,000 is not paid. Now you are reissuing. Only 1500 shares. Correct? 1500 into 65 is received, 97,500, and 1500 shares into rupees 10 is given discount, which is 15,000, to preference share capital account 1,12,500. To preference share capital account 1,12,500. Done, sir. Now try to understand how much is the share forfeiture relating to 1500 shares? Rupees 25. How much is discount? Discount is rupees 10, which means 1500 into rupees 15 shall be transferred to capital reserve. 1500 into 15 shall be transferred to capital reserve. See here, 2000 divided into 1500 and 500. Share forfeiture relating to this is 1500 into 25, 37,500. 500 into 25, 12,500. This will be left in the share forfeiture only. But out of this 37,500, 15,000 discount will be adjusted. Remaining 22,000 shall be transferred to capital reserve. So entry will be share forfeiture account debit 22,500 to capital reserve 22,500. Listen, there are 2-3 more questions are there. Quickly we'll look into that and we'll wind up. Beautiful Company Limited issued 30,000 equity shares of rupees 10 each, payable rupees 3 on application, 5 on allotment, including 2 rupees premium, 4 on call. All shares were subscribed. Great. Money due on all shares were fully received except from Ram, holding 500 shares, who failed to pay the allotment and call money, and Sham holding 1000, who failed to pay call money. So try to understand. Relating to Ram, allotment money is not paid, call money is not paid, which means security premium is not received. You should reverse it. In case of Sham, only call money is not paid, which means allotment money he had paid. Allotment money he had paid means securities premium is received in cash. So don't reverse securities premium. Treat it as forfeited at par. Okay. Great. Money due on all received. Okay. Sham 1000 who failed to pay the call money. All these 1500 shares were forfeited. Great. Of the share forfeited, 1250 including whole Ram share. So were subsequently reissued at a discount of 2 rupees. So what is happening, sir? 1500 is there, that is reissued. 1500, is it reissued? No, only 1250 is reissued, 250 is not reissued. Okay, this 1250, which is of Ram, which is of Sham. They are telling Ram's whole share. How much shares Ram held? Ram held 500 shares, which means 750 remaining is of Sham. 750 remaining is of Sham. Pass the necessary journal entry to record the forfeiture. Try to understand. Share capital account 1500 fully called up, so 15,000. Securities premium only and only relating to Ram share, because that is not received. Sham's securities premium is received. No need to reverse it. Okay, no need to reverse it. So share forfeiture, I mean only securities premium 500 into 2000. Share forfeiture, people. How much you have received? Relating to Ram, you received only application money 500 into rupees 3, which will come to 1500. Relating to Sham, sir, 1000 shares, 3 rupees application you have received, plus I told you you are not going to reverse securities premium portion, only and only face value portion you are going to reverse, that is 6 rupees. 1000 into 6. Share allotment, Ram didn't pay, so 500 into 5, 2500. Share call, Ram and Sham both didn't pay, 1500 into 4, 6000. Later it has been reissued. Bank account debit 10,000. Share forfeiture account debit because of the discount 2 rupees, 2500. To share capital 12,500. Now how much should be transferred to capital reserve, sir? Try to understand. Ram 500 is share forfeiture, 3 rupees is received per share, 1500. Discount on reissue is 1000 rupees, so which is 500. Sham, out of 1000, 750 is reissued, 250 is not reissued. 250 portion won't be transferred to capital reserve. 750 portion, share forfeiture account is 750 into rupees 6, 4500. Discount on reissue 1500 to be written off, that is 750 into rupees 2500. Capital reserve 3000, so total capital reserve 3500. So share forfeiture account debit 3500 to capital reserve 3500. Simple. Correct. Yes, look at this question. A holds 2000 shares of rupees 10 each, on which he has paid rupees 2 as application money. B holds 4000 shares of rupees 10 each, which he paid rupees 2 on application and 3 on allotment. C holds 3000 shares, 2 rupees on application, 3 rupees on allotment, and 3 rupees on first call is paid. Correct? They all failed to pay their arrears of the second and final call. So no one paid the second and final call. That doesn't mean that A paid the allotment and first call. A didn't pay allotment, first call, second call. B didn't pay first call, second call. C didn't pay second call. So the directors forfeited their shares. The shares are reissued subsequently for rupees 12. Shares are reissued for how much, sir? Rupees 12. Which means premium. So, sir, premium also should be transferred to capital reserve. The answer is no. Premium should be there in securities premium. Reissued related shares, discount, we return off against share forfeiture, no, sir. Whether premium should be added to share forfeiture, the answer is no. Premium, just to treat it like a securities premium there itself. So listen here. Share capital account debit 90,000 to share forfeiture account, that is A. See, share capital account, A holds 2,000, B holds 4,000, C holds 3,000, together 9,000, fully called up. So face value fully called up is 10 rupees. 10 into 9,000 comes to 90,000. To share forfeiture, A. How much ever paid? That much. A paid for 2 rupees on 2,000. So 2,000 into 2. B paid 2 rupees plus 3 rupees. Application plus allotment 5 rupees on 4,000 shares. And C paid 8 rupees on these 3,000 shares, which will come to 48,000. Allotment, people. Allotment, A is not paying. So to share allotment, 2,000 into 3. Correct? Share first call. A and B are not paying. How much it is? Rupees 3, no? 3 into 2,000 plus 4,000, 6,000. 3 into 6,000. Share second and final call. No one is paying. So 9,000 into 2 comes to 18,000. Now reissued. Everything has been reissued at rupees 12. Securities premium 18. And capital reserve. Whatever there in the share forfeiture, as everything is relating to reissued shares, everything will go to capital reserve. 48,000. Done, sir. Sir, what if the asset is purchased by issue of shares, sir? Asset to vendor is the normal entry for purchase. Then vendor consideration will be satisfied by share capital. If at all issued at a premium, then vendor to share capital to securities premium. That's it. Listen here. Exco Limited was incorporated with an authorized share capital of 90,000 equity shares. The company purchased land and building for 4 lakh rupees, payable fully paid up shares. So face value only. They are not paying at a premium. The balance of shares were issued to the public. So what will be the entry? Land and building we purchased, land and building to Vyco Limited. Later, that 9 lakh rupees share, 4 lakh rupees issued to the Vyco Limited. So now the decrease in the liability. So debit that particular Vyco Limited. So Vyco Limited account debit 4 lakh. Increase in the asset because the public will give you money. Bank account debit. Shares increase in a capital 9 lakh. Okay. Now, last question we'll discuss from this particular unit. Okay. That is your fourth question of your study mat. Listen here. Measure. Herbal Tea Plantation Limited was registered with a capital of 1 crore divided into equity shares of rupees 100 each, which means how many shares, sir? Shares are 1 lakh shares. 1 lakh shares. The company offered to public 50,000 shares. Out of 1 lakh, how much is offered to public, sir? To the public, we are offering 50,000 shares at a premium of rupees 20. So what is the issue price? Issue price is 120. How it will be paid, sir? Application 25, allotment 50. In the allotment, 20 rupees is premium. So 20 is premium, 30 is face value. 20 is premium, 30 is face value. 20 on first call, 25 on final call. 20 on first call, 25 on final call. Applications were received for 75,000 shares. 75,000 shares. Company offered 50,000, which means 25,000 extra. Shares were allotted to application on pro rata basis. Pro rata basis. Okay. Kantibai, who was allotted 500 shares, did not pay the allotment money. So allotment money is not paid by Kantibai, which means premium is also not paid, which means securities premium to that extent should be reversed. He also failed to pay the first call. Great. His shares were forfeited. Wow. Sheetal was holding 200 shares, did not pay the first call. Final call was not yet made, which means how much is called up, sir? Application money is called up. Allotment money is called up. First call is called up. Not fully called up, it is partly called up. Okay. Make a journal entry. First, you are going to issue shares. How many shares you issued, sir? You issued only 50,000 shares, but you got an application for 75,000. Entry will be bank account debit to share application account 75,000 into 25, which will come to 18 lakh 75, 18 lakh 75. Then share application money pro rata basis as we are doing. So whatever is relating to 50,000 shares, that shall be transferred to share capital. Other things shall be transferred to share allotment. So how much is it, sir? How much is it, sir? One is 50,000 into rupees 25, which will come to 12 lakh 50,000. Other is 25,000 excess application. So 25,000 into 25, 625,000. Done. Next, you are going to make a allotment. Allotment is 25,000, 25 lakh. How, sir? How many shares you are allotting? 50,000 shares. What is the allotment money? Allotment money is rupees 30, right? Allotment money is rupees, not 30, rupees 50. Allotment money is rupees 50, which will come to 25 lakh. 25 lakh. In that, 30 rupees per share will go to share capital, 20 rupees per share will go to securities premium. However, how much you are receiving, sir? You are not receiving Kanti Bai's portion. You are not receiving Kanti Bai's portion. How much, sir? How much, sir? Out of 50,000, Kanti Bai was holding 500 shares, which means only 49,500 is receiving. But Kanti Bai didn't pay anything about that 500 shares, sir. The answer is no. Try to understand. Kanti Bai got allotted 500 shares means applied for 750. Applied for 750. If applied for 750 means, people, applied for 750 means, don't you think 250 application money is already paid towards allotment? Yes, sir. So it's not something like Kanti Bai didn't pay any money towards allotment. Of course, he had paid. How much, sir? Try to understand. Try to understand. 50,000 shares are there in total, of which 50 rupees to be received. Correct? Done, sir. Already received how much, sir? Already received 625,000. Already received 625,000. Already received 625,000 and 500 rupees, 500 shares money is not received. How much is not received, sir? Try to understand. 500 allotment is not received. That is 500 into 50. 500 into 50. 25,000 rupees is not received. However, he paid a application, extra application. How many extra application? 250. Relating to that, how much he paid? Application money? He paid 25 rupees, no? He paid 25 rupees. So 250 into 25. 6,250 has been already received. So how much is not received, sir? Not received is 25,000 minus 6,250, which will come to 18,750. So how much is actually received? 18,56,250. And you are going to make a first call. In first call, how much you are going to receive? You are not going to receive amount relating to Kanti Bai and one more, that is Sheetal. So these two you are not going to receive. How much? Sheetal is holding 200, Kanti Bai holding 500, 500 into 700 into 20. So much you are not going to receive out of 10 lakh. Remaining is received. Now forfeiture. 700 shares you are going to forfeit. Called up portion you have to debit. That is 700 into 75, 52,500. Securities premium again debit, because only to the extent of Kanti Bai's. Because it is not received, no. It is credited but not received. Sheetal paid. Allotment money paid. So don't need to reverse Sheetal's. But Kanti Bai's you have to reverse. 500 into 20, 10,000. Share forfeiture how much, sir? Kanti Bai paid 750 shares money, application money. Sheetal paid 200 shares, application plus allotment money. To share allotment is how much, sir? To share allotment 8,750 of Kanti Bai. Correct? That is 18,750. 18,750. What is this 10,000, sir? Securities premium involved in it. 8,750 towards face value, 10,000 is towards securities premium. Share first call is how much, sir? Share first call 700 into 20. See here how it is. 500 allotted is applied is 750. So application money received is 18,750. whereas towards application we adjusted 12,500, allotment 6,250. So allotment money due was how much, sir? 25,000. In that face value 15,000, premium 10,000. So 6,250 is adjusted towards what, sir? First face value. So due is so much, which means premium is not received. Okay, premium is not received. With that issue of share is done. Next unit will be your bonus issue, one of the small one, very small. Okay, yes, now we'll be discussing on bonus issue, right? What do you mean by bonus issue, sir? Bonus issue is nothing but a free shares issued to the existing shareholders out of the free reserves available, right? So bonus shares are nothing but free shares issued to the existing shareholders, okay, out of the reserves available, and any company can issue the bonus, sir. Yes, the company which is authorized in its article to issue the bonus can issue the bonus, and bonus can be issued only to fully paid up shares. What do you mean by this, sir? If the existing shares are fully paid up, then only you can issue the bonus. Otherwise, first you should make these shares fully paid up either by using the free reserves or by making the call to make a payment. Then you should issue this bonus to these shares, that is bonus shares. Okay, sir. Free reserves. What are the different free reserves we can use, sir? Any divisible profit like P&L, general reserve, all those things you can use, plus CRR you can use, that is capital redemption reserve you can use, and securities premium you can use, provided that security premium should have been collected in cash. So what and all we can use, sir? Come on, we can use the free reserves, we can use the CRR, not capital reserve, capital redemption reserve. We can use free reserves, we can use CRR, we can use securities premium, correct? Because securities premium, first point is that no, securities premium, first point is that no. So for the purpose of bonus, you can use three things: free reserves like P&L, general reserve, etc., free reserves, CRR, and securities premium. Now, free reserves you can use it for any purpose, that is totally free. Yes, sir. CRR is what, sir? How it is created, that I will tell later. That is due to redemption it will be created, that I will tell while doing a redemption chapter. But that CRR what is created, that could be used only and only for the purpose of bonus issue. CRR cannot be issued for any other purpose. CRR purely could be used only for the sake of bonus issue and securities premium. That can be used for 5 reasons, however practically 3 purposes: bonus, buyback, writing off of expense relating to issue. So sir, first which we will use, sir? We are going to use CRR because that's the one no, which is restricted only to bonus. So first empty it. After that, if money is required, then take it out from the securities premium. Then if extra money still is required, then take it out from the free reserves. Okay. So and also that free reserves will be there, no, general reserve and P&L. Company can use that free reserves to make the shares fully paid up. So in bonus, what we will do, sir? From reserve we will take out the money and we will put it to capital. From reserves we will take out the money and we'll put it to capital, which means decrease in reserve, sir. Reserve is in the nature of capital. So decrease in reserve, debit, correct? Capital increases. So increase in capital, credit. So entry will be that particular reserves account debit to capital account. See, CRR account debit, securities premium account debit, free reserves account debit to share capital account. However, this entry could be split into two. That is, when the bonus is allotted, when the bonus is issued, what we are going to do? From the reserves, we are going to take out the money and park it to the separate account called bonus to equity shareholders account. Okay, we are going to park it to the separate account called bonus to equity shareholders account. Later, from bonus to equity shareholders account, bonus to equity shareholders account, from that we will take and we'll transfer it to share capital account. We'll transfer it to share capital. That's simple. We'll see few questions. Following items appear in the trial balance of Bharat Limited, a listed company. Okay, 40,000 equity shares they have. CRR balance is there to the extent of 55,000. SP is there to the extent of 30,000. GR is there 1,05,000. Surplus, that is P&L, is there 50,000. Company decides to issue equity shareholders bonus at the rate of 1 share for every 4 shares held. So if you're holding 4 shares, then you will get 1 share. If you're holding 4 shares, then you will get how much shares, sir? 1 share. Now, so for every 4 share held, you are going to get 1. Now for the 40,000 shares, how many bonus shares to be issued? 10,000 bonus shares to be issued. And what is the face value of that, sir? What is the face value of that? Rupees 10, which will come to rupees 1 lakh. Now you need 1 lakh rupees. Now you need 1 lakh rupees. From where you will take out, sir? From the CRR you will take out first 55,000. So CRR account debit 55,000. Securities premium 30,000. Securities premium account debit 30,000. Last you are going to take out either from P&L or general reserve. Let's take out from the general reserve 15,000 to equity share bonus to equity shareholders 1 lakh. Later bonus to equity shareholders 1 lakh to equity share capital 1 lakh. Simple. See here, CRR account debit, securities premium account debit, general reserve account debit to bonus to shareholders to equity share capital. Bonus to shareholders account debit to equity share capital. These are the 2 journal entries. Simple. Look at this question now. Past journal entries in the following circumstances. A limited company with a subscribed capital of 5 lakh consisting of 50,000 equity shares of rupees 10 each. Called up portion is 7.5 per share, which means rupees 2.5 is unpaid. A bonus of 1,25,000 declared out of general reserve to be applied in making existing shares full. So they are planning what, sir? Using the bonus of 125,000 to make this partly paid up shares into fully paid up. How it will be, sir? How much is required? 50,000 into 2.5. Correct? Which will come to rupees 125,000. Now you are going to take it out from the general reserve, that is general reserve account debit to bonus to equity shareholders account. How much, sir? 125,000. Later you are going to make it or transfer it to the share capital account. How, sir? First you will make a call, share final call account debit to share capital account 125,000. Later bonus to shareholders account debit to share call account 125,000. Instead of bank you are going to use bonus. See here, general reserves to bonus to share final call to share capital, bonus to share final call. Peace. Done. Second one, a limited company having a fully paid up capital of 50 lakh consisting of equity shares of rupees 10 each, which is 5 lakh shares. Rupees 5 lakh shares, add general reserve of rupees 9 lakh and capital is and resolve to capitalize 5 lakh out of general reserve by issuing 50,000 fully paid up shares of rupees 10 each shareholder to get 1 share for every 10 shares held by him. So try to understand. First what we will do, sir? From the general reserve where the balance is 9 lakh, we are going to take out 5 lakh. That is general reserve decrease, debit, general reserve account debit to bonus to shareholders account. Later you are going to issue shares. So bonus to shareholders to equity share capital 5 lakh. 2 entries. General reserves to bonus to share to equity share capital. Is clear? That is all about your bonus issue. Nothing much special. Nothing much special about it. Okay. Now we are going to discuss about next part, that is right issue. Okay. What do you mean by right issue, sir? Right issue is nothing but offering a new shares first to the existing shareholders. See, whenever you are a company, you want to offer a new shares. You can't straight away go and offer to the public, outsiders. First, you should offer it to the members who are already existing members. In their proportion, you should offer. Okay. That is known as right issue. See here, where at any time a company having a share capital proposes to increase its subscribed capital by the issue of further share, such share shall be offered one to person who at the date of offer are holders of equity shares. Okay, so first priority should be given to the existing person. And one more thing is when existing person don't want to exercise it, then he can transfer that right to someone else. He can transfer that particular right to someone else. So that is known as renouncement, where he can transfer that particular shareholder. He don't want to exercise, but they can transfer it to someone else. That is known as renouncement. For that renouncement, they might charge some money from that particular person who is taking that rights. See here, what will happen, sir, if the right issue comes? If right issue comes, of course, additional number of shares will get added. Because of this, number of shares will increase automatically. If at all right issue is made at the price less than the existing market price, then market price will fall. So, sir, what is the name of the market price before right issue? Before right issue, the market price, we call it as a CRP. That is come right price, which means come means cumulative. Okay, come means cumulative. So this will be treated as cumulative of right. The market price includes the value towards right. Okay, after right issue, the market price will be known as X right price. That is excluding right price, ERP. So the difference between come right price and excluding market price, excluding right price, is known as right value per share. That is difference between come right price and excluding right price is known as a right value per share. For example, 1000 shares are there right now. Which are the CRP is 400 rupees. That is before right issue, come right price is 400 rupees. Now the new right are issued at 320 rupees. How many shares, sir? 100 shares. How many shares? 100 shares. So try to understand how to find out ERP, sir. Earlier, how many shares were there? 1000 shares were there. What was the price? Price was 400. Correct? Done. Plus. Now, what is the price, sir? Now the new price is rupees 320. Yes. Into how many shares are there, sir? 100 shares. Divided by, now how many shares it will be? 1100 shares. 1100 shares. It will give you exclusive right price or your ERP X right price. Whereas come right price is before that. What was the market price? That one. Okay. Now as a existing shareholder, if you are going to transfer your shares, automatically you know that earlier my share price was rupees 400, boss. Now it is falling to 320, which means my portfolio will fall, no? So whenever I renounce this share right to someone, Of course, I am going to collect some money from them. Sir, is that applicable for us? No, because we are thinking from the point of view of company, not from the point of view of those individuals. Okay, see, there is one question. We'll look at this question and we'll straight away go to the bit of theory of this, like how many days, etc., etc. That anyhow you have learnt it in your company act. So I'm going to give a glance about it. After that, we'll go to redemption straight away. A company offers new shares of rupees 100 each at a premium of 25%, which means new issue price is 125 to existing shareholders on 1-for-4 basis. So if you have one share, you will get 4 shares. The come right market price is 150. Right now, the market price is 150. The 4 shares what you are holding, that is 150. Calculate the value of right. What should be the X right market price? So listen, X right market price, how to calculate, sir? Now, what is the price? 150. And how many shares you have? 4. Plus new shares will be issued at 125. What is the price? I mean, what is the number of share? 1. Divided by existing was 4 shares, new is 1, 5. So 150 into 4 plus 1 into 125 divided by 5, it will come to 145. It will come to 145. Done, sir. Value of right is how much, sir? Come right price was how much? 150. X right price is how much? 145. Correct? Which means you are going to lose rupees 5. You are going to lose rupees 5 per share. Total value is how much, sir? Out of 4 shares, you are losing how much? 4 into rupees 5. You are losing in total rupees 20. You are losing in total rupees 20. Value of right is 20. Now, if you want to renounce, you are going to recover 20 rupees from this particular person who is taking your renouncement right. Okay. See here, few things. How the offer should be made and all. Offer shall be made by a notice specifying the number of shares offered and limiting the time not being less than 15 days, which means you should give at least 15 days time for them to accept the offer and not exceeding 30 days. That is, somewhere between 15 to 30 days you should give them a time. And if not accepted, shall be deemed to have been declined. So if they don't accept within 30 days, it will be treated as they don't want, they decline. Unless the article of the company otherwise provide, the offer side shall be deemed to include right exercisable person concerned to renounce. Unless and until your article tells a shareholder cannot renounce his rights, then always and always remember a shareholder can renounce his right. After the expiry of time specified in the notice or on receipt of earlier intimation from the person to whom such notice was given and he declines to accept the shares offered, the board of director may dispose of in a manner which is beneficial to the company. Okay. The employees under scheme of ESOP, they also can be get a right issue. That is also right issue only. Any other person specified by the special resolution. So the notice shall be dispatched through registered post or speed post or through electronic mode to all the existing shareholders at least 3 days before the opening of the issue. So 15 days time you give, no. Today morning only you can't send a notice. At least 3 days before you should send a notice. Okay. Minimum 15 to 30. Before this 15 days starts, you should give a notice 3 days prior. Nothing in this section shall be applied to increase the subscribed capital of a company caused by the exercising of an option, term attached to the debenture issued, etc., etc. So this is all about the right issue, not much important as such. Theory, that anyhow theory you are going to learn in your Companies Act. I am not going to teach exact what provision tells and all. How much ever is required for accounts, I am telling. So right issue, this right and X is very important. Okay. This right and X is very important. How to find the X price, sir? New weighted average you have to find. That's it. Old rate into old share plus new rate into new share divided by old plus new. You will get X right. Now that is per share. In the given question, 150 was there. Now, one share will fall for 145 rupees. How many shares you have already? 4 shares you have. So, how much you will lose? You will lose 5. So, value of the right is 20. If you want to renounce, you are going to renounce for nothing less than rupees 20. That is all about the right issue. Now, we are going to discuss about redemption of preference share. One of the easy topic. at one of the important topic. Okay. Yes. Redemption of preference shares. Okay. We'll start with redemption now. Redemption of preference shares. Okay, sir. What do you mean by redemption, sir? Redemption is nothing but people repayment. Redemption is nothing but repayment where you are repaying the capital portion of the preference shareholders. That thing is known as redemption of preference shares. So repayment of the preference shareholders capital money is known as repayment. So on the basis of redeemability, preference shares can be classified into two: redeemable preference share, irredeemable preference share. What it classified as, sir? Two: redeemable preference shares, irredeemable preference shares. What do you mean by redeemable preference shares, sir? Redeemable preference shares are those preference shares which are repaid after certain number of years. Redeemable preference shares are those preference shares which are repaid after certain number of years. Irredeemable preference are those shares which will be repaid only at the time of winding up of the company. Redeemable means after certain point of time you are going to repay it. Irredeemable means you are not going to repay until the winding up. Okay, but as per the Companies Act 2013, people, as per the Companies Act 2013, no company can issue irredeemable preference shares. So as per the Companies Act 2013, no company can issue irredeemable preference shares. Okay, sir, fine, we don't want to issue irredeemable preference shares. Can we issue the shares with 100 years of redeemability? That is, after 100 years we are going to pay them back? The answer is no. Basically, your companies could be divided into two. Companies could be divided into two. Company which is related to infrastructural companies, which is not related to infrastructural activity. Company which is related to infrastructural activity, company which is not related to infrastructural activity. If at all your company is related to infrastructural activity, maximum 20 years. Maximum 20 years you can hold that preference shares, which means you should redeem within 20 years. If at all infrastructural company, you should redeem it within 20 years. Whereas if it's infrastructural company, if it's not infrastructural, up to 20 years. If it is infrastructural based company, then it will be not 20 years, it will be 30 years. That is, up to 30 years you can hold that capital. However, after 20 years, that is, from the 21st year, you should keep on redeeming it equally. Whatever the amount is there, no, 1/10 at least you should keep on redeeming it from the 21st year. Okay. Now, for the sake of redemption, what money company can use, sir? Company can either use the free reserves or they can issue the fresh shares, not securities. They should issue fresh shares only. They can't issue debenture for this purpose. Sir, the debenture they can't issue at all. They can issue, but it won't be considered as for this purpose. They can issue debentures. No restriction on that. However, that issue of debenture won't be considered that it issued for this purpose. Okay, done, sir. But one more thing you have to remember, people. To the extent of the face value of the preference shares redeemed, using free reserves, you should transfer such free reserves to the special reserve called CRR. There that we saw, no, in bonus issue, capital redemption reserve. For that reserve, you should transfer certain portion of the free reserves. How much, sir? Face value of the preference shares redeemed using free reserves. Okay, done. That can be used only and only for the bonus issue. See, as per section 55, face value of preference shares redeemed, face value of preference share, not overall, not redemption value, face value of preference shares redeemed shall be equal to these two. That is, free reserves utilized for this purpose plus face value of issue of new shares. Face value of issue of new shares. However, if your shares are issued at discount, then issue price you consider, not face value, which means if the new shares are issued at par and premium, if the new shares are issued at par and premium, then use the face value. If at all new shares are issued at discount, it won't happen. But let's say it is issued at discount, then use the issue price for this purpose. Okay. So this thing you have to remember, that face value, free reserve utilized plus face value of the new shares should be not less than face value of preference shares redeemed. Okay. Now the question comes, sir, minimum number of shares to be issued. How much is the minimum number of shares to be issued to satisfy section 55? What you should check? First you should check what is the face value of redemption. What is the face value of redemption? Let's say 1 lakh rupees. Okay. How much is the free reserves available for this purpose? Let's say 60,000. Now you should get 40,000 as a face value of fresh issue. You should get this 40,000 as a face value of fresh issue. So what you are going to do, sir? 40,000 divided by, let's say, 10. You are going to issue 4,000 shares. You are going to issue 4,000 shares. Okay. That's how you are going to do. However, in case of, there is face value of preference shares to be redeemed minus free reserves available for the purpose of redemption divided by face value per share. However, in case of discount, it will be issue price. And to redeem a preference share, those preference share must be fully paid up shares. Okay. What are the different entries for preference share, sir? Let's say you are going to redeem now 100 rupees share. You are going to redeem at 120 rupees. So first capital 100 should be reduced because you are repaying. So capital will be debited. Preference share capital account debit 100. 20 rupees extra you are paying as a premium. That is premium on redemption of preference share 20 to preference shareholders. When you make them a payment, preference shareholders account debit to bank account. When you make them a payment, preference shareholders account debit to bank account. Sometimes for the sake of money, you might sell some asset also. Let's say that investment is sold at loss. For example, investment of 1 lakh rupees, you sold at 90,000. Then entry will be bank account debit 90,000, loss debit only. That's why loss account debit 10,000 to investment 1 lakh as investment goes out. What if I sell it at 110,000, sir? Then bank account debit 110,000 to investment 1 lakh to profit on sale of investment 10,000. Done. Now this premium on redemption of preference share is there, no sir? That can I write it off against securities premium? The answer is of course no. The answer is a strict no. Why? I told you yesterday. Sir, in that there was a point, sir, where fourth point was you can use it for the sake of redemption of preference shares, redemption of debentures, basically redemption of securities. But I also told whichever the company follows section 133 they can't use it for those two purposes. One is to write off preliminary expense, two to write off premium on redemption of securities. So you can't use securities premium, you will use P&L. Sir, in question that is not at all there, sir. Free reserves is not at all there. Then what you should do, sir? Then use the securities premium, but write down the note and come assume that company is not following section 133. Usually they will not give. At all they give like that. You should do like that and come. Okay. Now, sir, you told no, sir. From free reserves we should take out what? Face value of shares redeemed using free reserves. That you should take out and you should transfer it to CRR account. Yes, what will be the entry, sir? Free reserves account debit to the CRR account, and this CRR account can used only for the purpose of bonus issue. Done, sir. Shall we see few questions? Yes, listen here. Hinduja Company Limited had 5,008% redeemable preference shares of rupees 100 each fully paid up, so it can be redeemed. The company decides to redeem these preference share at par by the issue of sufficient number of equity shares of rupees 10 each. So they are planning to issue it using not free reserves but by issue of shares. So how much they should issue, sir? Shares 5,000 into 100 is the redemption value, face value of redemption, which will come to 5 lakh. Now 5 lakh divided by new share face value is 10 rupees. You should issue around 50,000 shares. You should issue around 50,000 shares. Okay, see here, this formula kind of thing you can remember. The reason I told it already in the regular class. Now if I tell the same reason again, it will take other 1 hour. As it's an exam time, I don't want to waste your time, all those things. Try to understand this, you try to remember. That is, face value of the preference shares to be redeemed will be, should be equal or should be less than reserves available for this purpose plus face value of fresh issue. Now, how much is the face value of preference shares to be redeemed, sir? 5 lakh. Free reserves available for this, nil. So, face value of fresh issue should be 5 lakh. How many shares to be issued, sir? Number of shares into face value should be 5 lakh. So, number of shares will be 50,000 shares. Okay. What will be the entry for? First, you are going to issue 5 lakh rupees share. So, the entry will be bank account debit to equity share capital account. Later, you are going to redeem your shares. When you redeem, your capital will be decreased. You have to pay to your equity shareholders. Entry will be preference share capital account debit to preference shareholders account. Later, you are going to make them a payment. That is preference shareholders account debit to bank. That's it. Simple. Shall we go to the next one? That is C Limited had 10,000 10% redeemable preference shares of rupees 100 each, fully paid up. Okay. The company decides to redeem these preference shares at a par by issue of sufficient number of equity shares of rupees 10 each at a premium of 2 rupees, which means issue price is 12 rupees. Sir, is it going to make any difference? The answer is, of course, no. Why? Because we want face value of new issue to be so much. Yes. You are required to pass on necessary journal entries, including cash transaction. Try to understand how much is the face value of redemption. 10,000 into 100, which will come to 10 lakh. Okay. You need face value of fresh issue as 10 lakh, not the overall collection from that. Done. So, listen here. 10,000 into rupees 100. Free reserve utilized is nil. Face value of the fresh issue will be 10 lakh. It should be, how many shares to be issued, sir? Number of shares into face value, that is 10 lakh divided by face value. You will get number of shares, which is 1 lakh shares to be issued. 1 lakh shares to be issued. So, what will be the entry, sir? Bank account debit, new issue, bank account debit. How much you are issuing, sir? Shares. 1 lakh shares we are issuing into rupees 12 is what we are collecting. 12 lakh to equity share capital 10 lakh to securities premium 2 lakhs. Now you are going to redeem your preference share capital account debit to preference shareholders to bank 10 lakh as you are not going to pay them any premium as such. See here, G India Limited had 9,000 10% preference shares of rupees 10 each, fully paid up. Great. The company decided to redeem these preference shares at par by issue of sufficient number of equity shares of rupees 9. Oh sir, 1 rupee discount, no sir. So we have to take face value, no. Issue price, no guys. Try to understand. Face value itself is rupees 9. There is no hard and fast rule that it should be in 110s. Generally it will be in 110s. That doesn't mean that everywhere it will be 110s. Okay. Face value itself is rupees 9. So how many shares to be issued, sir? What is the face value of redemption? 9,000 into 10, which will come to rupees 90,000. Okay. Now this 90,000, I am going to divide by the face value of fresh issue, that is rupees 9, which will come to 10,000 shares. You have to issue 10,000 shares. You are required to pass the necessary journal entries. Journal entry will be what, sir? First, you are going to issue the shares of rupees 9. How many shares? 10,000 shares. Entry will be bank account debit to equity share capital account 90,000. Preference share capital account debit to preference shareholders account 90,000. Preference shareholders account debit to bank account 90,000. That is payment for them. Done. Look at the fourth one, everyone. To redeem 5 lakh preference shares, the maximum amount of divisible profit available is 3 lakhs, which means at least 2 lakhs should be face value of your fresh issue. Calculate the number of shares to be issued by the company to ensure provisions of section 55 are not violated. Also determine number of shares if the company decides to issue such shares in the multiples of 50 only. They don't want to issue for something 10, 20 and all. They want it in 50, 100, 150, 200 shares, 250 shares like that. Okay. Now, what is the face value of preference shares to be redeemed, sir? 5 lakh rupees. What is the free reserves available? 3 lakh rupees. How much is the face value of the fresh issue to be? 2 lakh rupees. Correct? Yes. Now, how many shares to be issued, sir? 2 lakh into rupees 9. Basically, the question is incomplete, but here we assumed, here in this question, it is assumed that face value of the share is rupees 9. Rupees 9. So, how much it will be, sir? 2 lakh divided by 9, which will come to 22,222. However, if the company wants to issue the shares in the multiples of 50, then they should issue 22,250. Sir, 22,222. Nearest 50 is 22,200. No, why you are telling 22,250? People, if at all you issue 22,200 shares, how much will be the overall this thing, sir? That is 22,200 into 9, 1,99,800. But how much should be the minimum amount of face value you want? 2 lakh, which means you are not satisfying this. But that will be maximum, no sir? Then maximum is fine. Minimum we are talking. Okay, this is the thing. Now this we saw only to satisfy what? Minimum requirement of section 55. Sometimes what happens, you might satisfy section 55, but you won't be having money to pay them. Sometimes you will satisfy section 55, but you won't be having money to pay. Sir, what are you talking, sir? Free reserves will be there now. Free reserves means need not be that money should be there in the bank account. That could have been utilized somewhere. That could have been invested somewhere. So don't think that how much profit is there, so much cash should be there with you. No way. Okay. Done, sir. So what you should do, sir, you should check from 2 points of view. One is to satisfy section 55. Next, to satisfy cash requirement. So whichever is the highest number of share, so many number of shares you should issue. That we'll discuss now. Okay. Look at this example. Face value of preference shares to be redeemed is 5 lakh. Okay. And redeemable at 10% premium, which means how much you have to pay to your preference shareholders? 550,000. No doubts. Free reserves available for this purpose is 4 lakhs. Okay. So to satisfy section 55, how much face value share you should issue, sir? 1 lakh rupees is the face value share you should issue. Correct? Because out of 5 lakh, 4 lakh could be satisfied using free reserves. So if you issue the shares of 1 lakh rupees, that is more than sufficient. Face value of 1 lakh, that is more than sufficient to satisfy section 55. Okay. Now, fresh issue to be made is around at the rate of rupees 12. Rupees 12 is the price at which the fresh issue to be made. Existing cash balance is 1 lakh. Now, company has the policy of retaining at least 40,000 cash all the time. Now, the company's policy is to hold cash at least 40,000 all the time, which means moral of the story, right now, although we have 1 lakh rupees, only 60,000 is available to pay to preference shareholders. Correct? Now, number of shares to satisfy the issue of the existing shareholders is how much, sir? Try to understand how much it is. Free reserves, I agree, 4 lakh is available. At the same time, you have to pay the premium of 50,000, no? And this premium should be written off against free reserves only. P&L or general reserve, generally P&L. Now, free reserves balance will be how much, sir? Free reserves balance for the sake of redemption is 350,000. So we have to issue the share of rupees 1,50,000 face value to satisfy section 55. That is 15,000 shares. Now 15,000 shares at the rate of 12 if you issue, you will be able to collect around rupees 1,80,000 and 60,000 is available already. So moral of the story, around rupees 2,40,000 will be available. Correct? 2,40,000 will be available. Amount payable is how much, sir? 550. Amount available is how much, sir? Before this 60, which means due amount is 490. Where you have to pay 490, you are able to collect only 180. Do you think you can satisfy only by satisfying section 55? No. So as per that, how much share you have to issue, sir? I have to collect 490,000. Face value issue price, sir. I have to collection, it happens at a issue price, not face value. So divided by issue price. So as per this, I have to issue 40,834. To satisfy section 55, I have to issue just 15,000 shares. For this one, to satisfy cash requirement, I have to issue 40,834. See, minimum number of shares to be satisfy the section 55 to satisfy cash requirement. Face value of the preference shares to be redeemed. Free reserves available after writing of premium, loss, etc. So that will be the face value of fresh issue. So face value of fresh issue divided by face value per share, you will get number of new shares to be issued. When it comes to cash requirement, amount payable to preference shareholders, from that we are going to reduce cash available after issue of securities other than shares, because you can issue securities like debenture, etc. for the sake of cash requirement, but that is not considered for the sake of calculation of section 55. That's it. Okay. Now you will get to know how much money is to be raised from the fresh issue. That money to be raised from the fresh issue divided by issue price you will get number of shares to satisfy cash requirement. So whichever is higher, that you select and you are going to get it. See, face value of the preference shares to be redeemed is 65,000, whereas free reserves available, free reserves, there is one question. Okay, I will show here only, Leo. I will give a glance like idea about it. We are not going to discuss on this question like completely. Try to understand. 48,000 is there. 48,000 is there. And the share, this preference share is redeemed at a premium of 10%. So this premium on redemption, which is rupees 6,500, to be written off. Yes, sir. To be written off against free reserves. Yes. So is 48,000 is available, sir? No, sir. Out of 48,000, 6,500 will be used to write off premium. Yes. And you sold investment for this purpose, and at a loss of 3,500, even that you are going to write off. So how much is the free reserves available for this purpose, sir? 38,000. So what is the face value of the fresh issue to be raised to satisfy section 55? That is 27,000. So what is the face value per share, sir? 50 rupees. So how many shares to be issued? 540. Sir, cash requirement. Right now, how much money you should pay to your preference shareholders? 65,000 plus 10%, which will come to 71,500. Yes, sir. Cash available is how much, sir? We already have 31,000. Okay. Plus, we are going to sell our investment of 18,500 at 15,000. So, we will receive 15,000 rupees through that. Correct? And we are planning to keep minimum balance of 12,000. So, cash availability is 34,000. And how much you should get from the new shares, sir? To the extent of 37,500. So how many shares, sir? 37,500 divided by 50, 750 shares. So to satisfy minimum criteria as per section 55, we have to issue 540, and to satisfy cash requirement 750. So how many shares to be issued, sir? Whichever is higher, that is 750. Whichever is higher, that is 750. Okay. Now, how much CRR to be created, sir? To the extent of free reserves used for this purpose. Try to understand. 65,000 is the face value of redemption. You are issuing 750 shares. Face value of this 750 shares is 750 into 50. 750 into 50, that will reduce. So we will get to know how much CRR could be used. So try to understand journal entry. 18,500 investment sold for 15,000. So bank account debit 15,000. Loss on sale of investment 3,500. To investment 18,500. Later you are going to issue the shares. So entry will be bank account debit to equity share capital account 37,500. Later you are going to redeem the shares. Preference share capital account debit 65,000. Premium on redemption 6,500. To preference shareholders 71,500. Later you are going to make them a payment. Preference shareholders account debit to bank 71,500. 71,500. Later you have to write off loss on sale of investment. Premium on redemption of preference share against a P&L. So entry will be P&L account debit 10,000 to loss on sale of investment to premium on redemption of preference 10,000. Now we calculated here how much CRR to be created. Sir, but earlier you told how much is the face value redeemed out of free reserves. Here free reserves available was 34. Available was 34 for this purpose. But now we are issuing 750 shares. No. So requirement automatically falls. So we have to create just 27,500. That is being CRR created to the extent of shares redeemed using free reserves. So this is minimum cash criteria. One, you should think from the point of satisfying section 55. That is very easy. Normal one. Then you should think from the point of view of satisfying cash criteria. Okay. See here. The following are the extract from the balance sheet of ABC Limited as on 31st December. Share capital 40,000 equity shares of rupees 10 each is there, which is 4 lakh rupees. 1,000 10% removable preferential of rupees 100 each, fully paid up 1 lakh. Reserves and surplus. Capital reserve 50,000. Can you use it for? You can't use it, sir. Security premium is there 50,000. Can you use it, sir? You should not use it, but if it is inevitable, then you can't help use it. General reserve 75 is there. P&L 35 is there. So free reserves available is how much, sir? 110,000. Free reserves available is 110,000. What is the face value of the shares to be redeemed? 1 lakh. So moral of the story, do we have enough free reserves? The answer is yes. On 1st January 23, Board of Directors decided to redeem the preference shares at par by utilization of reserve. Great. So the entry will be are we issuing any new shares? No. Okay. So entry will be we are going to redeem preference shares. That is preference share capital account debit to preference shareholders account. How much, sir? 1 lakh. Then preference shareholders account debit to bank 1 lakh. Then you are going to create a CRR, that is reserves and surplus. What is there? General reserve is there to the extent of 75. P&L is there to the extent of 25 is required. That's it. To CRR 1 lakh. Okay. This is the answer for some different questions. So sometimes you might issue a debenture and all, but for the section 55 criteria, don't consider those debentures. However, for the sake of cash criteria, consider those debentures also. Okay, that is all about redemption of preference share. Simple concept. Next, we are going to discuss on issue of debentures. Okay. Now, issue of debenture. What do you mean by debenture, sir? Debenture is nothing but a bond issued by a company under the common seal. What and all will be there in that? They will be acknowledging a debt, telling that, yes, boss, we have taken money from you, so and so much. Contains provision as regards to repayment of the principal and interest. That is, that will also contains the information regarding how much will be repaid, at what percentage interest will be given, when the interest will be given, and how many years you are going to keep that money. Basically, your shares are there, no? Those are capital. Your debenture is there, no? That is your debt. What are the different kinds of debentures, sir? Debentures could be classified on many bases. In that, if you divide the debenture on the basis of security, secured debenture is there, unsecured debenture is there. Secured debenture is there, unsecured debenture is there. Secured debenture means what, sir? Debentures which are secured by the assets of the company. That is, if the company fails to repay the loan, then asset will be sold and the money will be given to debenture holders. Unsecured means such money, security and all won't be there. On the basis of convertibility, convertible debenture, non-convertible debenture, that is, debenture which can be converted into any other form of security, we call it as convertible debenture. Debenture which cannot be converted into any other form will be known as non-convertible debenture. On the basis of permanence, we have redeemable debenture, irredeemable debenture. That is, after certain number of years, you have to pay those amount of debenture. Those are redeemable debenture. Don't have to pay that money after certain number of years. Irredeemable debenture. On the basis of transferability or negotiability, we have registered debentures, bearer debenture. Registered debenture means these are registered. Basically, these debenture holders' name will be recorded in the company's debenture register. Bearer means whoever is holding that debenture will be the debenture holder. Okay. Accounting for debenture. Sir, I told you already, that is, in the debenture document itself, it will be known how many years you are going to keep, at what price you are going to repay, which means repayment provision will be known at the time of issue itself, not like shares. Not like shares. Debenture repayment related information will be known at the time of issue itself. Yes, sir. So, that also should be considered. What will be the entry, sir? We'll see one by one. Debentures are issued at par, redeemable at par. Issued at par, redeemable at par. Which means now also you collect 100 rupees. In future also you collect 100 rupees. Now this is redemption. For the time being, let's park it aside. Now what will be the entry, sir? Bank account debit to debenture account. Simple. No premium, nothing. Bank account debit to debenture account. Second case. Sir, debentures are issued at par, redeemable at premium. Debentures are issued at par, redeemable at premium. Now, sir, try to understand, people. At the end, while redeeming, you have to pay 20 rupees extra, which is your expense, correct? But future expense, no, sir. Future expense, no. While redeeming, we have to pay 20 rupees extra, no. Conservatism. This is what I told earlier part while doing your revision of introduction. Conservatism says what, boss? Boss, if it's a loss and all, you should recognize immediately. Now, although it's a future loss, you have to recognize it immediately. So what you will do, sir? Bank account debit, rupees 100. Okay. Loss on issue of debenture, rupees 20. Now only you are going to record it as loss on issue. To debenture account 100, and you are going to create one provision called as debenture redemption premium to the equal amount. Hope it is clear. You are not only going to record 100, you are going to classify this, you are going to record this 20 loss also, because although it's a future loss, as per conservatism, you should recognize it immediately. Hope it is clear, the second point. Now, what if the debentures are issued at par and redeemable at discount? What if debentures are issued at par, redeemable at discount? Sir, in future 10 rupees less you have to pay, sir. Gain, no. So, shall we record it as gain, sir, at the time of issue? The answer is no. Why? Again, my answer remains same. That is conservatism concept. Why, sir? Conservatism concept tells anticipate future losses and expense, not incomes and gains. So, if it's an income and gain, just ignore it until it is realized. So, people, you are going to consider only it is issued at par, redeemed at par basis only. Bank account debit 100 to debenture account 100. Done. Sir, debentures are issued at premium, redeemable at par. Sir, issued at premium, no sir, 20 rupees gain. Extra you are getting 20 rupees. But sir, now we remember we should not consider gain. No. Again, the answer is no. Why, sir? Because conservatism concept tells don't anticipate future gains. But here at the time of issue itself, you are realizing. So it's a realized gain. This you can consider. So the entry will be people, bank account debit 120 rupees. That's what you are receiving. To debentures account 100. To securities premium 20. Okay. Next. What if the debentures are issued at a premium, that is 120, redeemable at a premium of 130. So try to understand 20 rupees gain here, sir, because you are getting more. Here 30 rupees loss, sir, you are paying more. So net, sir, 10 rupees is a loss. Shall we recognize as 10? The answer is no. Why? Why? Try to understand. This 30 is what? Loss on redemption. This 20 is what? Securities premium. Can you use the securities premium to write off the premium on redemption? No. Then why you are using? So in a single journal entry, all these aspects will come. How, sir? First, normal bank account debit 120 rupees. Also future loss is there that you are not going to write off. You are going to record as it is. That is loss on issue 30. Two debentures 100 face value always. Securities premium 20, and whenever the loss is there, if it is not due to discount, then of course you have to create something called as Debenture Redemption Premium, DRP 30. This is the entry. Hope you guys understood. Next, the debentures are issued at premium, let's say 120, redeemable at discount, that is rupees 90. Then sir, bank account shall be debited. Sir, discount no sir, which means in future you are paying less, 10 rupees gain, no. So 30 rupees is a gain. The answer is no. 10 rupees is a future gain. Don't consider that. Only consider the gain of 120. So bank account debit 120 to debentures account 100 to securities premium 20. Okay. Next. Debentures are issued at discount 90 rupees, which means 10 rupees is a loss. Redeemable at par, no loss, no gain. Now, this loss, no sir, of course, future loss, current loss, we have to consider. Bank account debit 90, loss on issue 10, to debenture 100. No need to create a DPR because debenture will be written at a face value. Now, issued at discount, sir, okay, loss of 10 rupees, redeemed at premium, sir, profit of 20. So can you tell, sir, net profit of 10? The answer is no. Why? Profit is of future. Profit is of future. Ignore this. Only consider this and treat it. Only consider this and treat it. Okay, that is also loss only. Sorry. Premium means that is also loss only. Rupees 20 is the loss. So both the loss you should consider. 30 rupees is the loss. Bank account debit 90. Loss on issue 30. To debenture, how much, sir? 100. To debenture redemption premium is 20. Future premium on redemption. Done. Issued at discount, redeemable at discount. Sir, issued at discount, sir, 10 rupees is a loss. Redeemable at discount, sir, 10 rupees is a gain. Can you set off both, sir? Can you set off both, sir? You can't set off both because this is future gain. So bank account debit 90, loss on issue 10, debenture 100. You should consider only and only loss at the time of issue, not gain at the time of redemption. These journal entry you should keep in mind. Conservatism concept, that's it. Don't need to buy heart. Sir, now, bank is an asset, sir. Yes, we are going to show it in asset side. Debenture is a liability side. Yes, we are going to show in a liability. But whenever you issued at a premium or redeemed at a premium, issued at a discount, redeemed at a premium, that time you treated it as a loss on issue, no sir? Yes. What you are going to do with that account? Is it an asset? The answer is, people, sir, you debited it, so it should be asset, no? The answer is, actually it's not asset, it's a fictitious asset. Why fictitious asset, sir? See, it is only there in the books. Only there in the books. That is not going to give any future economic benefit. Of course, benefit of the debenture is taken till the redemption. No? Benefit of the debenture will be taken till the redemption. So what you are going to do, sir, this loss on issue of debenture, you keep on amortizing it throughout the lifetime of the debenture on the basis of benefits derived. So how you are going to treat this loss on issue of debenture, sir? You are going to write off this loss on issue of debenture throughout the life of the debenture on the basis of benefit derived. See, it is treated as fictitious asset and shall be amortized over the period of debentures based on the benefit derived in that particular period. See, there is an example. Loss on issue is 3 lakhs. Okay, loss on issue is 3 lakh. These are that could be due to issue at discount or redemption at premium, whatever it is. Debenture value is 60 lakhs. Debentures redeemable after 6 years, which means from year 1 till year 6, you had whole 60 lakh rupees debenture with you, which means every year the benefit derived from the debenture is ditto. Yes, sir. So you should amortize it over these 6 years equally because benefit derived is equal. So see there, what you will do, you will take the outstanding debenture. Every year it is 60 lakh. So for this you are going to give the weights. Weights will be same only because everything is same. 1. So total weight comes to 6. So whole 3 lakh you are going to multiply by 1 divided by 6. Weights relating to that particular year divided by total weights. Simple. Sir, bit change. What is it? Loss on issue is 3 lakhs, sir. Same, no different. Debenture is 60 lakhs, sir. Great. Debenture redemption is 1/6, sir. Fine. Now, sir, debentures are redeemed 1/6 every year. So 1/6 of portion of the debenture you are redeeming every year. Moral of the story, people, first year, of course, you had the benefit of whole 60 lakh debenture money, but second year, out of that 1/6, that is 10 lakh has been paid off at the first year end. So second year, you could be able to take a benefit of just 50 lakh debentures. Third year, 40 lakh, fourth year, 30 lakh, fifth year, 20 lakh, last year, just 10 lakh debentures benefit you could take. So based on the benefit, you are going to do the weights. Weights is how much, sir? First year you took the benefit of 60 lakh, so 6. Second year 50 lakh, 5. Third year 40 lakh, 4. Fourth year 30 lakh, 3. Fifth year 20 lakh, 2. Sixth year 10 lakh, 1. So based on this we have given weights. Now whole 3 lakh we are going to divide in this weight basis. That is total weight is 21. 3 lakh divided by 21 into 6 will be the amortization amount for the first year. Second year it will be 5 by 21. Third year 4 by 21. Of course you have to multiply 3 lakhs. Fourth year 3 by 21. Fifth year 2 by 21. Sixth year 1 by 21. Entry will be, sir, of course you are going to write it off against the P&L. So P&L account debit to loss on issue of debentures account. Okay. Sir, when the debentures are issued for non-cash consideration, what you are going to do, sir? Asset account debit to vendor account debit to debenture account, just like shares what we discussed in our earlier part. Issue of debenture as a collateral security, sir. If you issue the debenture as a collateral security, how you are going to treat, sir? We have two methods. Method 1 is no treatment in the books of accounts. Method 2 is giving it a treatment by opening a suspense account. Before that, what is collateral security, sir? First, let's say banker has given you a loan. Now you have to give them security, but you don't have any security. So what you have told, boss, I took loan of 1 crore with you. Yes, I will give you debenture worth rupees 2 crore as a collateral. That is, if at all I am unable to pay your 1 crore rupees, I am going to pay you 2 crore rupees in terms of debenture. Fair enough. So now if at all you issue debenture like this, that is known as collateral security. One more point. These debentures get activated. Only and only when you make a default. Boss, I don't have to pay banker 2 crore if I pay 1 crore in loan on time. I have to pay only if I make a default. No. So debentures activation will take place only at the time of default. So method 1, that is not showing in the books of accounts. What you will show, sir? You will show it as a non-current liability, bank loan. Below that you will show 2 crore rupees debenture issued as a collateral. 2 crore rupees debenture issued as a collateral. You are going to show that way. Just notes to accounts you are going to disclose. However, method 2, what you will do, sir? Normally, the debenture you will get it as a non-current liability. So you are going to credit debenture, debit what, sir? Bank. No, boss, you are not getting any money for that. Sir, bank loan you are getting. No, that is bank to bank loan. That is bank loan money, not debenture money. Now debenture is not backed by any money. So you are going to open one account, fictitious asset called debenture suspense. Debenture suspense. If at all you don't make a default, then both account entry will get ulta. That is, it will become debenture to debenture suspense. Both account will go. If at all you make a default, then debenture suspense will go. Debenture will stay in liability side. Along with debenture suspense, bank loan also will go. Like that it is. Okay. Now, these were when it is issued as collateral. Sir, they didn't ask the method, sir. Method 1, method 2. What you should do, sir? If they ask, pass the entry. Method 2, debenture suspense to debenture. If they don't ask any method, then method 1 is preferred. That is showing it in the notes to accounts. Done, sir. Interest on debenture, sir. That is when you pay the interest to the debenture holders, how you are going to treat it. Before learning interest on debenture, try to understand there is something called as tax deducted at source. TDS. Not tax deducted by Sitaraman. No. Tax deducted at source. Okay. Now, how it works, sir? Simple, people. Let's say we as a company have to pay 10,000 rupees as a interest to debenture holders. What government tells? Listen. Your debenture holder, no, he don't disclose this income with me at all. He's smart. He don't disclose this income. So what you should do? Do one thing. 10% you deduct. Pay to your debenture holder only 9,000 rupees. We are so happy. Why we are so happy? 10,000 rupees interest. We are paying just 9,000 rupees. Wow. Happy. The answer is no. Why no happy, sir? Because government didn't stop here. They told 9,000 you give to your debenture holders. Remaining 1,000 is there, no. What you deducted as a TDS, that you deposit in your debenture with us in your debenture holder's name. This 1,000 rupees, we should give it to government in their name. Moral of the story, as a company, your expenditure is 10,000 only. Either you pay to debenture holder or either you pay to government. Your expenditure is 10,000 only. So people, interest 90% will be given to debenture holders, 10% to the government. We have two methods for it. How, sir? 1. Debenture interest, let's say 100 rupees. 2 debenture holders 90. 2 TDS payable 10. 2 debenture holders 90. 2 TDS payable 10. Now, when you make up payments, debenture holders account debit to bank 90-90, TDS payable to bank 10-10. Correct? Now, when you write off, your expense is 100, so P&L account debit to debenture interest account. This is one method. Second method is what, sir? Debenture interest account debit 100 to debenture holder account 100. Straight away, everything will be transferred as a due to debenture holder. Now, when you are satisfying debenture holder, what you are going to do? Debenture holders account debit 100, In bank, you are going to pay 90. As a TDS payable, you are going to deduct 10. Now, TDS payable to bank 10. However, the second method you ignore. Concentrate on first method. Debenture interest will be split into two parts. As it's expenditure, it will be debited. So debenture interest account debit to debenture holders account. They are our liability now because we have to pay them. Done. To TDS payable, again we should pay to government, again one more liability. Now when you pay debenture holders to bank. When you pay TDS payable to bank. Now when you have to write off at the end of the period, as it's a nominal in nature, expense income you should write off to P&L. You can't keep the balance because those benefits won't be there for more than 1 year. So in the year of benefit itself, you have to knock it off. So you are going to charge it to P&L. Entry will be P&L account debit to debenture interest account. You are going to do this way. So let's see few questions now. Okay. That's it. So many concepts are there in the debenture issue. Let's see few questions and knock it off this particular unit. Amol Limited issued 40 lakh 9% debentures of rupees 50 each, payable on application as per the term mentioned in the prospectus and redeemable at par anytime after 3 years. So issued at par, redeemable at par. So what will be the entry? Bank to debenture. However, they are telling it is payable in application. So what you are going to do, sir? Bank to debenture application. 40 lakh into rupees 50. Debenture application to debenture, just like your share capital only. Debenture application to debenture, 40 lakh into rupees 50. 20 crore, 20 crore. Atul Limited issued 1 crore 8% debenture of rupees 100 each at a discount of 10%. Moral of the story, while issuing you are taking less, which means there is a loss on issue of rupees 10 per debenture. Loss on issue. Done. Redeemable at par. Luckily at the time of redemption there is no loss, there is no gain. Money was payable, 30 on application, 60 on allotment. Now sir, loss where to record, sir? Allotment stage. Correct? So what will be the entry? Bank account debit to debenture. Application account. How much, sir? 1 crore into rupees 30. That is 30 crores. Then debenture application to debenture. 30 crore. Now you have to make the allotment. That is debenture allotment account debit. How much, sir? 60. Correct? How much it is, sir? 60. Loss on issue 10 to debentures 70. Then bank to, see, 8% debenture allotment 60. Loss on issue 10 to debenture 70. Bank to allotment 60. That's it. Okay. Third one, sir. Coinal Chemical Limited issued 15 lakhs 10% debentures of rupees 50 each at a premium of 10%. Issued at a premium, which means gain at the time of issue. How much, sir? Not 5 rupees, 2.5 rupees. Oh, sorry, premium of 10%, no? So 5 rupees. Gain of rupees 5. Payable 20 on application, balance on allotment. Debentures are redeemable after 6 years. All the money due on allotment were called up and received. Record the journal entries when premium money is included in application money. They are telling the premium is included in application money itself. And one more thing. They didn't tell redeemed at par or premium, then it is assumed to be par. Now, you receive application, entry will be bank account debit to debenture application account. How much, sir? 20 into 15 lakh. 20 into 15 lakh, 3 crores. Now, in the 20 rupees, 5 rupees will go towards securities premium. 15 rupees will go towards face value. So entry will be 10% debenture application account debit, 20, per debenture I am talking, 2 debentures like capital only, 2 debentures 15, 2 securities premium 5. 10% debenture 3 crore, 2 debenture 2.25, 2 securities premium 0.75. Now you are going to make allotment, that is allotment to debenture. Later you are going to get a money bank to allotment. Hope it is clear. Look at this fourth one. Modern Equipment Limited issued 4,12% debentures of rupees 100 each payable. Application 30, allotment 70. Moral of the story, issued at par. No gain, no loss at the time of issue. The debentures were fully subscribed and all the money were received. As per the term of issue, debentures are redeemable at rupees 110, which means you have to repay 110 rupees, 10 rupees extra loss on issue. However, as it is relating to the future loss, you are going to create a provision called Debenture Redemption Premium. Okay. See, bank account debit to debenture application account, that is 4 lakh into 30, which will come to 120 lakhs. Later, debenture application to debenture 120. Now you are going to make an allotment. While making allotment, it is 70. That is debenture allotment account debit 280. Loss on issue because I told you already, future loss, but conservatism concept you should consider, and you should create debenture redemption premium for the future loss to debenture face value, bank to debenture allotment. Wait. This is your fourth question. Look at the fifth question now. Look at this fifth question. Agrotech Limited issued 150 lakhs 9% debentures of rupees 100 each at a discount of 6%, which is basically rupees 6. Issued at a discount, which means loss on issue. Redeemable at a premium of 5%. Again, that is a loss. While receiving, you received less money. While paying back, you are paying 5 rupees more. So loss on issue total is 11 rupees after 3 years. So receivable 50 on application, 40 on 4 on allotment. Great. Record a necessary journal entry. Bank account debit to debenture application. How much it is, sir? 50 into 150 lakhs. Debenture application to debenture. Then you are going to make an allotment. 150 into 44. The loss on issue, I told you, 11 rupees. To debenture account, that is face value 150 into whatever 50 rupees it is, and to debenture redemption premium, that is loss on redemption, that is 5 rupees per share. Bank account debit to debenture allotment account. So let's say this thing, we have given a collateral debentures as a collateral security, 14% mortgage debenture at the rate of around, let's say, 1 crore 50 lakh rupees for the loan of 1 crore. Method number 1, you are showing it as a non-current liability, that is long-term borrowings, loan. Below that, loan is secured by the collateral security of 14% mortgage debenture of rupees 1 crore 50 lakhs. Method number 2, bank to bank loan, debenture suspense to debenture. Debenture suspense to debenture. Look at one more question. Company X Limited issued 10,000 debentures of the nominal value 50 lakh rupees. Moral of the story, per share face value is rupees 500 to sundry persons for cash 90% of nominal value rupees 25 lakhs. So it is 22 lakhs 50,000 rupees is issued for this is what received. Face value is 25 to a vendor for a purchase of fixed asset worth rupees 10 lakh, whereas 12 lakh 50,000 is the nominal value. To the banker as a collateral security, 10 lakh rupees, where the nominal value is 12 lakh 50. Pass the necessary journal entry. So your collateral security they are asking as a journal entry. So method number 2. So first one, listen. You are going to issue to the sundry person 25 lakh rupees debenture at a discount of 2 lakh 50,000. So entry will be bank account debit 2250, discount 250, that is loss on issue 250, to 14% debenture 25 lakh. Then you are going to buy a asset of rupees 10 lakh, where you are going to issue debenture of 12 lakh 50,000. So it will be asset account debit to vendor, vendor account debit 10, loss on issue 250, to debenture 1250. Next, you are going to give it as a collateral security. So bank account debit to bank loan 10 lakh, debenture suspense to debenture 12 lakh 50. Okay, listen here, one more question. HDC Limited issues 1 lakh 12% debentures of 100 each at rupees 94, which means loss on issue is rupees 6. Under the term issue are redeemable at 5 years from the date of issue. They didn't tell redeemable at par or premium, so we are going to assume at par. So how much is the total loss, sir? 1 lakh into rupees 6, which will come to rupees 6 lakh. This we are going to write off. How you are going to write off? See, redeemable after 5 years. Moral of the story, every year we are going to get a same benefit. 1 lakh, 1 lakh, 1 lakh into 100 rupees is a debenture benefit. 1 crore, 1 crore, 1 crore, 1 crore. So moral of the story, every year weights are same. So first year it will be 6 lakh into 1 by 5. Second year 6 lakh into 1 by 5. Third year 6 lakh into 1 by 5. Fourth year 6 lakh into 1 by 5. Fifth year 6 lakh into 1 by 5. That's what we are going to amortize it throughout the year of that 5 year. 12th one. HDC Limited issues 2 lakh 12% debentures of rupees 10 each at rupees 9.4. Correct? So issue is what, sir? 10 rupees at rupees 9.4. Moral of the story, 0.6 per share is a, debenture is a loss. So as per the issue, 1/5 of the debenture is drawn every year. So loss is how much, sir? 2 lakh debentures, 0.6, which will come to 120,000. So first year outstanding debentures were how much, sir? 2 lakh into 10, which will come to 20 lakh. Second year, out of this 20 lakh, first year end, we are going to write off 1/5, which is 4 lakh. It will become 16 lakh. Third year benefit is 12 lakh. Fourth year benefit is 8 lakh. Fifth year just 4 lakh. So accordingly, we are going to make the weight 1, 2, 3, 4, 5. Correct? So amount written off will be, based on this proportion only, okay? Amount written off will be 120 lakhs into 5 by 15, 120 lakhs into 4 by 15, 120 lakhs into 3 by 15, 120 lakhs into 2 by 15, 120,000 into 1 by 15. Okay. Outstanding amount of the debenture before redemption in that particular year. Okay. Outstanding amount means before redemption how much it was, not after redemption. Yeah. Done, sir. Next. A company issued 12% debentures of the face value 10 lakh rupees at a discount of 10%. So loss on issue is how much? 1 lakh. Great. Debenture interest shall be calculated on what, sir? Face value. Okay. Debenture interest after deducting a tax at source of 10% was payable on 30th June and 31st December, which means half yearly interest. 6 months, 6 months. All the debentures were redeemable after expiry of 5 years period at a premium of 5%, which means while paying, you are paying more. So total 15% is the loss. 1,50,000 is the loss on debenture issue. That is bank account debit 9 lakh, loss on issue 150, to debenture 10 lakh. Out of this 50,000 is redemption loss. So we are going to create a provision DRP. Now first year interest will be what, sir? Interest will be expense. So interest will be debenture interest account debit 12% of 10 lakh, which comes to 120,000 into 1 by 2 or 6 by 12, because half yearly interest 60,000. To debenture holders, you are going to pay 54,000. As a TDS, you are going to deduct 6,000. Done. Next, debenture holders account debit 54, TDS 6, to bank 60. Next, again we are going to do the same thing. Again we will do the same thing. This is what going to happen. Next, you are going to write off two things here to the P&L. One, loss on issue, which is to be written off. 1,50,000 is loss on issue. That should be written off throughout the life, which is 5 years. So 30,000, that one thing, and interest. Both you are going to charge it to P&L. And debenture interest you are going to pay to debenture holders. Same thing happens for the 5 years. So redemption entry, sir, redemption entry. Redemption entry we will see in the redemption of debenture chapter. Okay. Redemption of debenture chapter. With that, we completed our issue of debenture. There is one special account question here. Listen here. Listen here. The special question, one special question is there that we will do and we'll complete this chapter. So listen here. Z Limited issued 2,500 10% debentures of rupees 100 each at a premium of 10% payable 20 on application, 50 on allotment, including premium. Great. And the balance on first and final call. So 10 rupees is benefit. Yes. The public applied for 3,500 debentures. So we issued 2,500. Public applied for 3,500. Application for 2250 debenture were accepted in full. Wow. Application for 500 were allotted 250 and remaining were rejected. All money was duly received. General ledger transaction. Listen here. 3500 application we received. In the 2250 will get 1:1. Correct. Other 500 will get 1:2. Other 750 will not get anything. So application money is how much, sir? 2250 into 20. 45. 500 into 20. 10,000. 750 into 20. 15,000. Application money allotted to debenture is how much, sir? Straight away 45. In this scenario, you are getting allotted 250 shares, sorry, 250 debentures. Face value of that is how much? 5,000. So remaining 5,000 will be extra. That let it be. Here nothing. So whole 15,000 will be refunded. In this scenario, nothing application money is there. Here 5,000 is there. That is adjusted to allotment. Accordingly, we'll pass the entry. See here. Z Limited issued 5,000 14% debentures of 100 each at a discount of 5%. The discount being adjusted on allotment. Great. The debentures were payable. Application 20. Allotment 25. So discount is getting adjusted over here. 5 rupees. So 30 rupees should be the allotment. Face value of debentures for the stage of allotment. First and final call 50. The debentures were subscribed and money was duly received. Show in the cash book. So see here. First we will receive application money. Then we will receive allotment money. Then we will receive the first and final call. Balance carried on. Cash only what we received. This is the thing. Entry will be debenture application, debenture allotment, whereas 125 is the what we received, whereas 25 is discount, loss on issue. That is it. So in the balance sheet, what we are going to show, sir? In the liabilities, non-current liability, long-term borrowings, 14% debentures, 5 lakh rupees. Loss on issue, 25,000. That's it. Loss on issue. This we are going to write off throughout the life of the debentures. That's it. With that, issue of debenture. Next, we are going for ESOP. Okay. Employee stock option plan. Yes. Now, we are starting with employee stock option plan. Sir, what do you mean by employee stock option plan? Sir, nothing but employee stock option plans are shares of the company issued to the employees at the price less than the market price. So when you issue your shares at less than the market price to the employees, that is known as employee stock option plan. Sir, why less than market price only, sir? Because if it's more than market price, employees can go and buy it in the market, no? Why they will buy it from the company? So usually that will be less than the market price only, and it is the option, not compulsion. It is the option given to employees. That is, after the vesting period, employees can exercise the option or can let go the option. So it is not compulsion, it is an option given to the employees. Either you accept, boss, after your vesting period, or don't. Now the question comes, what do you mean by vesting period, sir? Period in which term relating to vesting to be satisfied by the employees. For example, now if you stay with our company for 3 years, then you are eligible for ESOP, employee stock option plan. Now 3 years is a vesting period. So what do you mean by vesting period, sir? Period in which terms have to be, vesting terms have to be satisfied by the employee. Employee. That is known as what, sir? That is known as vesting period. Exercise period is what, sir? Vesting period is over. That is, let's say 3 years is over. Now we have given 1 year time to our employee. Not 1 year always. Example. Now we are given 1 year time to employee. That is, boss, if you want to buy it or don't want to buy it, that you have to decide in this 1 year. If you want to buy it, you should buy it within 1 year. If you don't buy it within 1 year from the vesting, then your options will be lapsed. You are not eligible for that options. So exercise period is price after vesting period allowed to employees to exercise the option. Exercise price means what, sir? Price at which stocks are offered to employee. For example, face value is 10 rupees, sir. Offered to employee at 30 rupees, where the market value is 40 rupees. Now the price at which we are offering it to the employees, that is 30 rupees, that will be known as exercise price. Now, sir, what is the fair value of option, sir? Market price is 40, we are offering 30. Now this 10 rupees benefit is getting, no, employer, he or she, that thing is known as fair value of the option. That is market value of the shares on grant date minus exercise price. Grant date means what, sir? Date on which options are granted. Today, our annual day. Today we are telling whoever employees stay for next 3 years will be eligible for ESOP. Now today, our foundation day will be grant day. Vesting period, sir. Vesting period. Two things are there. One, it gets over in the same accounting period in which the options are granted. For example, now in the year 2025, if we grant the offer, then let's say 1st of April we granted offer, and vesting will get over on 31st March, which means benefit due to this ESOP will be related only to the year 25. Then this will be known as gets over in the same accounting period, extended beyond the accounting period, that is vesting period, let's say 2 years, which means of course it's not going to be in the same accounting period in which it is granted. So because of this, for example, we told 3 years, no, now employees are staying with us for how many years? 3 years, which means benefit of that ESOP is not restricted to 1 year like this. It will be restricted, it will be there for 3 years. It will be there for 3 years. So how to treat it, sir? If at all it gets over in the same accounting period, which means benefit of ESOP, because you are telling 1 year you stay, boss, you take and go. Now that benefit of that ESOP, employee staying for 1 year, will be there for only 1 year. So whatever the charges, whatever the expense because of ESOP you are getting, write it off that in that year itself. For example, 25-26, in that year only you write off, because that benefit is not there beyond 26. Now in the 2025 you offered, where exercise is going to happen in 2028, which means employee stayed from 2025 to 2028, 3 years. Now people, now that benefit is there for 3 years, so that cost is there, no, employee benefit expense, that you charge it to 3 years in the proportionate manner. That's what it is. See, expense of the ESOP should be written off proportionately in the years of vesting period based on the benefit derived, not on the exercise period. That has nothing to do. Vesting period, in exercise period, whether they stay, they don't stay, nothing matters. Only in vesting period they have to stay. That is a condition, no? Yes. What will be the entry, sir? What will be the entry for the, if it is in the same accounting period, vesting is in same accounting period, only 1 year of vesting or less than 1 year. Let's say the market price is rupees 100. Market price is 100. We are offering to our employees at 40. We are offering to our employees at what rate, sir? 40. Moral of the story, rupees 60 is employee benefit expense, which means rupees 60 is our expenditure for offering at less price. If we offer at market, we will get 100 rupees. Because we are offering to our employees, we are getting 40 rupees. Moral of the story, 60 rupees is your employee benefit expense. So what will be the entry, sir? Bank account debit 40. That's what our employee is giving. At 60 rupees, we are going to treat it as employee benefit expense. To share capital 10. And what is the price? 100. So securities premium is 90. Try to understand. Don't find out a securities premium as 40 minus 10. No way. You should take the market price for computation of securities premium. Correct? Yes, sir. Now, vesting period in the same accounting period, but exercise period in the next year. Vesting period in the same accounting period. That is, this year vesting will happen. This year issue, this year vesting, done. Next year will be the exercise. In that scenario, in the vesting year, what you should do, sir? You should charge that expense to your books. Employee compensation expense account debit 60. 2, you are going to keep it as a provision. Because you know that's an expenditure. You are going to keep it as a provision, that is to ESOP outstanding account. Next year, when they exercise it, bank account debit 40, ESOP outstanding account 60, 2 share capital, 2 securities premium. Sir, instead of this, take it as ECE only, no? If you take it as ECE, for example, vesting is happening in the year 2025-26. Okay. Now exercise period is 2026-27. Now, if you don't consider anything over here, if you consider ECE over here, when the exercise happens, then don't you think the ECE will be charged to this year where the benefit is taken in this year? So when the benefit is taken, that year only you book the expense and keep the provision. If that is not exercised in the same year, then using that provision, issue the shares in the next year. That's it. Okay. Next accounting period, we are going to pass this entry because these are not the expenses. No, this is provision was there. This provision credit balance was there in the balance sheet. Now we debited. This year no expense is booked. Last year employee compensation is booked that you charge to costing P&L. That's it. So writing of entry is what, sir? P&L account debit to EC account. Done. Now, when the benefit is derived for more than one, you can do two things. Method 1, method 2. Method 1 is what, sir? Creating full provision and writing it off every year. So creating full provision and writing it off every year, because in the same example, let's say 60 rupees is the expense. Benefit is there for, let's say, 3 years. Now what we will do, we'll create the expense now. Provision will create now only. And every year we are going to write off 20, 20, 20 for next 3 years. 20, 20, 20 for next 3 years. This is method number 1. Method number 2 is what? First year 20 we will create, second year 20 we will create, it will become 40, third year 20 we will create, it will become 60. That one. Sir, which method we will use most, sir? Method number 2 is the one which we are going to use the most. Okay. See here. Creating provision only to the extent of expenditure in that particular period. See. Method 1. What will be the entry, sir? Employee compensation expense account debit to employee stock option outstanding account. This is provision. This will be used only at the time of issue. So keep it aside. Now this one, don't treat it as an expenditure. This one, don't treat it as an expenditure. Treat it as a fictitious asset. Then what you will do, sir? This year, you are going to write off 20 rupees. P&L to ECE. Now ECE balance is how much? 40. Second year again 20. So now ECE balance is 20. Third year we will write off this 20. That is method number 1. Done. Method number, and next year whenever the issue happens, we are going to use this. We are going to debit this. Done. Method number 2 is what, sir? First year we created 20. Written off 20. Second year we created 20. Written off 20. Automatically here ESOP is getting credited twice. Third year again we created 20. Written off 20. When we issue, we are going to issue like bank account, ESOP outstanding, bank account, ESOP outstanding. Entry will remain same, final entry. Sir, one more doubt, sir. What, sir? ESOP you created 60, sir. Yes. One of our employee told no need. Relating to that is 10 rupees. They didn't exercise the option. Now what you will do, sir? Array, this provision you kept, no. From where you kept this provision? Your P&L say you reduced. From profit and loss you return it off. Which means from P&L you reduce, no. Now add it back to P&L. But not to this year. So add it to general reserve. So what you will do? Outstanding you will debit to general reserve. Basically you are going to transfer unutilized compensation expense. EC means employee compensation expense. You are going to transfer it to general reserve. Done. See here. If any amount is left in ESOP outstanding account due to the non-exercise of option, such amount should be transferred to general reserve. Sir, computing the expenses to be booked, how you can compute, sir? We'll take the year, okay? Okay. And number of options outstanding as on that date we will take. Opening balance of ESOP we will take. We'll find out how much should be the ESOP so far. Then how much should be booked during the year or how much to be transferred to GR we will find out. When you see the question, you will understand. Let's see the question. Shall we? Look at the first question. A company has its share capital divided into shares of rupees 10 each. On 1st April 2021, it granted 10,000 ESOP at the rate of rupees 40. So how much is exercise price, sir? Exercise price is rupees 40. When the market price is 130. Market price is how much, sir? rupees 130. So how much is the value? Value is rupees 90. Value is rupees 90. Great. The option were to be exercised between 15th March 2022 to 31st March 2022. Try to understand. Issued on 1st April 2021 now. Exercise to be done between 15th March to 31st March, which means vesting and exercise both are in the same year. Nothing will be carried to next year. Correct? The employees exercised their option to the extent of 9,500 shares only. Remaining options were lapsed. The company closes its books every year at 31st March. So what is happening, sir? Moral of the story? Moral of the story is nothing but, sir, you are going to create a expense to the extent of rupees 90 straight away. No need to create provision because everything is getting sorted this year only. So bank account debit, your employees will pay how much? 9,500 into 40 rupees, 3,80,000. Employee compensation expense, value is how much, sir? Value is rupees 130, no? Sorry, 90, no? So compensation expense, you are going to book 90 rupees per share. So 9,500 into 90, 8,55,000. 2 share capital, 9,500 into 10, 95,000. 2 securities premium, 9,500 into 120, because face value is 10, market price is 130, 120. It will come to 11,40,000. And this ECE we are going to write off against P&L. Entry will be P&L account debit to employee compensation expense. Peace. Second one. This is nice. We have only few questions in this, right? We have only few questions. We'll discuss. We have just 3 questions. Small 3 questions. We'll discuss now. Not small, of course. So, ABC Limited grants 1,000 employee stock option on 1/4/2020 at rupees 40. So ABC is doing what, sir? Granting ESOP. When? Of how much? 1,000 on 1/4/2020 at the rate of rupees 40. When the market price is rupees 160. Moral of the story, value is rupees 120. Value is rupees 120. Vesting period is 2.5 years, which means vesting period benefit is there for more than 1 year, which means you have to create a provision, etc., etc., etc. Maximum exercise period is 1 year. So after completion of the 2.5 year, they can exercise it for within 1 year of that. Sir, in exercise period, whether you have to book the expense? No, because benefit is taken in vesting period only, not exercise period. They are exercising exercise period. But what the right they got, that is because of vesting period. Done. 300 unvested options lapsed on 1/5/2022. 600 options were exercised on 36/2023. 100 vested options lapsed at the end of exercise period. Pass the journal entries giving suitable narration. Here, remember one thing. In the ESOP, the very important part lies in drawing a timeline. See, 1/4/2020 grant date. 1,000 options were granted. 31st March 2021, nothing has happened. Peace. Correct? Peace. See, 1/4/2020 it is granted. So, 2021, 21-22 full, 22-23, 6 months. April, May, June, July, August, September. Till 6 month vesting period will be there. That is till 30th of 9. From 1st April 2020 to 30th of 9 2022, it is vesting period. Correct? After that, 1 year will be exercise period. This is exercise period. Done? Okay, listen here. So, now what happened in this period, we'll see. 31st March, nothing. 31st March 2022, nothing. But on 1st May, what happened, sir? On 1st May, what happened? 300 stockholders left the company or lapsed it. Let's say they lapsed it. I mean, they left the company before 2.5 years, which means we are not entitled, like they are not entitled for ESOP. We also don't have to give. Now, ESOP option left is how much? 700. Till when? Vesting period. Now, 700 shares are eligible for ESOP. In that, 31st March 23, nothing has happened. Now, on 30th June 23, 600 options were exercised in that exercise period. Remaining how much? 100. 100. What is happening, sir? After 1 year also they didn't exercise, which means it got lapsed. Finally, how much shares got exercised? 600. So how much expense we should book, sir? From the first year, 600? No, the answer is no. Conservatism. Maximum loss. First year, according to you, maximum loss will be relating to 1000 shares. Second year, 1000 shares. Third year, 1000 shares. Fourth year, you got to know, boss, 900, 300 employees left, which means my expense will be max to max 700. Fifth year, you got to know, exercise period, generally I'm telling, you got to know your expense is restricted to 600, like that. So conservatism concept you should apply here. So listen here. See, look at this table, very important. First year, number of options outstanding were 1000. So we'll calculate 1000 into 120 rupees is the value of the option, basically our employee benefit expense or employee compensation expense. But this year how much we should book, sir? We should book out of 2.5 year benefit. This year we are deriving 1 year full because April to March, 1 year. If the stock option is given on 1st October, then we would have taken 6 months, but leave, done. So we should create 48,000 this year. We created 48,000, done now. Second year we went, again 1000 options were there. So already 48,000 balance we already created. Now after second year, total how much should be the provision, sir? 1000 into 120. 2 years got over in the 2.5 years, which means 96,000 should have been the provision. Already 48,000 is there. So this year we are going to book again 48,000. Going to third year, see here, on 30th 9 what is happening, sir? On 30th 9 what is happening, sir? Vesting period is getting over. By the time of vesting period got over, we got to know that max to max it will be 700 shares which is getting exercised. So already provision of 96,000 is kept. Now for 700 shares, maximum how much is required for the 2.5 years? 700 into rupees 120 into 2.5 by 2.5 because 2.5 got elapsed, which will come to 84,000. So 84,000 was a provision required. But how much you are keeping? 96,000. 12,000 extra you kept? No. Just transfer it to general reserve. No more charging in this year, but transfer it to general reserve. On 31st March also, so much only it was, nothing extra, nothing less. On 30th 600 got lapsed. On 30th, that is by the end of exercise period, 600 got exercised. So 72,000 would be the amount required for that, but your balance was 84,000. Moral of the story, 12,000 is extra, charge it to or transfer it to general reserve. First year, see here, we created employee compensation expense to employee stock option plan outstanding. One provision we created. This is an expense, this is a provision, done. We wrote it off to P&L. Entry was P&L to employee compensation. First year done. Second year, again look at the table, 48,000 we created and we return it off to P&L. And provision, if you see, first year 48,000 was there. Next year again 48,000, done. Third year, by the end of vesting, what happened, sir? By the end of vesting, we got to know we have 12,000 excess already. Automatically what we did, sir? 12,000 we transferred it to general reserve. And in exercise period, what is happening, sir? Exercise period, 600 shares are exercised. So bank account debit 24,000 relating to this 600 shares. ESOP, expense is already we kept in the provision. Now reverse that provision. 600 into 120, 72,000. 2 share capital, 600 into 10. 2 securities premium, 600 into 150, because the market price was 160. Correct? Now ESOP actually how much was there? First year we created 48,000. Second year again we created 48,000, 96,000. Third year we debited 12,000, so it became 84,000. In the exercise period we debited 72, which means still credit balance of 12,000 is there, which is of no use. Just transfer it to general reserve. That is ESOP outstanding account debit to general reserve account. Simple. Look at this one. P Limited granted option for 8,000 equity shares of nominal value 10 on 1st October. The grant is given, okay. 2020 at the rate of 80 when the market price is 170. Moral of the story, 90 rupees is the value of the stock. 90 rupees is the value of the stock. The vesting period is 4.5 years. 4,000 unvested option lapsed on 1st December 2022. 3,000 options were exercised on 30th September 2025. 1,000 vested option lapsed at the end of exercise period. So assume exercise period to be 1 year. If nothing is given, assume it to be 1 year. Pass the journal entries. So 1st April 2020, nothing is happened. On 1/10/2020, we granted 8,000 shares. On 31st March 2021, so when is the vesting period, sir? 4.5 years. From 1/10/2020 to 4.5 years is 31st March 2025. Okay. Now on 31st March 2022, 8,000 shares were outstanding. On 1st December 2022, 4,000 shares got lapsed, which means on 31st March 23, only 4,000 shares were outstanding. Next also 4,000 shares were outstanding. Next also 4,000 shares were outstanding. But on 30th 9/25, 3,000 shares got exercised. 1,000 shares got lapsed. What will be the entry, sir? Before that, look at the table. First, from October till March, 0.5 years. So 8,000 were there. So 8,000 into rupees 90. This year only 0.5 to be booked. So 0.5 by 4.5, which will be 80,000 directly. Next year, opening 80,000 is there. Opening 80,000 is there. How many years of vesting period got lapsed? 1.5 year. So 8,000, still 8,000 is the outstanding. So 8,000 into 90 into 1.5. In 1.5 years, how much we should have kept? 240,000. But in first year, we already kept 80,000. So this year, we are going to create again the provision of 160,000. Going to third year, 2.5 year elapsed. But we got to know only 4,000 is the option which can be max to max granted. I mean, max to max exercised. So how much should be the expense should be kept, sir? 4,000 into rupees 90 into already 2.5 years done. So we should have kept 2 lakh. But how much we already kept? 240, which means 40,000 you have to reverse, transferring it to general reserve. 31st March 24, 3.5, 4,000 units. So already 2 lakh balance is there because 2 lakh 40 was there. 40 we transferred to general reserve. 2 lakh is left. How much we should keep? 4,000 into 90 into 3.5 years done out of 4.5 years. So we should have kept 280,000, but we kept only 2 lakh. This year we are going to create 80,000. Next year, 4.5 years got elapsed, vesting period. 4,000 still activated, I mean valid. So how much it will be the expense after 4.5 years? Total expense relating to this is 3,60,000. But till vesting period, how much we kept? 280. So other 80,000 we should create now. Now later 3,000 got exercised. So how much is expense related to that? 270,000. But how much we actually kept? 360. Moral of the story, 90,000 to be transferred to general reserve. Journal entries will fall according to that itself. You can see that once on your own. I will just show it. You can take a screenshot and you can look into that. Okay. See here. 1. Second year. Third year. Fourth year. Simple. The table plays a major role in this kind of chapter. With that, we have completed ESOP. Okay. So we are left with redemption of debenture, buyback, cash flow statement, the master of all the chapter, consolidation, because 10 marks will be from consolidation, one of the easiest chapter. So consolidation, interpretation of results, right? These are the chapters left. Underwriting is also there. We'll take it one by one. So this is all about ESOP. Yes. Now we'll be discussing about redemption of debenture. What do you mean by redemption of debenture, sir? Just like redemption of preference share, where there the repayment will be done to preference shareholders. Here it will be done to debenture holders. Their repayment done due to shares, redemption of preference shares. Here due to redemption of debentures. Okay. So repayment to the debenture holders and cancellation of debenture is known as redemption of debenture. Okay. Sir, can we keep our own debenture as investment? Sir, the answer is absolutely no. Whenever you redeem, you should cancel those debentures. You can't keep your shares and debenture as your own investment. Okay. So you should cancel it off immediately. Okay. How can you do that, sir? One, open market purchase and cancellation. That is, whenever you have extra money, whenever you have that extra reserve in your company, just go to the market, buy your own debentures, cancel it off. Or after certain number of years, you have to repay anyhow, then pay it. What are the different provisions, sir? All the unlisted company other than NBFC, HFC should maintain a DRR to the extent of 10% of outstanding debenture. So all the unlisted company other than unlisted NBFC and HFC should maintain one reserve called DRR, Debenture Redemption Reserve, to the extent of at least 10%. At least 10% of the outstanding debenture. For example, now in our company outstanding debenture is rupees 1 lakh. Then we should create one provision or reserve called Debenture Redemption Reserve to the extent of at least 10,000. At least 10,000. Okay. Also, all listed company. DRR provision is for unlisted companies. Now, all listed company other than the banking company, AIFI, financial institution, and all unlisted company other than HFC and NFC. So this provision, now what I am telling, earlier provision was applicable only and only to the unlisted companies. Now listed and unlisted company should maintain Debenture Redemption Reserve Investment, DRRI, to the extent of 15% of the debentures to be redeemed during that financial year. So out of 1 lakh, let's say during the year we have around 20,000 of debentures to be redeemed. Now at least 15% of this, which comes to around rupees 3,000, we should maintain as a DRRI. We should invest in securities like government securities, etc. We should invest. That is Debenture Redemption Reserve Investment, DRRI. So come on. DRR provision, that is to create 10% of the outstanding debenture. That is applicable to whom, sir? That is applicable to unlisted companies. Now to the listed companies, of course, other than banking, FI, all those financial institution, NBFC, HFC, that you keep aside. Normal companies, listed companies as well as unlisted companies, you have to invest at least 15%. At least 15% of the money which you are going to redeem in this financial year. For example, out of your 1 lakh rupees debenture, if you have to redeem let's say around rupees 50,000 during the year, then you should invest at least 15% of it, rupees 7,500 in the certain securities. Okay. In case of convertible debentures, that is which has the option of converting into other securities, DRR and DRRI should be created to the extent of non-convertible portion. For example, out of 1 lakh debentures, let's say 30% debenture has the option of convertibility. That is 30% debentures can be converted into shares, which means now DRR and DRRI will be calculated on this 70,000, not on whole 10 lakh. Okay. And sir, any company can issue the irredeemable debenture, sir? The answer is no. Max to max, you can issue for 10 years. If you're an infrastructure company, 30 years. Just like preference where maximum was 20 years, here it is 10 years. For infrastructure, it is not changed. Okay, done. At the time of redemption, relevant DRRI should be sold. That is what we should do. You invested now in DRRI. How much you invested, sir? 15% of debentures to be redeemed in that financial year. Need not to do it on the whole debentures. That is DRR. DRR should be created on the whole debenture. But for the sake of DRRI, how much ever you are going to redeem during that period. On that, if you create 15% investment, more than enough. So always remember at the time of redemption, you should sell your DRRI to the extent of creation, to that redeem portion. To the redeem portion, how much ever you created, that you can sell it off. Okay. And just like a normal any investment sale. And if the question is silent, assume it is sold at book value. If the question tells it is sold at some value, then you should sell it at that value. If the question is silent regarding sales, then you should sell it at a book value. And DRR balance will be there now. To the extent of the redeem portion, that shall be transferred to general reserve. So what will be the entry, sir? For the transfer, DRR account debit to general reserve. From DRR we will take it out and we'll transfer to general reserve, because from there only we took it out. No, when creating, what was the entry? P&L to DRR. While creating, entry was P&L to DRR. This P&L is free reserve. So now when reversing it off, entry will be DRR to general reserve. Done. Sir, I told you two options. One, purchase from open market, cancel it off. Two, after certain number of years, cancel it off. Correct? Okay. Now, debentures to be purchased and immediately cancelled against liabilities. So, in open market, what you will do? You will go and purchase in the open market, stock markets, and you are going to cancel it immediately. So, your investment also goes down, your liabilities also goes down. Answer. From open market, debenture can be purchased at X interest price, cumulative interest price, cum interest price. What do you mean by X interest price, sir? Price excluding interest, which means whatever the price is, that is only and only towards the cost. Whatever the price it is, that is only and only towards the cost. When it comes to cum interest, the price includes interest portion also. That is, it will be having cost plus interest. Whereas X interest is the price will be only and only towards cost. For example, now debenture is quoted as 103. Debenture is quoted as how much, sir? 103. Now, if it's a X interest, then cost is 103 only. Upon this, you are going to pay interest to the extent of outstanding portion. Okay, when it is X interest. If it's a cum interest, in 103 only interest could be there. Let's say 1 rupees. Now, cost is just 102, not 103. That is cum interest price. Okay, debenture price will include only cost of the debenture, whereas debenture price will include accrued interest also. Done. So, whole purchase price shall be the cost of debenture. Debenture interest to be calculated separately and to be paid in the addition to the debenture price. So here you will pay only debenture price. Because that includes cost plus interest. Whereas if it's a X interest, it will be only including a cost. So you are not going to take out anything from there. Plus you are going to pay the accrued interest till the time they held from the last day of interest payment. Okay. Debenture price, when it's a cum interest price, will be consist of cost of debenture and accrued interest on debenture. Cost of interest and accrued interest on debenture. How to calculate that, sir? Face value of debenture into interest rate into period from the last date of interest till the date of purchase. So, what is the face value? On that, how much is the interest rate? And from the last day of investment till the date of purchase, what was the period? For example, 1st Jan you purchased. Okay, last interest payment was 30th June. Now, how much interest you should pay, sir? For how many months you should pay, sir? July, August, September, October, November, December. 6 months. Like that it is. Okay. What are the certain journal entries? We'll take a glance at. What are the certain journal entries? See, creation of DRR, pre-reserves account debit to DRR account. Pre-reserves account debit to DRR account, that is for creation. When you invest in DRRI, DRRI is an investment in asset increases, asset debit. That is DRRI account debit to bank. Next, you are going to purchase of debenture in the open market. What will be the entry? Own debenture. You are going to park it in a temporary investment account called own debenture account. You are going to park it in a temporary debenture investment account called own debentures account debit. If at all you paid interest also, of course you should pay interest on own debenture account debit to bank. Interest on own debenture you are going to charge it to P&L, whereas own debenture you are going to cancel it against debenture. You are going to cancel it against debenture. For example, if at all you purchased for 101, your debenture was 100 rupees, then 1 rupee is a loss. 1 rupee is a loss. You are going to book it as a loss on redemption of debenture. Loss on redemption of debenture. If at all the book value is 100, you bought it at a cost of 98, then 2 rupees is profit, that you are going to treat it as profit on cancellation of debenture. Profit on cancellation of debenture. Done. When the debentures are redeemed after the expiry of the period, just like debenture liability will decrease in the liability debit. So debentures account debit, you might have paid a premium on that. So premium on redemption account debit to debenture holders account. To debenture holders account. Interest accrued might be, so entry will be interest account debit to debenture holders account. Interest account debit to debenture holders account. When you pay the money to debenture holders account debit to bank account. And when you sell the investment, entry will be bank to investment. If it's a loss, bank account debit, loss on sale of investment account debit to investment account. If it's sold at profit, bank account debit to investment account debit to investment account to profit on sale of investment account. The money when you transfer to GR from the DRR after the redemption of the debenture, entry will be DRR account debit to general reserve account. DRR account debit to general reserve account. On conversion, sir, on conversion you are going to create or you are going to transfer how much we should pay to debenture holders. Then to debenture holders you are going to issue share capital, you are going to pay cash also. If you issue the shares at a premium, then securities premium will get credited. We'll see the few questions so that quickly you can understand other things. Okay, listen here. The following balances appear in the books of company which is unlisted other than AFI, BFI. This thing, moral of the story, DRR to be created, sir? Yes. DRRI? Yes. DRRS, DRRI, yes. 6% mortgage, 10,000 debenture of rupees 10 each. So we have 10,000 debentures of rupees 10 each. So outstanding debenture is how much, sir? Outstanding debenture is rupees 1 lakh. Outstanding debenture is rupees 1 lakh. Sir, DRR should be created? Yes. How much it is, sir? 1 lakh into 10%. Which will come to rupees 10,000. At least 10,000 DRR should be there. DRRI, sir, depends on how much you are redeeming during the year. Okay, done. DRR is around 5,000, which means 10,000 must have been there. Only 5,000 is there. Other 5,000 you should create now. Investment in deposit with the scheduled bank, free from any charge or lien. So investment in deposit without any charge or lien, investment in government securities, all these are eligible for DRRI and they have done already 15%. Wow. So they did it, even this one they did it on the outstanding only, which means no need to do it every year. Once we had put it, boss, provision is satisfied. Minimum criteria is there, maximum criteria is not there. Okay. And it fetches 4% interest receivable on 30th December every year. Bank balance with the company is rupees 90,000. Interest on debenture had been paid up to 31st December. So interest on December, till what date we have paid, sir? Till 31st December. On 28th February 2023, the investments were realized at par and debentures were to be paid off at rupees 10.1 together with accrued interest. So you are going to pay them rupees 10.1 plus interest. Okay, when, sir? February 28th. Write up the concerned ledger excluding the bank transaction. Excluding the bank transaction, whatever is there now, just write up the entry they are asking. Let's do it now. Okay. See here. Sir, what is the face value of the debenture, sir? 1 lakh. DRR to be created is 10,000. So how much to be created extra? 5,000. DRRI, sir, 1 lakh into 15%, 15,000. First, what we will do, sir? We'll create a DRR. Entry, P&L account debit to DRR account. How much to be created? 5,000, 5,000. Next, on 28th February, we are buying. Before that, we are redeeming, no? So we have to sell our DRRI. They didn't tell anything about selling of DRRI. So we are going to assume that DRRI has been sold at a face value. So 15,000 DRRI. At the same time, bank pays interest up to 31st December. So January and February, 2 months, our money was with banker only. So for that 2 months, interest is not yet paid. So that will be paid at the time of redemption. I mean, at the time of withdrawal of investment. How much it will be, sir? Rupees 15,000 into 4% into 2 by 12, which will come to 100 rupees. So you are going to receive total 15,100, whereas 100 rupees is towards interest, 15,000 towards the investment. So entry will be bank account debit to DRRI to interest on investment. Later, at the same time, you are redeeming. If you are redeeming means you also paid your debenture holders interest on 31st December. Moral of the story, even you have to pay your debenture holders 2 months interest before redeeming it. So how much it will be 2 months interest, sir? 1 lakh into 6%. 1 lakh into 6% into 2 by 12. 2 by 12. Done. So how much it will be, sir? 1,000. Done. Later, what you are going to do, sir? You are going to buy your debentures. You are going to buy your debentures. How much you are going to buy, sir? You are going to buy at 101 or 10.1. Correct? Rupees 10.1. 10.1 you are paying to them. Done, sir. Done. So how much is 10.1, sir? So in 10.1 face value is 10. So debentures to be debited, debenture account to be debited is it 10. 0.1 is what, sir? 0.1 is what you are paying extra premium. So loss on redemption or premium on redemption. So listen here. Debenture 1 lakh, premium on redemption 10,000 into 0.1. Two debenture holders 1 lakh 1,000. Two debenture holders 1 lakh 1,000. Later you are going to pay them debenture holders account debit 1 lakh 2,000. Why 1 lakh 2,000, sir? 1 lakh 1,000 towards debentures and premium on redemption plus 1,000 towards interest. Total I should pay them 1 lakh 2,000. Done. Next, what you will do, sir? You are going to transfer the DRR, whatever is there, to the GR because that is of no use now. That is of no use. Like X has gone. So their memories, what you will do with it? So that's the thing. You are going to throw all the gift, etc., given by them. Same way, debenture is gone. Then there is no point in keeping that reserve. So DRR account debit to general reserve account. Later, you have to write off everything. No interest on investment to P&L will write off. I mean, it will be income. No, so it will be credited. Later, you have interest on debenture. You have premium on redemption. All those things will be written off against P&L. Okay. If you see the account, it will come like this. Opening balance credit because it's a liability and it got out at 1 lakh face value only. Debenture holders interest we credited for 1,000. Face value of debenture 1 lakh, premium 1,100, 1,000. So basically 1 lakh 2,000 we have to pay and we paid to debenture holders. Debenture redemption reserve, if you see, opening was 5,000. We created to the extent of 5,000. Last we have redeemed it. So we transferred it to general reserve. DRRI, if you see, it's a investment, which means asset. 15,000 was there. 15,000 we sold. Interest on DRRI, nothing was there. During the year, we got 100 rupees that we charged to or credited to P&L. Interest on debenture to debenture holders 1000 P&L. Premium on redemption 1000 and 1000 is written off against P&L. Simple. Look at this question. Look at this question. The following balances appeared in the books of Apple Limited, unlisted company, other than AIFI, banking, NBFC. Moral of the story, you have to maintain DRR at 10% of outstanding debenture. Yes, sir. Also, you have to maintain DRRI at 15% of debentures to be redeemed during the period. Debentures to be redeemed during the period. See here. 12% debentures, 75,000 is there. Balance in the DRR, 2,500 is there. So 75,000 into 10% will come to 7,500 rupees. 7,500. But how much you have kept, sir? Only 2,500. Moral of the story, rupees 5,000 to be created extra. Rupees 5,000 to be created extra. DRR investment is 11,250. DRR investment is 11,250. So represented by 10% 1125 secured bonds of Government of India, which means DRRI. So how much you should have created, sir? Let's say full 75,000 only. 75,000 into 15%. Assuming that 75,000 is going to get redeemed, 11,250 full they have kept. No worries. No need to create anything. Done. Annual contribution to DRR was made on 31st March every year. So what we are doing, sir? We are making an annual contribution to Debenture Redemption Reserve when 31st March every year. On 31st March 2023, balance at bank was 75,000 before receipt of interest. Before receipt of interest, it was 75,000, which means after all other transactions. The investments were realized at par for redemption of debentures at a premium of 10%. So what you are doing? Your debentures you are redeeming at a premium at 10%. But your investment you are selling at book value, par, book value. You are required to prepare the following account, which and all debenture account. That will be pretty simple. Opening will be credit side. Now you are cancelling. So 2 debenture holders, it will be in the debit side. That's it. DRR account, credit balance is there. How much is their credit balance? 2,500 credit balance will be there. You are going to create around 5,000 more as a by P&L, and again to general reserve you are going to transfer 7,500. Done. DRRI also not much things. 2 balance bought down is there around 11,250. As it is sold at par, we are going to write by bank 11,250. Done. Bank account not much. Whatever the balance is there, around 75,000 balance is there. So from sale of investment you got around 11,250. To your debenture holders you are paying around see, before receipt of interest, all the transactions are done, which means till 31st March whatever the interest you should pay, that is also done. Only receipt of interest was pending. So how much it will be, sir? Redeemed at a 10%, no? So around 75, 82,500. You are going to show 82,500 as an outstanding, I mean outside this thing. Yeah, that's it. Balance will be there. Done. Debenture holders account. If you open debenture holders account, basically debentures account will be debited, debenture holders account will be created, no? Because we are liable to them. No more debentures are our liability. We are going to reverse it. So debit. So debenture, how much, sir? Debenture value was how much? 75,000. And premium on redemption, premium on debenture was how much, sir? Redemption of debenture 7,500. Around 82,500 we are going to pay them through bank. That's it. See here. Debentures account, balance account is the credit, and we are going to pay it as 2 debenture holders. DRR balance was 2,500. We created 5,000. So 7,500 transferred to general reserve after redemption. DRRI opening was 11,250. During the year we sold it at par. If you sell it at loss also, investment will go at same way, but it will come as buy loss on sale of investment. Bank account balance was there 75,000. Interest on DRRI, okay, that actually see there. DRRI is 11,250 before receipt of interest. Okay, receipt of interest also you have to pass. How much it is, sir? 11,250 into 10%. 1125. 1125 is the interest on DRRI, and DRRI sold 11,250 to debenture holders. You are paying 82,500. So by balance, debenture holders done. These are the certain things. A few questions to discuss. Let's discuss those things quickly. Padapat. Okay. So this is one of the nice question. Conversion question. Okay. See here. ABC Limited has issued 10,000 12% convertible debentures. Okay. Of rupees 100 each, redeemable after the period of 5 years at a premium of 5%. So redeemable at a premium of 5% after 5 years. The debenture holders also had the option at the time of redemption to convert 30% of their holding into equity shares of rupees 10 each at a price of rupees 20 per share and balance in cash. So whatever we have to pay to you, of that 30% you can convert it into shares of the face value rupees 10, but issue price is rupees 20. Issue price is rupees 20. For example, I will tell that you. Now, debenture holders amounting to rupees 2 lakh. Okay. Opted to get their debentures. Sir, but here only 1 lakh is there, no, sir. 10,000 is there, no, sir. Not 1 lakh. 10,000 is there, no, sir. Only 10,000 is there, no, sir. 10,000 debentures of rupees 100 each, which will come to 10 lakhs, not 10,000. Here they are telling rupees 2 lakh, part of it. Get there converted into equity shares. So only out of the 10 lakh, only 2 lakh debenture interest people, like those are interested. Basically, how much it is, sir? Around 2,000 debenture holders are basically interested in conversion. So for them, everything will get right or what, sir? Because 30%, no, sir. 30% was conversion. So in 10,000, 30% means 3,000. So 3,000 debentures will get converted, but applied is only 2,000. So everyone will get converted. No, sir. The answer is no. Try to understand. Out of this 10,000, people are divided into two. One interested people, that is 2,000. One not interested people, which are 8,000. For them completely in cash. To these people, 30% will be in the stocks, remaining 70% of their money in cash. So don't think whole 2,000 gets converted. You are required to calculate the number of shares issued and cash paid for the redemption of rupees 2 lakh debenture holders. Okay. See here, debentures I will take it as 10,000 debentures. Correct. That I will divide into 2,000 and 8,000. Correct. Now 8,000 redemption value is how much, sir? Per debenture it is 105 is the redemption price. 100 rupees face value plus 5 rupees premium. So 8,000 into rupees 105, 8,40,000. So 8,40,000 we are paying through cash. 8,40,000 we are paying through cash. Done. Now this sir, in this 2,000, how much I should pay to these guys? We should pay around 2,10,000. In that 2,10,000, 30% of the consideration will be satisfied through the issue of shares. Other 70% will be through the cash. So to be paid in cash is 147,000. Through shares is 63,000. How many shares to be issued? 63,000 is the consideration to be paid, and issue price is 20 rupees per share. How many shares to be issued? 3150 shares to be issued. Done. Hope you guys understood. XYZ Limited has 5,000 10% debentures of rupees 100 each. The interest on these debenture is paid half yearly on June and December. The company is not maintaining any sinking fund, which means they don't have any DRR. On 1st April 2022, the company purchased 500 debentures at 95, come interest for immediate cancellation. So what is happening, sir? Company purchasing for immediate cancellation outside, I mean open market operation they are doing at the rate of 95, which means in this 95, both the cost is there plus interest is there. Cost is there plus interest is there. On 1/10/22, company purchased 600 debentures of 90 each at X interest, which means rupees 90 is just towards this one, and you have to pay interest. Journalize. Try to understand. I will divide it into two parts. First, 1/4. 500 debentures we are buying at 95, which means this 95 includes cost as well as interest. So 500 into 95 will come to 47,500. Correct? You are investing 47,500. In this 47,500, some portion will be interest, some portion will be cost. How much is interest? How much is cost, sir? Interest will be very simple. 500 into 100, no? 500 into 100 into how many percentage it is? Percentage is 10%. When was the last time debenture was paid? Before 1/4/22? So what they are trying to tell? Debenture interest is paid on June and December. Debenture interest is paid on June and December. So January, February, March. January, February, March. These 3 months interest is due. So into 3/12. This is how we are going to calculate the interest, which will come to 1,250. So out of the 47,500 what we are paying, 1,250 is towards interest, which means towards debenture we are paying only and only 46,250. Okay, this is one thing. Next on 1/10/22, 600 debentures are purchased at 90 excluding interest, which means straight away whole 90 rupees is cost. Interest will be how much, sir? 600 into 100 into 10% into 3/12, because try to understand, 1st October we are purchasing. Last interest was paid when, sir? June 30th. So July, August, September, October, November, October we are purchasing. So July, August, September, 3 months. So 3 months interest 1,500. Total we have to pay them how much? 55,500. Done. So in this kind of question, just draw a timeline and try to understand. 1/1, there was outstanding debentures for 5,000. On 1/4, 500 debentures got cancelled. On 30th/6, you have to pay the interest. You are going to pay the interest on how many debentures, sir? Just 4,500 debentures. Just 4,500 debenture. Why is it so? Why is it so, sir? Because 500 debentures were there only till 1st April and we already paid interest till 1st April. Gone. Other 4,500 was there for 6 months. We are going to pay the interest for 6 months. On 1/10 again, 600 debentures got cancelled. So interest will be paid for the remaining 3,900. Done. Here. First, 1/4. Own debentures we are purchasing. So towards debenture, towards investment, you are paying 46,250. Other 1,250 is towards interest. So to bank. Later, immediate cancellation. So debenture face value will be debited. Investment is 46,250, which means around 3,750 is profit on cancellation. On 30th, interest comes, interest payment, that is only for 4,500 shares for the 6 months. Again 1/10, we are purchasing our own debentures at the rate of 54,000 plus interest we are paying, interest on debenture to bank. Now debenture cancellation, debenture of 60,000 you are cancelling with debentures of 54,000, which means 6,000 is profit on cancellation. And 31st December, again you are paying them interest on debentures to bank, 19,500. Now at the end of the year, you are going to charge your interest on debentures to the P&L and you are going to transfer or credit your profit on cancellation to the P&L account. Simple. If you draw like this and all, and if you do like this, it will become very easy. No need to get confused with your institute material. They have done something else only. So you should neatly draw these timelines or this differentiation, all these things. Okay. That was open market. That was open market. Last one question is there. Let's see. Okay. Last one question is there. Let's see. Okay. Listen. Sugandha Limited issued 10,000 12% debentures of rupees 100 each on 1st April 2021. Interest is payable on 30th September and 31st March every year. On 1st July 2022, company purchased 1,000 of its own debenture at 96 X interest as investment. They can't keep it as investment. They should immediately cancel. Your study mat, they given this question, but I solved this question as a basis of immediate cancellation. You can't keep your own securities as an investment. Company law Act tells. On 1st January 23, company purchased again 2,000 of its own debenture at 96 cum interest. Immediately, the company cancelled all its own debentures and books closed on 31st March. So, try to understand what is happening. 1st April 2022, outstanding debentures were how much, sir? 10,000. Great. On 1/7, what happened? 1,000 debentures you bought at 96 rupees, excluding interest, X interest price. 30th 9 interest payment. 2,000 again you bought. Okay, listen. First, on 1/7, purchase of 1,000 debentures at 96. So cost is how much, sir? 96,000 only. Why, sir? Because it is X interest price, excluding interest price. Done. Interest is how much, sir? 1,000 into rupees 100 into 12% into 3 by 12, which will come to 3,000. Next, again you purchased at cum interest. Now here you paid 192,000. In that, how much towards interest, sir? You are paying, purchasing on 1/1. Interest payment dates are 31st March, 31st March and 30th September. So last interest payment was in September. So October, November, December, 3 months. So that is 6,000. Out of 192,000, 186,000 is towards cost. First, you purchased your own debentures, 96,000. You paid interest of 3,000 additional to that, total 99,000, and you cancelled 1 lakh debentures. So entry will be 1 lakh debenture account debit, 2 own debenture investment, basically 96,000, 2 profit on cancellation 4,000. Again, you paid a interest on debenture on how much, sir? 10,000 was there, but 1,000 got cancelled immediately. So only on 9,000 you will pay for 6 months. Again, on 1st January, you are purchasing own debentures at 186,000. Interest is 6,000. Bank is 192. That is what you are paying. In that, you are cancelling 2 lakh debenture at only investment of 186. Moral of the story, 14,000 is the profit. And 31st March, again for the remaining, that is around 9,000 were remaining. In the 2,000 you redeemed. So around 7,000 is remaining. On that, you are going to pay the 6 months interest. And you are going to charge your interest to the P&L, and you are going to credit your profit or loss on sale of investment to your P&L with that redemption of debenture. Okay, so only few chapters are left now, but very, very, very important chapters like cash flow statement, like your consolidation, interpretation. That is basically easiest chapter, but still you will get it in the examination. Very easy scoring like chapter. These few chapters are remaining, like buyback is remaining, right? Underwriting is remaining. These are the 5 units remaining. We'll complete it. Okay. This after your exams, full party sir. Yeah. Yes. So we'll see that now. Remaining things. Okay. Yes. Now we'll be starting with underwriting of securities. Sir, what do you mean by underwriting of securities, sir? Where company issues shares, they should satisfy with the minimum subscription criteria. Correct? Yes, sir. Now they are scared. They are scared whether they will be able to do it or no. So what they will do is they will kind of enter into underwriters an agreement where underwriters will agree that, boss, don't worry. First let's public buy. First let public buy. If at all they don't buy, don't worry, we are there. We will buy it for you. So that process is called as underwriting. So it is agreement under which underwriters agrees to subscribe the securities of the company if the public won't subscribe for it. If the part is underwritten, I mean whole guarantee they are not giving. Max to max up to 10,000 units we will give you a guarantee, boss. Up to 10,000 shares we will give you a guarantee. Now this is partial, whereas completely underwritten means, complete underwriting means where complete 100% of the shares we are giving a guarantee. If they don't buy even a single share also, we are going to buy 100% of your share. That is complete underwriting. So if part of issue is underwritten, such underwriting is known as partial underwriting. If the full issue is underwritten, such underwriting is known as complete underwriting. And remuneration for underwriters is what, sir? Remuneration for underwriters is known as underwriters commission. Underwriters commission. Maximum commission how much you can give, sir? As per AOA, it will be mentioned in AOA, or in case of debenture 2.5% of issue price. In case of shares 5% of issue price, whichever is lower. Let's say shares, in AOA they mentioned it as 4%. In your as per provision it is 5%. Minimum of this, that is they can give 4%. In AOA 6%, then they can give maximum 5%. Minimum of these two will be given as a commission. In case of debenture it is 2.5%. How to calculate the commission, sir? Commission to be calculated as number of securities underwritten into issue price into commission percentage. So, sir, let's say public subscribed in full. Public subscribed in full. So, underwriters exercising 0 option, or you can tell underwriters underwriting 0 shares. Now, their commission is how much, sir? The answer is their commission is 0, no, sir? The answer is no. Why? Because you are giving commission for them taking a risk. Boss, let's say you issued 10,000 shares. Public subscribed 10,000 shares. But when you issued, your underwriters took the risk on whole 10,000 shares, isn't it? Yes, sir. Yes, sir. Then don't you think underwriters, this 10,000 on this day you should give a commission irrespective of the exercise or no, because they are taking risk, you are giving a reward for the risk. So commission will be given irrespective of underwriters purchasing shares or no. Okay. Application which bears the stamps of the underwriter is known as marked application. Where underwriter's stamp is not bared, that is known as unmarked application. Okay, sir, how to compute the underwriter's liability, sir? How to compute underwriter's liability? Pretty simple, people. Gross liability will calculate, that is how much they agreed for. From that we will take out a marked application, because those applications are coming in their name, automatically that reduces their liability. Now something will be left. From that, unmarked application will be taken out. Unmarked application will be taken out. Unmarked application means general application. Unmarked application means general application where benefit is given to all the underwriters in their respective gross liability ratio. Okay, sir. After that, certain underwriters might get a negative liability. Negative liability means company should pay them, sir. That is not possible, no. So what you should do is such extra credit will be there, no, with some underwriters, that will be distributed again to underwriters with a positive liability. Okay, that is minus credit from the underwriters who has a excess application. You will find out a net liability. That is, if any underwriter's liability becomes negative at any stage, then give the credit of the same to the underwriters whose liability is positive in their which ratio? Gross liability ratio. Okay, sir. Done. Shall we see a few questions? Yes. Listen here. Sunflower Limited issued 50,000 equity shares. Okay. The whole of the issue is underwritten by red 40%, white 30%, blue 30%. Application for 40,000 shares were received in all, out of which application for 10,000 shares had the stamp of red, 5,000 had the stamp of white, 10,000 had the stamp of blue. This is talking about marked application. 40,000 application is received. In that red how much, sir? 10,000. Okay. White how much, sir? 5,000. And blue how much, sir? 10,000. So around 25,000 is marked. Moral of the story, 15,000 is unmarked. Now, is there any other liability? Company liability is there. For example, they have underwritten only 90%. Let's say 45,000. Now, other 5,000 is company liability. No. Now, unmarked application first will be treated as companies marked. So, out of this 15,000, 5,000 will be adjusted first towards company's liability. Remaining 10,000 we will give a credit like an unmarked application. That point you should keep in mind. Okay. Whenever the company liability is also there, then first treat unmarked application just like company's marked application. Then extra is there, then you give credit to these people. Okay. The remaining applications for 15,000 shares did not bear any stamp. Determine the liability of underwriters. Gross liability is how much, sir? 50,000 has been issued. The ratio in which they took is 40-30-30, which is basically 20,000, 15,000, 15,000 minus marked application 10, 5, 10. So balance is 10, 10, 5. Now the 15,000 credit is there. That will be given to the red, white and blue in their respective gross liability ratio. That is 4:3:3. So 15,000 into 4/10, 15,000 into 3/10, 15,000 into 3/10, 6,000, 4,500, 4,500. Net liability is 4,000, 5,500, 500. Like this, we are going to calculate the liability of underwriters. See here, one more question. Monlit issued 50,000 equity shares, of which only 60% was underwritten by the green. So out of 50,000, only 30,000 is underwritten, which means 20,000 is with the company. 20,000 is the risk of the company. Yes, sir. So what? So nothing. Listen here. Application for 45,000 shares was received in all, out of which application for 26,000 were marked. So 45,000 received, in which 26,000 is marked. So around 19,000 is unmarked application. Ma is marked application. Umma is unmarked application. So 19,000. Now try to understand this 19,000 first shall be treated as Ma of company. Before treating it as Umma, you should treat it as Ma of company because company has the liability. So listen here. What we are going to do, Green and Co. Gross liability 30, 20. Treat it as Ma of company. Unmarked. So 26,000, 19,000. Net liability 4,000, 1,000. That is, try to understand here. Whenever it's partial underwriting, first adjust unmarked application towards the risk taken by a company like its marked application. Liability of green is net 4,000. The answer. Goods Earth Limited issued 30,000 6% debentures of rupees 100 each. 60% of the issue was underwritten by black. So how much it is, sir? 18,000. Application for 28,000 is received by the company. So now 28,000, they are not telling how much is marked, how much is unmarked. Now this also you are going to divide it in the ratio of their liability. If they don't give how much is marked, how much is unmarked, divide it in the ratio of their liability, just like any other unmarked application. So gross liability was 1812. Share of unmarked application in the ratio of 60:40 or 6:4 is 16,800, 11,200. So net liability of black is 18 minus 16,800, 1,200. Satellite Limited issued 12% 10,000 preference shares. The issue was underwritten. Apple 30, mango 30, orange 20. Moral of the story, partial underwriting. How do you know, sir? 30 plus 30, 60, 60 plus 20, 80. 100% is not underwritten, only 80%, which means company is also taking risk. Applications for 8,000 were received by the company in all. So try to understand, it is not marked applications now. It is Umma. Now when completely it's Umma, everyone should share it in the GL ratio, including company. Okay. Sir, but you told when company has liability, Umma is first, company is Ma. That is when marked application is also there. When there is no marked application at all, Umma should be shared by everyone. Now, GL 3000, 3000, 2000, 2000 gross liability minus Umma in gross liability, 8,000 into 30%, 8,000 into 30%, 8,000 into 20%, 8,000 into 20%. Net liability 600, 600, 400. Net liability of apple, mango and orange is 600, 600 and 400 respectively. Done. Now, firm underwriting is there. What do you mean by firm underwriting, sir? Where the underwriters are partnership firm, they are known as firm underwriting. The answer is no. Here firm means standing. Yes, boss, I am going to do that. Firm in their decision, like that. So here where underwriter firmly tell, boss, listen, whether your public might subscribe, public might not subscribe. I need 1,000 shares of your company for myself. Whether liability comes, liability don't come, that you leave, secondary. But I need 1,000 for myself. I want to keep a shares of your company. Now, this kind of decision is known as firm underwriting. See, underwriters agreeing to subscribe certain predetermined number of securities, irrespective of securities subscribed by the public. When underwriters agreeing to subscribe certain predetermined number of securities, irrespective of securities subscribed by the public, is known as firm underwriting. Firm underwriting, you can treat it two ways. Basically, firm underwriting applications are there, no? That you can treat it two ways. Where firm underwriting applications are treated as marked application, they are treated as unmarked application. When it is treated as marked application, boss, what you should do? Gross liability minus marked application, including firm underwriting. Including firm underwriting, you should take out the liability. Okay. Then balance you will get from that unmarked application share you take out, excess share you take out, you will get net liability due to only public. Net liability due to only public. For that you add firm underwriting. Because you have to take under firm underwriting irrespective of your liability is there or no. First what we tried, boss, for the public, how much is my liability? Public, how much is my liability? I did that. Then I added my liability towards firm underwriting because I have to purchase it. If the question is silent, this method shall be preferred. That is firm underwriting treated as MA. Second method is what, sir? Gross liability minus marked application. But here don't treat firm underwriting as marked application, which means only marked application from the outsiders. That shall be treated as marked application, not the firm underwriting. Then reduce the unmarked application. But here while reducing unmarked application, treat firm underwriting as unmarked application. Then last you will get how much is the liability towards the public not subscribing it. For that add the unmarked under firm underwriting, you will get a net liability. Done. Sir, what will be the entry, sir? Underwriter's commission will be our expense. So underwriter's commission account debit to underwriter's account. Then these underwriters have to pay us for the shares they subscribe, if at all they subscribe. That is underwriter's account debit to share capital to securities premium. I mean, instead of bank, we are keeping their balance. Why, sir? Adjustment could be done, no? Later. Let's say underwriter has to pay 1 lakh. We have to pay them 20,000. Net what we will do, sir? We'll write it as underwriter's account debit to bank account 80,000. whether they have to pay, then bank account debit to underwriter's account. Look at this question, 8th one. MS Limited issued 40,000 shares which were underwritten as 24,000 P, 10,000 Q, 6,000 R. The underwriters made application for the firm underwriting as follows. Along with this, they are making a firm underwriting. How much, sir? 3,200, 1,200, 4,000. How much is the total firm underwriting? 8,400. The total subscription excluding firm underwriting, including marked application, is 20,000. Other than this 8,400, they got 20,000 application including marked application. Marked applications were how much, sir? Out of 20,000, 4,000, 8,000, 2,000, which will come to 14,000. Which means 6,000 is UMA. Correct? So, listen here. Liability 24, 10 and 6 minus marked application including firm underwriting. How much marked application received? 14,000. Correct? 14,000. Of P how much? 4,000. Also we should add treat marked application of firm underwriting. How much it is? 3,200. 7,200. For Q, 8,000 is marked application. This thing is 1,200, 9,200. For R, 2,000 and 4,000, 6,000. Done. From that, unmarked application, how much is that, sir? Unmarked application is 6,000. But see here carefully, R already liability is gone. R liability is already gone. But firm underwriting he has to take. That's there. Public towards liability is there. No. Then unmarked application credit again you giving to R. Again it coming negative. Again you giving it to P and Q. Instead of so much drama, don't you think you can give it just to P and Q in their ratio? Yes, sir. Which ratio? 12:5. That is 24:10, 12:5 ratio. Done. Now what happened, sir? Again, Q also got negative. This negative credit shall be given to P. So net you can tell liability due to public not subscribing is 11,600 plus those people doing firm underwriting is 3,200, 1,200 and 4,000, which will come to 14,800, 1,200, 4,000. Okay, done. Now let's treat the same question under firm underwriting, not treated as marked, instead it is treated as unmarked. Then what you should do, sir? Liability minus marked application but excluding firm underwriting, you will get unmarked application credit including firm underwriting. That's the difference. So liability was 24, 10 and 6. Marked application you should reduce but excluding firm underwriting, which is 4, 8 and 2. Balance you got 20, 2 and 4. Unmarked application but including firm underwriting. Unmarked was how much, sir? Unmarked we computed here, no? Unmarked was 6,000 but including firm underwriting 8,400. That is 14,400. Now you should divide this 14,400 to these parties. Now what happened, sir? Q got negative 1,600. Q got negative 1,600. Now that should be distributed among P and R in their ratio. That is 24,000, 6,000. That is 4:1. 4:1. Now when you divide it in the 4:1, it became 1,280 and 320. So final balance towards public is 10,080 and 1,520. For that, add the firm underwriting because you have to firm underwrite. That's what you told earlier. You are going to buy it, whatever the situation. So these are the net liability. See here. Last question we'll do in this. Sam Limited invited application from public for 1 lakh equity shares of rupees 10 each at a premium of rupees 5. Okay. The entire issue was underwritten by the underwriters Anita, Babita, Chavi, David. 4 underwriters are there in the ratio of 3:3:2:2. With the provision of the firm underwriting of 3,000, 2,000, 1,000, 1,000 shares. So they have a firm underwriting also. How much, sir? 3,000, 2,000, 1,000, 1,000. The underwriters were entitled to the maximum commission permitted by law. Okay, great. The company received application for 70,000 shares from the public, out of which application for 19,000, 10,000, 21,000, 8,000 were marked in favor of Anita, Babita, Chavi and David. So how much is a marked application? 19 plus 10, 29, 29 plus 21, 29 plus 21, 50 plus 8, 58. Out of 70,000, 58,000 is marked application. Uma is how much, sir? Uma is 12,000. Calculate the liability of each one of the underwriter. Also ascertain the underwriting commission at 2.5% payable to the different underwriters. So they are telling that commission is 2.5%. Okay, no worries. Earlier they told it do it as per law, but now they are telling 2.5. That's fine. General gross liability is how much, sir? 1 lakh divided into 3:3:2:2, that is 30, 30, 20, 20 minus marked application excluding firm underwriting, because we are treating firm underwriting as a unmarked application. So how much it is, sir? 19,000, 10,000, 21,000 and so. So C already got a negative. Chavi already got a negative. Her credit let's give to Anita, Babita and David. Now after that the balances are like this. Minus unmarked application. Again don't give it to Chavi. Only give it to Anita, Babita and Chavi and David. Sorry, Anita, Babita and David in their gross liability ratio. That is 3:3:2. Once it is done, you will get some amount. For that, add the firm underwriting, you will get a net liability. See here, commission, how much we should pay, sir? On the basis of the risk they have taken. 30,000, 30,000, 20,000, 20,000. Price is 15 rupees. Always remember, only dividend, interest, etc. would be calculated on the face value. But when it comes to underwriting commission, it is calculated on the issue price. 15 rupees into 2.5%. 30. So we found out their commission. Now try to understand. Underwriters commission 37,500. We should pay total 37,500 to underwriters as a commission. To Anita 11,250, Babita 11,250, Chavi 7,500, David 7,500. Now how much these idiots have to pay to us? Anita's liability is towards 6,500. She should pay 6,500 into 15. Babita 14,500 into 15. Chavi 1,000 into 15. But Chavi was 0, no sir. Firm underwriting was there, no. That you have to take towards liability of public 0. David have to pay us so much. To equity share capital, how much, sir? 6,500 plus 14,500 plus 1,000 plus 8,000 into 10. To securities premium 30,000 into rupees 5. Then we are going to check. To Anita have to pay us 97,500. We have to pay her 11,250. So she will pay us 86,250 like that. With this, we have completed underwriting of securities. Not much difficult topic, very easy topic, but 5 marks usually they are giving it all the time. So please concentrate on all these topics, which is going to help you out in clearing your examination. Okay. So with that, underwriters topic is done. Now we are left with very few topics where are 2 big chapters are still there. That is cash flow statement and consolidation. Cash flow and consolidation is still there. Let it be. Other than that, ratios are remaining. Buyback is remaining, right? And interpretation is remaining. For interpretation, we have to find out, like we have to complete cash flow first, then we should go to interpretation, because their forecasting of cash flow is also there. That's it. Now we can go for next unit, that is ratio analysis. Of course, we are not going to discuss so many questions and all. We are going to look into these ratios very quickly, because it's a formula based. Not much things are there. You should remember the formula. That's the option left. Okay, I don't know why they have given it in corporate accounting instead of financial management, but still, let's see. Now we'll start with ratio analysis. Yes, now ratio analysis. So basically people, we are going to discuss about 4 different kinds of ratios here, like liquidity ratio, solvency ratio, turnover ratio, profitability ratio. Liquidity ratio means what, sir? Your ability to pay the current liabilities. Immediate liability will be there, no? Current liabilities which are required to be paid within 1 year. That kind of liability, how much ability you have to pay? That is your liquidity ratio. First one under that is current ratio. Here it is how much current asset you have compared to current liability. How many times you have current asset when compared to current liabilities. That is current asset by current liability. Ideal ratio is 2:1. Liquidity ratio is different, liquid ratio is different. Okay. Under liquidity ratio, liquid ratio is there. What is it, sir? Liquid asset divided by current liabilities. That is, current asset will be there, I agree. But in that, inventory will be there, some prepaid expense will be there. All these items, all these inventory, prepaid expense and all, people, advance tax, you can't encash it immediately. You can't encash it immediately. It takes time. So excluding this, all other asset will be there, no, cash and cash equivalent, etc. So using that, how many times you have that kind of asset compared to current liability? That is, liquid asset by current liability will be liquid ratio. What is the formula for liquid asset, sir? Current asset minus inventories minus advance tax minus prepaid expense. Current asset minus inventory minus advance tax minus prepaid expense. Ideal ratio is 1:1. Then we have cash ratio. That is, cash and cash equivalents, how much you have compared to current liabilities. Okay. So accordingly, they have given few questions, you have solved it. Going to leverage or solvency ratio. Here, long-term point of view. Debt equity ratio, that is how much long-term liability you have compared to your net worth or shareholders fund or your equity. Equity means net worth or shareholders fund. What is net worth, sir? Total asset minus total liabilities. Total asset minus total liability will give you net worth. So how much debt you have when compared to equity, capital. Debt to capital employed is, capital employed means not only your capital, what and all you have invested. Basically you invest what you get from the, in terms of capital, that is shareholders fund, plus you will take the long term loan also, no? Long term loan also, no? That will also be considered as a capital employed. Okay. So long term liability divided by capital employed will give you debt to capital employed ratio. Interest coverage ratio, that is EBIT. Before giving a interest, how much revenue you have? It is more than 1 or no? It should be more than 1. Otherwise, it meant to that from your revenue you are unable to pay even your interest. After earning, that is operating income, using your operating income, you are unable to pay off your interest, if at all it is not 1. Interest coverage ratio. Okay. Fixed cost coverage ratio or fixed charges coverage ratio, that is EBITDA, that is before depreciation and amortization, divided by principal payment of the loan plus interest after tax. Okay. These are the certain ratios you have to keep in mind. We are not going to discuss much about it now. So we see here now, introduction to accounting done, introduction to corporate accounting done, standard cost, of course accounting standards I told we are not going to discuss. Accounting for share capital, in that bonus done, issue done, redemption done, buyback is pending, correct? Buyback is pending. Going to debentures, issue and redemption, both are done, great. Related aspects of the company, underwriting is done, ESOP is done, the other one is buyback itself. That's these two chapters are like related. I don't know why they did separately, right? Again they are giving the same things again and again. Consolidation is pending. Financial statement analysis is nothing but ratio analysis. That's what we have seen just now. Cash flows is pending. Forecasting of financial statement is pending. These two are the remaining things pending. Okay. Basically, forecasting is nothing but they will give something, you have to add, minus, you should do that thing. That's it. Okay, we'll do one thing. Forecasting will complete now, except forecast of cash flow. Except forecast of cash flow, forecasting will do right now, and will be left out with only buyback, consolidation, and cash flow statement. Okay, we'll go to the last chapter. I'm going to use the illustrations only. For this one, interpretation, that is forecasting, I'm going to use the material itself, institute material itself. What do you mean by forecast, sir? Nothing, interpreting what might happen in future or forecasting what might happen in future. In this kind of questions are pretty simple, where whatever they give, you have to apply that. That's it. For example, few cases we'll see. You are a company secretary assigning a task of profitability projection of different scenarios. Okay. Right now you have this one, historical data. Revenue, variable cost is 60% of sales. Fixed cost you have, depreciation you have, tax you have, cash flow from operations you have. This has nothing to do. Net cash flow you have. This has nothing to do. Company is forecasting that sales will increase by 37.5% approximately, keeping in mind market forces, whereas variable cost will forecast at 56% of sales. Earlier 60%, in future it will be 56%. Company is in anticipation of having fixed cost of 15 crore. So fixed cost will become 15 crores. On the other side, that is worst. If it is optimistic, this will happen. If it's a pessimistic or negative, what might happen, sir? Company is forecasting that sales will curb by 25%. Whatever is there now, from that 25% will be reduced. Variable cost will become 65% from 60. Company is in the anticipation of fixed cost of 25. It is forecasted that depreciation remain unchanged in case of any scenario, and tax applicable is 28.57. Tax applicable is 28.57. See, I will tell you one format. Keep that thing in mind. Sales, okay. From that, when you reduce variable cost, you will get a contribution. You will get a contribution. From that, when you reduce fixed cost, you will get a profit. From that, when you reduce tax, you will get a profit after tax. This format, of course, in FM you have learnt all these formats, but still. So, sales is how much, sir? Two situations are there. One is optimistic, that is being positive. One is pessimistic, being negative. So, optimistic, pessimistic. Optimistic, what happens, sir? Sales from 200, it will go 200 plus 37.5%. Sales will be 200 plus 37.5%. It will become 275. Sales will become 275. But if it is pessimistic, then sales will curb by 25%. So 200 minus 25%, which will come to 150. Variable cost is how much, sir? Variable cost, in first scenario, they are telling it is 56% of sales. So 275 into 56 percentage, which is 154. Correct? Whereas in the second scenario, it will become 150 into 65%. 97.5. How much will be the contribution? In first scenario, contribution is 275 minus 154, which will come to 121. Next it is 52.5. Fixed cost, what they are telling, excluding depreciation and depreciation. Okay, I will write both together. Fixed cost in first scenario, how much it will become, sir? In first scenario, it will be 15 crores. So this will become 15 crore, irrespective of this, depreciation remains same. So in first scenario, it is 40. In first scenario, it is 40. Next one, it will become 25. Anyhow, depreciation remains same. So next scenario, it is 50. Profit is 81, 2.5. Tax is how much, sir? 28.57. So 81 into 28.57 percentage, which will come to 23.14. Correct? In next, it is 2.5 into 28.57 percentage, 0.71. Now, how much is the profit after tax? 81 minus 23.14, which will come to 57.86. Next one, it is 2.5 minus 0.71, which will come to 1.79. Simple, sir. Whatever they have given, that you have to apply. That's it in this chapter. See here. From the following balance sheet, you are required to forecast the cash flow. Cash flow, let it be. Cash flow I will explain you after I explain you the cash flow statement. Balance sheet will go. From the following balance sheet, you are required to forecast the cash flow. Same question they have given, just do it as a balance sheet. Okay. What is happening, sir, here? The projected P&L they have given. During the year, company has forecasted to raise a secured term loan of 20 crores and repay the previous loan of 5 crore and increase unsecured loan by 10 crores. So try to understand what is happening. During the year, company is planning to raise a secured loan of 20 crores. So right now, how much is there? 80 is there. So what company is planning, sir? Raise it by 20, which means it will become 100 crore and repay 5 crore. Repay 5 crore. So when you repay 5 crore, how much it will become? It will become 95. It will become 95. Also, during the year, 20 is a retained earnings. 20 is a retained earnings. Where does the retained earning go? Reserves and surplus. So reserves and surplus will become how much, sir? Plus 20, which will become 40. Reserves and surplus will become 40. It is forecasted and increase unsecured loan by 10 crores. So unsecured loan from 50, they have given this line twice, okay. That's why I love the institute material very much. It will give work to your brains. First you should correct the question, then you should write the answers. So unsecured loan, it won't be a 50. We are going to increase it by 10 crore, which means it will be 60. Done. It's forecasted that current liability and provision remains unchanged. While the company is planning to buy a fixed asset worth rupees 30 crores, so they are planning to buy a fixed asset worth rupees 30 crores. Listen here. 180 is there. Try to understand. 180 was there. Already future depreciation we planned was 20. So from 180, 20 will go out as a depreciation. And also we are planning to buy 30 crores ka asset again. So around 190. Fixed asset will become 190. And increase the inventory and receivable by 10 and 15. Increase the inventory and receivable by 10 crore and 15 crore. Inventory will be 90 crore. Receivable will be 95 crore. Done. Next, company's projection of paying a dividend of 10 crore. So that is there already. That I excluded and I have taken. Assume other asset would remain unchanged except cash. So cash will be the balancing figure now. Cash will be the balancing figure. So liability will be how much? 140, 235, 295, 385, 385, 405. This side also, if it's 405, 190 plus 90, 280, 280 plus 95, 375. 375 means cash should be around 30. See here, this so much. This has become 40 now. Reserves became 40. Secured loan became 95. Yes. And unsecured loan became 60. Unsecured loan became 60. Yes. Then current liability and provision remained same, 90 and 20. 90 and 20. Yes. Next, going to asset. Fixed asset became 190. Fixed asset became 190. Correct. The depreciation point you should never forget. Please mark it as last minute revision question. Cash, it became 30. Balancing figure, we took cash as balancing figure, 30. Yes. Next, inventories 90. Inventories 90. Trade receivable 95. And this one more format is there. Okay, we'll take revenue. We'll take revenue minus operating expense, operating cost or operating expense. You will get a EBITDA, EBITDA, earning before interest, tax, depreciation and amortization. From that you will reduce depreciation, amortization. You will be arrived at EBITDA, EBIT. From that you reduce the interest. You will arrive at earning before tax. From that you reduce the tax. You will arrive at earnings after tax. From the earnings after tax, if you reduce the preference dividend, you will arrive at earning after tax available to equity shareholders. Earnings after tax available to equity shareholders, ETESH. Okay. From that, if you give dividend, then you will be at a retained earnings. Then you will be at a retained earnings. See here. We recently reported the following income statement. What they are asking: the year is forecasting company 25% increase in sales. You are required to compute the projected net income and expected growth rate in dividend. Dividend growth rate means last year how much was dividend, this year how much it is, how much growth in the dividend is there. Okay, let's do that. This year company is forecasting a sales of 25%. So sales last time how much it was, sir? 700. This year it is 700 plus 25%. 875. 875. Then operating cost will be around 70% of the sales. So 875 into 70%. 612.5. How much is EBITDA, sir? 875 minus 612.5, which will come to 262.5. From that reduce the depreciation and amortization. Depreciation amortization is there? I think it's not there. So EBIT also will be 262.5. From that you have to reduce the interest. Have they told anything about the interest? It is expected that tax rate, interest and dividend payout ratio will be constant. Dividend payout ratio, which means how many percentage of earnings is given, not dividend amount. Dividend payout will remain same. So how much is interest last time? Interest was 40. So that will remain same. So it will become 222.5. Tax rate will remain same, that is 40%. 222.5 into 40% will come to 89. Earning after tax is how much, sir? 222.5 minus 89, which will come to 133.5. 133.5. Preference dividend is not there, sir. No. So ETESH is how much, sir? 133.5. ETESH, earnings available to equity shareholders, or earning after tax available to equity shareholders. Okay, done. So they are telling dividend payout ratio will be constant. Last time what happened? You earned 96. You paid dividend of 32, which means around 1/3 you gave dividend, right? 32 divided by 96. 1 by 3 you gave dividend. Now you earned 133. In that you should give again same ratio 1 by 3. That is 0.3333333333. That is 44.5. You are giving dividend of 44.5. You will be left out with 89. You will be left out with 89. What they are asking? They are asking you to compute projected net income. Projected net income is 133.5. Expected growth in the dividend. Dividend last year how much you gave? 32 you gave. This year 44.5, which means extra 12.5 you have given. So what is the growth rate when compared to last year? That is 12.5 divided by 32. Around 39.063 something is the dividend growth. Done, sir. Next. They have given few more illustrations. 2 more illustrations. Let's see. Looking ahead of the following year, company management assembles the following information. Year-end sales are expected to be 10% higher than the last year. So sales will become 3,300. Okay. Year-end operating cost excluding depreciation expected to be 80% of the year-end sales. So 3,300 into 80% will come to 2,640. So 3,300 minus 2,640, which is 660, correct? Depreciation expected to increase at the same rate as sale, which means 10% increase. So it will become 275, 250 plus 10%, 275. Done. Next is what, sir? Interest costs are expected to remain unchanged. So EBIT is how much? EBIT is 660 minus 275, 385. Interest remains unchanged, 125. So EBT how much, sir? EBT is 385 minus 125, 260. 260. Tax rate is expected to remain at 40%. That is 260 into 40%. Will come to 104. So earning after tax is around 260 minus 104 will come to 156. Earning after tax is 156. 156. Answer. Next. X Limited recently reported the following 2022 income statement. Okay, done. The year company is forecasting 20% increase in the sales. So sales will become how much, sir? 1528 plus 20%, which will come to 1833.6. Okay, what they're expecting. Operating cost will be around 60% of the sales. So they're telling operating cost will be around 60% of the sales, which is around 1100.16. So your EBIT is around 1833.6 minus 1100.16 is 733.44. Then it is expected tax rate, interest and dividend payout ratio will be constant. Okay. So interest will be there as it is. So interest will be 95 only. Your EBT will be minus 95. 638.44. Tax also remains same, they are telling 40%. So into 0.4, which will come to 255.38. We'll get earning after tax 638.44 minus 255.38, 383.06. Dividend is 25%. Dividend is 25%. Last time they paid 25% of the net earnings. See there. 300 into 25%. So they are telling dividend payout ratio remains same. So not dividend amount, dividend payout ratio. So 383.06 into 25 percentage, which will come to 95.77. 383.06 minus 95.77. Retained earnings is 287.29. In this question, retained earnings is not required because they are asking net income. That is your earning after tax and expected growth rate. Growth rate is how much, sir? How much is the growth? Around 20.77 is the growth compared to last one. Divided by last time you paid 75. So how much it will be? 20.77 divided by 75. Around 27.69% is the growth. 27.69, 383.06. Hope you guys understood. That's it. So now we are coming towards the end of our marathon with the major two chapters. One is cash flow statement. The other one is consolidation. Consolidation to at least 10 marks. So try to understand what will happen. Underwriting, you can expect 5 marks. This chapter, you can expect 5 marks minimum. 10 na. Consolidation, if you study well, don't skip that. Try to understand. Tomorrow you will get to know that is how easy it is, right? So if at all you watch this tomorrow next day, you will get to know. Or if you want to watch the same day today itself, then you will be getting it to know today itself. So around 20 marks is done through only these chapters. Only these chapters 20. Issue of shares, again it will fetch around 10 marks. Issue, reissue, your 12th standard concept which we did again, of course with certain prorata basis and all. So that will 10. Around 30 marks you can get from only this. 30 marks you can get from only this. In second chapter theory question might come, XBRL etc. Around 5 marks, 35 marks. Ratio small question if you keep also, it will be around 40 marks. 40 marks to already. Yeah. So that's why. And redemption of debenture again 45. So you can score, if you plan well, you can score well. So whenever this revision you watch, again you go and study your study mate once. Okay. Continue our session. Now, which concept we are going to do is a buyback. Okay. Yes, now starting with buyback of shares, people. So what do you mean by buyback, sir? Buyback means purchase of our own share by the company. Basically, company's own share. It will be there with members, no? Now from members we are taking back our own share is a buyback. Basically redemption only, correct? But here no requirement or no compulsion is there because it's a equity shares. It's kind of corporate financial strategy, etc., etc. So what are the different provision applicable for buyback, sir? For unlisted company 68, 69, 70. For the listed company along with 68, 69, 70. Rule 17 is applicable, that is applicable to both, as well as SEBI regulations are applicable as it is relating to listed company. As it is related to the listed company. Okay, sir, done. So what are the extracts? What are the extracts you have to know? See, purchase can be made out of free reserves, securities premium, the proceeds of issue of any shares or other specified securities. Try to understand. In the redemption of preference share, one thing was there. You can use the free reserves. And proceeds from the issue of shares. Correct? But in case of buyback, it is you can use the free reserves along with the securities premium. Last point of securities premium, allowing it, correct? So free reserves along with the securities premium and issue of not shares, securities. Issue of securities here need not be shares only, it could be debentures also. But one more thing, when you are buying back equity shares, you can't issue new class of equity shares. You should issue preference share. When you are buying back preference share, you can't issue preference share, but you have to issue equity share, like that. Same class you cannot issue. Buying back, same class cannot be issued. What are the certain preliminary conditions, sir? It must be authorized by the article. Okay. Special resolution has been passed at a general meeting authorizing the buyback. The special resolution is not required when, sir, buyback is 10% or less of the total capital plus free reserves. Basically, when it is 10% or less of shareholders fund, no need of the special resolution. Such buyback has been authorized by the board by means. Basically, if at all you are buying back less than 10%, then all you need, less than 10% or 10%, all you need is board resolution. Board resolution. That's it. No need of special resolution. If the buyback is 25% or less and free reserves of the company, so buyback cannot exceed more than 25% of shareholders fund. But in case of equity shares, same can be only 25% of equity share capital, not even shareholders fund. In case of equity share, it is not even shareholders fund, it is 25% of equity share capital. Okay. Debt equity ratio should not fall below 2:1. After buyback, your debt equity should not fall below 2:1. Okay. All the shares or other securities for buyback are fully paid, so it should be fully paid, etc. You have to transfer certain amount to CRR, just like redemption of preference share. How much ever you use free reserves to pay off your buyback amount, face value of buyback, so much you have to transfer it to CRR. And you know that CRR could be used only for the bonus issue. Okay. What are the certain entries, sir? Try to understand. You might sell the investment. Entry will be bank to investment. Then you might issue fresh securities like bank account debit to debenture or to shares, equity, not equity shares. If at all you are buying back equity shares, then it should be other than that securities premium. If at all issuing at a premium, then first you are going to pay off your equity shareholders. So equity shareholders to bank, and later you are going to write it off against equity share capital, premium on buyback if at all you paid to equity shareholders, and this premium could be written off against either the free reserves or securities premium, or the securities premium could be used for this purpose. Okay. If at all you bought back your equity at a discount, then you are going to credit capital reserve. And when you transfer some amount to CRR, entry will be free reserves, securities premium to CRR, and certain buyback expense to bank, and writing off is P&L to buyback. Not much important things. See here, we'll see few questions if it's available. This is underwriting. They have given here one balance sheet. Okay, in the page number 164 of your study material. And here see what they are telling. On 1st April 23, the shareholders of the company have been approved for the buyback of equity. It seems 5% of equity shares will be bought back at rupees 15. How much you are buying, sir? 5% of equity. How much is your equity? Note number 1. Equity 1 lakh is there. 5% of it you are planning to buy back 5,000 shares at rupees 15. 5,000 shares at rupees 15. 12% debentures to be issued for 10,000 to finance for buyback. So to finance for buyback, how many shares you are issuing, sir? You are issuing 12% debenture of rupees 10,000. To the extent of 10,000, you are issuing this one. Balance is from the general reserve. Great. Premium paid on buyback shall be met out of securities premium. They are telling use securities premium to write off a premium on buyback. Okay. Investment would be sold for 275,000. How much is your investment amount right now? You see here, Non-current investment 150,000. Non-current investment 150,000, and they are telling it will be sold at what? 275,000. Moral of the story, 125,000 is the profit on sale of investment. Okay. Pass the necessary journal entries. So try to understand necessary journal entries. First, let's sell the investment. Okay. Let's start with something good. So investment is how much, sir? 1,50,000. So bank account debit 275,000. To investment 150. To profit on sale 125. Correct? Bank account debit 275. To investment 150. To profit on sale 125. Done. Later, sir. Later. They are telling 12% debenture will be issued. So entry will be bank account debit to 12% debenture account. How much, sir? 10,000, 10,000. Okay. Now, how much will be bought back? Bought back is 5,000 shares. What is the face value of the 5,000 shares which you are buying back? Rupees 10, which comes to 50,000. Correct? Which comes to 50,000. Moral of the story, 10,000 you are issuing a debenture, not like a preference share here. You can issue any securities other than the same security. That too same class of security. So 10,000. So remaining 40,000 you are going to use the free reserves. So here if you go reserves and surplus, general reserve is there. So you are going to use the general reserve for it. So general reserve to CRR. How much, sir? 40,000. Done. Securities premium 2 lakh is there. You are going to use to write off the premium. How much is it, sir? 5,000 shares into rupees 5, which will come to 25,000. So you are going to use 25,000 rupees for this one. Done. So listen here. Bank account debit 275 to investment to P&L 150, 125. Shareholders to bank, you have to pay them 75,000. No, you paid them 75,000. Now you are cancelling it. Equity share capital, securities premium to shareholders, or you can write it as equity share capital, premium on buyback to shareholders. Later, securities premium account debit to premium on buyback. You are going to create CRR to the extent of 40,000. And you are going to get 10,000 rupees in cash due to issue of debentures. That's it. Not much other things are there. Okay. And always remember, your debt equity ratio should not go beyond 2:1, which means after buyback, if at all your equity is, let's say, 1 lakh, your debt cannot exceed more than 2 lakh. This thing. Of course, these conditions are there in your law. Assuming you guys have done it in your law, I'm not going in depth into all these things. With that, we have completed bonus also. So, sorry, buyback also. So now if you go to index and check, $1 done, boss. $10 done. Introduction is done, sir. Okay, 2 marks guaranteed from that. This one 5 marks. This is done. Accounting standards, I told you, no way I'm going to touch this, because they have given, like, tasting kind of things, where they given accounting standards, Indian accounting standard, IFRS, IAS, everything they have given. I don't want to touch that. Expect you guys also not to touch if you don't have a time, because for 5 marks reading 100 pages. So accounting for share capital, in this issue of share done, forfeiture done, reissue done, bonus done, redemption of preference share done. What else was there? Buyback, now we completed. Done, sir. Accounting for debentures, if you go, issue, redemption, both are done. Related aspect, ESOP done and underwriting done. These are the only two, because buyback I considered it as chapter number 4. Consolidated still remaining. Financial analysis, yesterday just glance with it. Forecasting done. So now we have consolidation as well as cash flow statement, 2 big chapters. Okay, now consolidation we'll try to keep it for a lasting, and cash flow we'll do it now. And cash flow is very easy, people. Try to understand. Always the question comes and it is very easy to do. You have to understand why it is what it is. Okay, that will do. No worries. Now we are going to start with cash flow statements. Yes, now we'll start with what is cash flow statement. So cash flow statement is a statement, no doubt in that. Cash flow statement is a statement. Yes, sir. So what statement it is, sir? It is a statement which shows inflows and outflows of cash and cash equivalent. So cash flow statement is nothing but a statement which shows inflows as well as outflows of the cash and cash equivalent. Cash flow statement is a statement which shows inflows and outflows of what, sir? Cash and cash equivalent. Cash means what, sir? Cash as well as bank. Cash means what, sir? Cash as well as bank balances. Whereas cash equivalent means what, sir? Cash equivalent means, people, those investments where maturity is less than 3 months. Maturity period is less than 3 months and which can be converted into cash immediately. And it should be able to convert it into cash immediately for the known amount. That is it should not lose its major value. For example, sir, equity shares, sir, today I will buy, okay, tomorrow I will sell, okay, so it's a cash equivalent, no, sir? It's a cash equivalent, no? Of course no. Why? Because today's equity share value, tomorrow's equity share value, we don't know, no? Do you know the known amount at what you are going to redeem or at what you are going to sell it back? No. Buying rate you know, selling rate you don't know, boss. So that you can't tell it as a cash equivalent. To be a cash equivalent, 3 conditions. 1, maturity period should not be more than 3 months. 2, it should be immediately converted into cash. It should be able to immediately convert it into cash. 3, not only able to convert it into cash, it should be not losing any of its major value. Then only it will be considered as cash equivalent. So inflows and outflows of these cash and cash equivalent shown in the statement called as cash flow statement. And always remember, company's financial statement includes cash flow statement. Basically AS3, accounting standard 3 or Ind AS 7 is the standard which is regulating cash flow statement, and all the companies should prepare cash flow statement because that will form part of financial statements. However, if you are a OPC, 1% company, then you got an exemption from it. Done, sir. Sir, how we should show cash flow, sir? All the cash inflows in one place, all the cash outflows in one place. The answer is no. For the sake of cash flow, activities are divided into 3. What and all, sir? Operating cash flows, investing cash flows, financing cash flows. Operating cash flows, investing cash flows, financing cash flows. What do you mean by operating cash flows, sir? Cash flows due to day-to-day and operation. Cash inflow and cash outflow relating to day-to-day operation is known as operating cash flows. Investing cash flows means what, sir? Cash flows due to investing activities, whereas financing cash flow means what, sir? Cash flows due to financing activities. Done. Example, sir. Payment to creditors, payment from customers, salary paid, rent paid, income tax, all these things are operating. When it comes to investing, sale of asset, purchase of investment, dividend received, interest received, etc. When it comes to financing, issue of shares, bank loan, dividend payment, interest payment, etc. However, for banking, interest payment is, of course, operating. No, bank's business is that. So that will be considered as operating. So based on the nature, you have to decide which is operating, which is investing, which is financing. Okay. Preparation of cash flow should be as per AS 3 or Ind AS 7. If you are following Ind AS 7. If you are following accounting standard 3. Cash flow can be disclosed in the following manner as operating activity, investing activity, financing activity. Operating activity, investing activity, financing activity. Operating activity could be shown under indirect method or direct method. Operating activity could be shown under indirect method or direct method, whereas investing activity, financing activity will be in the direct method. Investing activity and financing activity will be in the direct method. Now the question comes, sir, what do you mean by indirect method? What do you mean by direct method? What do you mean by indirect method? What do you mean by direct method? See, direct method is pretty simple. How much cash inflow? How much cash outflow? How much cash inflow? How much cash outflow? First, operating. How much cash inflow? How much cash outflow? Investing activity. How much cash inflow? How much cash outflow? Financing activity. How much cash inflow? How much cash outflow? All these three together we call it as net cash flow. To this, if you add the opening balance of cash and cash equivalent, we should get the closing balance cash of cash equivalent. That's it. So direct method you see how it will be. Okay, operating activities, direct method you see. Cash inflows will be what, sir? Cash inflows will be basically collection from the trade receivable, because operations, no, relating to sales, purchase, etc. Those are the things, regular day-to-day expenses, etc. So collection from the trade receivables, okay, and cash sales. These two usually will be operating incomes. Collection from trade receivable as well as cash sales. These are the operating cash inflows. Okay. Sir, how to ascertain how much is collection from trade receivable? Open trade receivable account, no? Open trade receivable account and see, no? See, what and all will be there in the trade receivable? Trade receivable is an asset, so debit balance will be there. When you sell, credit sale, what will be the entry? Debtor account debit or trade receivable account debit, two sales. So two sales, correct? Whenever they don't pay, bad debt. Whenever you create a provision for bad debt, and whenever you write off, basically whenever you create a provision, what would be the entry? P&L to provision. When you write off the bad debts, entry will be provision to that particular things. Cash and bank and balance carried down. Usually this will be the balancing figure, that is how much you received. So ascertain how much you received from the trade receivable. You should open the trade receivable account where you are going to get balance as cash or bank. If the question is silent about credit sale portion, total sale shall be considered as a credit sale. Sometimes in question they don't tell how much is cash sale and how much is credit sale. In that scenario, people take whole sale as a credit sale. Whole sale as a credit sale. Done, sir. Payments are what will be there, sir? Payment towards your trade payables, cash purchases could be there, cash payment towards operating expense. See here, not incurrence basis, here cash flow basis. That is, only if cash goes out, then you will record it as outflow. When it cash comes in, only we are going to record it as inflow, not as per accrual. Accrual is what? Paid or not paid. Cash went or cash didn't come, doesn't matter. Whether you earned or incurred matters. Here it is not like that. In cash flow, it is like whether cash flow is happening or not happening based on that. Okay, sir. Done. Next is what? Tax expenses during the period. Paid, okay? Paid. Not tax expense for the period, paid. Usually what happens, tax of the last year will be paid in the next year or this year. So this year tax expense is different, tax payment is different. Tax payment is previous year's tax payment. Tax expense of this year will be paid next year. Like that it is. So you should keep all these things in mind. So see here. How to ascertain how much we have received? Sir, balance will be there, credit side. Credit purchase will be there. Discount received, balance will be there. Then the thing will be cash or bank. How much we paid. Sir, when to use the direct method, sir? When the information about the collection from debtors, payments to creditors are available, then you go for a direct method itself. However, If these informations are not available, but if they have given both balance sheet and P&L, then easily this information could be ascertained. How, sir? In balance sheet, balances will be there, opening balance and closing balance. In the P&L, you will get to know what are the transactions relating to this. So automatically cash flow could be found out. Okay. So either the information relating to collection and payment is given, or in question only they have given balance sheet and P&L, then you guys can go for a direct method. Okay. Sir, cash flow from investment activity, there is no direct, indirect, always it's a direct. That is, what and all you have received, cash flows from the investing activity. That is, sale of assets and investment, or income from investment received, that is like interest, etc. From this, payments you are going to reduce, that is, purchase of asset and investment, payment of capital gain taxes. Then you will find a net cash flow from investing activity. If the receipt is more, that is cash inflow is more, then it will be positive. If the outflow is more, then it will be negative. Done, sir. Financing, sir, financing. Cash flow from the financing activity. Proceeds from the issue of securities, okay. Borrowings, all these things will be there. Minus payback of debts as well as securities, and expense on borrowings like interest payment, etc. We will find this thing. Okay. Done. Now that was direct method. Anyhow, question is not there on that. Now we go to the indirect method, which is very important. Indirect method, which is very, very, very important. Okay. Listen here. What is indirect method, sir? Indirect method, try to understand, it is applicable only to the operating activity, okay? Because investing activity and financing activity is a cakewalk where you are going to do it under a direct method. But when it comes to indirect method, you are going to check out only operating activity. So operating activity, you are going to ascertain cash flow from operating activity is there. No, this you are going to ascertain using indirect method if the direct information is not given. Okay, sir, how to do it? Basically try to understand using the P&L balance. Using the P&L balance, or using the profit or loss figure for the period. Using the profit or loss figure for the period, you are going to find out how much is your cash inflow or cash outflow. How to find it out, sir? Pretty simple, people. If you see the P&L, you will find a lot of things. Cash expense will be there, non-cash expense will be there, like depreciation and all. Income side, interest received will be there, where it is not a for the period. I mean, it is not a operating activity, it's a financing it's a investing activity. Like that, other things also will be there. So in that situation, how to arrive at cash flow, sir? First step, what you should do is converting profit after tax into profit before tax by adding the tax expense for the period. So profit will be there, no? Profit after tax. This how we arrived? Profit before tax minus tax gave us profit after tax. Now we should go to profit before tax, means what we should do? To profit after tax, we should add the tax. But why even want to do, sir? Because you told that tax is an operating activity. Yes, tax is an operating activity. Because for the operations only you are earning income. Because of earning income only you are paying that. Yes. Unless and until it's a capital gain. Capital gain means investing activity. Okay. But leave that, sir. Come back here and tell why we want to add our tax. Try to understand, people. Try to understand. From the profit before tax, when you reduce a tax, you will get a profit after tax. Even I agree. But tax is also operating activity. Then why to adjust? There is no point. That's what you think. But try to understand. This tax will be there, no? That is tax expense for the period. Tax expense for the period. It is incurred, not paid. Not paid. Try to understand, it is a tax expense for the period. In that scenario, try to understand, actually for cash flow, we are not going to reduce tax expense for the period. Instead, cash outflow is tax payment in the period or during the period. Tax paid is the one which is going to affect cash flow statement, not tax expense. So what we will do, sir, first from profit after tax, first thing you are going to do is bring it to profit before tax. Bring it to profit before tax. Done, sir. Now what you have? Now what you have? Profit before tax. Now convert this profit before tax into cash profit before tax by adding back various non-cash expenditure while arriving at profit before tax, that is depreciation amortization. Now you arrived at a PBT, correct? How you arrived at PBT, sir? Let's say earning before interest, tax, depreciation and amortization was there. From the depreciation amortization you reduced, from that interest you reduced, you arrived at a EBT or PBT, correct? Now my question is whether depreciation is cash outflow or cash inflow. Depreciation is cash outflow or cash inflow. When the depreciation happens, cash outflow happens or inflow happens? Nothing happens. It's non-cash expense. It's a non-cash expense. But while arriving at PBT, you are at a PBT now. From PAT you came back to PBT, correct? Now you are at a PBT. But while arriving at PBT, you already reduced depreciation and amortization. Add it back, people. Add it back. It is not a cash expense. Cash outflow is not happening. Cash outflow is not happening. So add it back to PBT. Now, what you got, sir? All the non-cash things are gone. All the non-cash things are gone. Now you have only cash PBT, cash profit before tax, correct? Now, next step is to converting cash profit before tax into operating cash profit before tax by eliminating effects already given towards investment and financing activities. Sometimes what happens, people? Sometimes what happens? We have received interest on investment. Let's say we have received interest on investment. Already that is there in the profit. Yes or no? Because we would have credited. Now what you should do, sir? Reduce it, because it is not a operating activity. It is a financing activity. It is not a operating activity. It is, investing activity. Sometimes we might pay the interest on loan. That would have been taken as an expense, correct? That would have been taken as an expense. For the profit, what you should do, sir, add it back, because that is not a operating expense. Although it is a cash expense, that is not a operating expense. So first what you did, sir, from profit after tax, you return to profit before tax because it was a tax expense by adding it back, correct? From profit before tax, you came to profit before tax only cash items. Only cash items by adding and reducing a non-monetary items. From this now, you are going to reduce investment activity items and financing activities. So now what we will arrive at? We will arrive at profit before tax from operations and only cash. Only cash. That is third stage. Fourth stage is converting operating cash profit before tax into cash flow from operating activities before tax by giving effect of the changes in working capitals. Due to the changes in working capital, you should give some more effect. Why is it so, sir? Why is it so? Try to understand. In the P&L, whether you have taken purchases or whether you have taken payment to creditors, you have taken purchases. Whether you have taken sales or whether you have taken receipt from debtors, sales. Now profit is based on purchase and sales or payment and receipt, purchase and sales. Now this should be eliminated. These items should be eliminated and payment and receipt should be bought in, correct? So for that, what you are going to do, sir? You are going to adjust the working capital changes. You are going to adjust the working capital changes. How is it gonna be done, sir? That I will explain with numbers there. Okay, don't worry. But I hope you got some idea why we should do that working capital adjustment. Because profit, while arriving at profit, as per conservatism, we took sales. not how much we received. We took purchases, not how much we paid. Done, sir. So how it's going to be there, sir? One by one we'll take to see, try to understand. We'll take net profit after tax. For that, add the tax expense. We'll arrive at net profit before tax. For that, add the non-cash expenditure debited to P&L. Add the expenditure relating to investment financing activities. Reduce the income relating to investment financing activity. Whatever we have done while arriving at a profit, we are doing it ulta, which are non-operating and non-cash to that. We arrived at operating profit before working capital changes. For that, you are going to adjust the increase or decrease of current asset, current liability, basically working capital. Why it is to be done, sir, I will explain later. But now I told a bit idea, hope you guys got. Because you have taken purchases, not payments. You have taken sales, not receipts. But for cash flow, it is more than purchase and sales. Important thing is payment and receipt. Done. So tax expense paid during the period. Tax expense paid during the period will arrive at a net profit after the net cash flow from operating activity. We'll see one by one. Net profit after tax. How to ascertain this, sir? How to ascertain net profit after tax? Usually they will only give how much is profit after tax. Sometimes they might give profit before tax only. Then you can start it from here only. But sometimes they will tell net profit after tax. Net profit after tax. Profit after tax. Okay. How to? Sometimes they don't even tell. They will just give a balance sheet. Accumulated P&L balance will be there, no, in the reserves and surplus. They give how much is opening, how much is closing. General reserve, how much is opening, how much is closing. CRR, how much is opening, how much is closing, like that. Using that, you have to ascertain the net profit after tax. Let's see how it is. Working note number 1. Closing balance of accumulated P&L minus opening balance of accumulated P&L should be what? Profit transfer to accumulated P&L. Correct? Profit transfer to accumulated P&L. That is what, sir? Difference between closing and opening. Then to that, what you are going to do, sir? You are going to add the declared dividend declared during the year. Because how usually it works, sir? Whatever the net profit we earn, correct? From that we'll pay some dividend. Okay. After that we'll transfer it to free reserves. Correct? Or basically P&L, accumulated P&L. Now it's already transferred, which means it is after deduction of dividend. But let it know, sir. What is the problem? Dividend paid in cash now. But dividend is not operating, it is a financing activity. So what you will do? You will add back dividend payment. So add dividend declared during the period. Add apportions to reserves from the P&L. Sometimes we'll to the general reserve and all we give now. So all those things add it back. So you will arrive at a net profit after tax. Sometimes in question what they do is they will give CRR account, capital redemption reserve. If you remember, at the time of redemption of shares as well as buyback, we used to create how, sir? Free reserves we used to debit and CRR we used to credit. So always remember if there is a changes in the CRR, then there would be change in the FR. Free reserves is nothing but accumulated profit. Accumulated profit change will directly affect net profit during the period. Balance. Done. So when CRR account is given, general reserve account is given, P&L account is given in the question. In the same question, they will give all the 3 accounts. In that scenario, try to understand CRR account. What and all will be there, sir? It will be having a credit balance, correct? And we might have transferred something from the general reserve and P&L. So by general reserve only you take. So bonus to shareholders is how much, sir? That will be excluded, eliminated, no? So we'll get a balance carried down. All these things will be there. So how much we transferred from the general reserve will be the balancing figure. Now going to general reserve, opening they will be there, closing they will be there. Opening how much, sir? 5 lakh assumption. Closing how much, sir? 7 lakh. Now to CRR how much you transferred, sir? 78,000. That we got to know using CRR account. Bonus how much you gave, sir? 1 lakh. So try to understand out of 878,000, only opening balance was 5 lakh. Opening balance was 5 lakh. Moral of the story, 378 is coming from the P&L this time. 378 is coming from the P&L this time. Now if you go to P&L account, opening was 7 lakh. Opening was 7 lakh. To general reserve, you have transferred 378,000. Bonus to shareholders, let's say we have used 50,000. CRR you used 1 lakh, general reserve 1 lakh, P&L 150,000, like that. Dividend declared, interim as well as normal, whatever it is, whenever it is declared, we are going to write it off against balance in P&L account only. No, P&L means accumulated P&L, because dividend is appropriation of profit, not charge against profit. Then balance carried down also will be there, which means this will be the amount net profit after tax. Net profit after tax. Correct? Done. Sometimes, sir, how to ascertain how much is the dividend? Dividend payable account you should check. Dividend payable account you should check. How much is the opening, sir? 92. How much is the closing? 1 lakh. How much is the opening? 92. How much is the closing? 1 lakh. And how much is the payment, or how much is declared during the year? 96,000. So how much is the payment? 88,000. 88,000. See here. If only opening balance and closing balance of dividend payable account is given, only what is given, sir? Opening balance is given, closing balance is given, then it is assumed as opening balance is paid off during the year, closing balance is declared during the year. Always remember, even a tax payable or dividend payable, always remember, if they give just opening and closing, then try to understand what you are going to assume, sir. Opening is paid during the period, closing is for the period. Okay, closing is for the period. Done. This is note number 1, how to ascertain the P&L. Based on question to question, you should be knowing. I am just trying to tell you how the flow works, how the flow is working. So first one is done. Next is tax expense for the period. How to ascertain, sir, how much is the tax expense for the period? Correct? Yes. So how to ascertain, sir, how much is the tax expense for the period? Because we have to add back tax expense now. Because we should not reduce tax expense, we should reduce tax paid during the period. So how to ascertain that, sir? See here. Tax expense paid during the period. They have given how much is the balances in the provision for tax, and payment of tax is also given in the question. Then what you are going to do, sir? You are going to open the provision for tax account. Opening balance they have given 90,000. Closing balance they have given 110,000. Also payment they have given, that is provision for tax account debit to bank account 50,000. So difference should be how much is the expense for the period, this provision for tax. When opening and closing balance of provision for tax account is given, always remember, as I already told, no other treatment is given, no other information is given, only opening provision, closing provision then they have given. Then always remember, opening is paid during the period, closing is expense for the period. Opening balance is assumed to be paid during the period, and closing balance is assumed to be tax expense for the period. Sometimes what they do, sir, when provision for tax and advance tax is given, both they have given. They have given provision for tax, advance tax as well as provision for tax. This is how much we paid already beforehand. This is how much we should pay. Correct? In that scenario, opening balance of advance tax is first adjusted against the opening tax liability. Tax liability will be there. We already paid, that will be there in the advance tax or a TDS. Now, whatever TDS is there, first shall be adjusted towards tax liability. Correct? So, how is it, sir? See here. Let's say opening balance of provision for tax, they have given 180,000. Closing balance, they have given 2 lakh. Okay. Now, opening balance of advance tax, they have given it as 150. Closing, they have given it as 190. So, always remember, first opening tax shall be adjusted towards the liability, that is provision for tax. So by provision for tax 150 to advance tax 150. Now, opening got adjusted, closing is still there. Opening was there, opening got adjusted, closing is there, which means if the opening is completely adjusted, then this 190 is not 190,000 is nothing but how much is tax expense paid during the period. Answer. Now here you see opening balance was there, closing balance was there. How much is advance tax was there, adjusted. Sometimes they will only give how much it is extra paid, because need not be that advance tax is always more than or equal to liability. Sometimes liability will be more, that time in cash also you have to pay certain things, not only how much you have paid already earlier. No. And balancing figure will be tax expense for the period. Answer. This is note number 2. Note number 3. That is non-cash expenditure debited to P&L, like depreciation and all are non-cash expenditure, no? That which is already debited to P&L. So listen here. Non-cash expenditure debited to P&L, note number 3. Like accounting for depreciation I will show. It could be done 2 ways. One, provision for depreciation is not opened. One more is provision for depreciation is open. Provision for depreciation is not open. Provision for depreciation is open. Let's say now provision for depreciation is not open. In that scenario, how it's going to work, sir? In that scenario, depreciation is directly reduced from the cost of asset. See, asset cost, let's say 10 lakh. Depreciation every year is 1 lakh. Sold at 4th year end. One sold for 640,000. Next alternative is sold for 740. In this scenario, what happens? First year end, you are going to charge the depreciation. So entry will be depreciation account debit to asset account. Depreciation account debit to asset account. Then you are going to write off the depreciation to P&L to depreciation. So this is an expenditure. This is an expenditure which is already debited. So now we have to credit it back so that non-cash expense item won't be there. Second year also same thing happens. Third year also same thing happens. Fourth year beginning, what you are doing, sir? Fourth year beginning only you are selling the assets for 640. Try to understand. Every year for 3 years, asset value got decreased by 1 lakh, which means beginning of 4th year, your asset value is 7 lakh. But you are selling it for 640,000. Moral of the story, rupees 60,000 is loss. 60,000 is loss. So listen here. Bank account debit 640, loss on sale 60, asset account 7. Or if at all you sell it for 740, then 40,000 is profit. In that scenario, bank account debit 740, to asset account 7, to profit on sale 40. Correct? Now, when the provision is created, that time how the accounting works. This provision is not created, which means in the asset account only we are going to write off depreciation. But when the provision is created, that time provision depreciation amount shall be transferred to provision for depreciation. So depreciation account debit to provision for depreciation 1 lakh, P&L to depreciation 1 lakh. However, depreciation 1 lakh only, but accounting is changed. Always remember one thing. In this scenario, asset account is not reduced. Balance in asset account will be reflected cost only. But instead of reducing here, you are going to open one provision. That is your provision for depreciation. Okay, sir. Okay. Then what you are going to do, sir? When the asset is sold, this provision balance will be transferred to that asset account. Net amount shall be considered for calculating profit or loss. See here how. Second year, depreciation account debit to provision for depreciation. Third year also same. Fourth year beginning, asset is sold. So immediately in the provision for depreciation, every year 1 lakh, 1 lakh, 1 lakh we credited. So it has a 3 lakh credit balance. Now you have to debit it against the asset. So provision for depreciation account 3 lakh to asset account 3 lakh. Whereas final entry will be for the sales, bank account debit, loss on sale to asset. Asset will get closed. Same like that only. Finally, amount and all will be same only. But how you are going to show in the first one, how you showed, sir, when the provision is not opened, you are reducing it from the asset account only. But when the provision is opened, depreciation you can trace it in provision account but not in asset account. Depreciation you can trace it in provision account but not in asset account. So that is how the accounting will be done. Now you see how to trace. See the provision account. What and all will be there, sir? Balance will be there. Opening balance, closing balance. And what is the provision relating to sold asset will be there. Then the balancing figure should be how much is depreciation for the period. Balancing figure should be how much is depreciation for the period. Going to case number 2. That is, when the provision for depreciation is not given, then where you can trace the depreciation, sir? In the asset account itself. Opening balance, closing balance, you know how much is the amount at what you sold, you know. Then profit, if you know, then straight away you can find out how much is the depreciation for the period. Okay. This is your note number 4. I mean, when we see the sum, you will get to know all these things. But I'm just giving you a glance about it once. So that if you understand all these things, then whatever might be the question, you can easily solve. Expenditure relating to investment in financing activity charged to P&L. Like your interest and all will be there, no? Note number 4. Here. Loss on sale of asset. What you would have done? You would have debited, correct? You would have shown as an expense. Interest paid, you would have shown as an expense. Interest related expense you would have written off. Premium on redemption of securities you would have written off. Whatever P&L got debited due to financing activity and investing activity, all those things should be added back. And same, whenever you credited your P&L with any income and expenditure relating to investing and financing activity, that you should reverse it by reducing it, because that's not a income anymore. Okay. Now comes legend adjustment. What legend adjustment, sir? That is your adjustment for working capital changes. That is, instead of purchase, you should make sure you write it as how much is the amount paid. Instead of sales, you should write it as how much is the amount received. Along with that, few other expense also will be there. Correct? How to adjust all those things? All those things we are going to see in Note 6, Note 7, Note 8, Note 9, Note 10. If you understand so much, after that you are going to reduce tax expense. Then you will arrive at operating. Then cash flow is done. Then cash flow statement is done. So now we are going to see note number 6. Yes. Sir, how to treat this working capital changes? See here. Increase in working capital, you should reduce. Decrease in working capital, you should add. Increase in working capital, you should reduce. Decrease in working capital, what you should do, sir? You should add. Basically, current asset is inversely proportional to cash flow statement. That is, current asset is increasing, cash flow will decrease. Current liability is directly proportional to cash flow statement. What do you mean by that, sir? If the current liability is increasing, cash flow increase. Current liability decrease, cash flow decrease. Sir, how, sir? Why, sir? Everyone tell the same thing, sir. But why is it so? Why we should treat that way? Everyone tells increase in current asset minus decrease in current asset plus increase in current asset, current liability plus decrease in current liability minus. Why is it so? Look at this example. We'll take one current asset. Let's say debtor as an example. Debtor opening balance was 5 lakh. Sales during the year is, let's say, 10 lakh. Situation 1, let's assume cash received as 12 lakh. Situation 2, let's assume cash received as 7 lakh. Situation 1, look at the debtor's account. Opening balance 5 lakh debit. Sales during the year 10 lakh. Cash received 12 lakh. Balance carried down. Closing balance, balancing figure 3 lakhs. Correct? Now try to understand what is happening, sir. In the P&L, how much is recorded? In the P&L, sales is recorded as 10 lakh. Income is recorded as 10 lakh. But for the cash flow, whether we should take sales as total sales or only how much is the money received from debtors? Of course, how much is the money received from debtors? But in the profit, what is there? In the profit, what is there? Is sales is on accrual basis or sales is on cash basis? Of course, it's on accrual basis. So what you should do, you should eliminate the sales as per accrual. You should consider only cash received from debtors. So try to understand here what is happening. Sales we recorded as 10 lakh, but if you see there, cash received relating to sales is 12 lakh. If you see there, cash received relating to sales is 12 lakh, which means, sir, we should have received how much? We should have recorded it as 12 lakh, but how much we recorded it as 10 lakh. Moral of the story, rupees 2 lakh extra we should record, because actual cash receipt relating to sales is 12 lakh, but while arriving at profit you considered sale as 10 lakh, which means 2 lakh extra you have to record. So the 2 lakh is nothing but, see here, opening balance was 5 lakh, closing balance is 3 lakh, which means decrease in the debtors by how much, sir? 2 lakh. And what we are telling? Add it. Hope you got to know. Go to the debtors, one more situation where sales is 10 lakh only, but you received 7 lakh, which means from profit you should have taken sales as 7 lakh, cash sales for cash flow statement, but you have taken sales as 10 lakh, which means 3 lakh you have taken more. You should reduce that 3 lakh. Let's see how the debtor account will affect this. Opening balance 5 lakh, sales during the year 10 lakh, cash received 7 lakh, closing balance 8 lakh. Which means if they give just opening balance, closing balance, see what is happening. Debtors account is increasing by 3 lakh. So when debtors account increased by 3 lakhs, what is the meaning of that? Boss, you treated it as money has received, but you haven't received that. You treated the money has been received, but you haven't received. So add it. Add it now. So 3 lakh, you have to add it. Sorry, receive, decrease. You treated it as it is received, but not yet received. You treated sales as 10 lakh, but you should have treated only 7 lakh, which means 3 lakh you haven't received. So treat it as not yet received. Sales treat it as just 7 lakh, not 10 lakh. So what you should do? 3 lakh you reduce. That is the reason increase in debtors minus decrease in debtors plus any current asset is it so concerned. Sir, current liability, see here, example of current liability. Opening was 8 lakh. During the year we purchased 25, paid 20 lakh, paid 28 lakh. As per cash flow, purchase must have been recorded at 20 and 28, not 25. But while arriving at a profit, you recorded it as 25. Now, in first scenario, purchase you recorded more, because of which profit decreased by 5 lakh. But your actual cash purchase is 20 lakh. So add 5 lakh in situation number 1. Situation number 2. You purchased 25 lakh, but you recorded cash outflow is 28. You should have recorded as 28, but you recorded just 25, which means 3 lakh is extra expense. Just record it now. Decrease your profit. But they don't give this. No, that is the problem. If they give this, you can go for direct method only. If you know how much is payment to your creditors, debtors, you can use direct method only. Here they haven't given it. That's the reason why we are doing this. Yes, sir. So in this scenario, what they will do? They will give you opening balance and closing balance. See here. Opening was how much, sir? Opening was 8 lakh. Correct. How much you purchased? 25. How much you received? 20. Balancing figure is balance, 13. So opening is 8, closing is 13. Which means increase by 5 lakh. First scenario, what I told you, to increase it by 5 lakh. The reason is here, because you recorded your expense as 25 lakhs, but your cash expense was just 20 lakh, which means profit should increase by 5 lakh to arrive at a cash profit. So increase it. So increase in liability, current liability, add. Go to one more thing. Whereas balance was 8 lakh, you purchased 25 lakhs, but you paid 28 lakhs, because of which balance became 5 lakh. Decrease in the balance by 3 lakh. Decrease in the balance by 3 lakh. In P&L, you took your purchase as 25, but cash purchase is 28, which means you decrease your profit by 3 lakh. That's what. Decrease in the balance of current liability minus increase in the balance of current liability plus decrease in the balance of current asset plus increase in the balance of current asset minus. Or remember this, current asset and cash flow is like snake and mungus. Current liability and cash flow is like something friendly. or in your Gen Z terms, if I want to tell, current asset and cash flow is like good guy and a girl. I'm not telling out of experience or something. I'm just watching your memes, reels. I'm telling this. So cash flow is a girl. Current asset is a good guy. Current liability is a red flag, bad boy. Okay. Current asset is a good boy. Current liability is a bad boy. So what people will tell, boss, girls won't fall for good guys, it seems. Girls fall for red flags, it seems. That's what happening now. So try to understand. Girl and bad boys are directly proportional, which means increase means increase, decrease means decrease. Whereas girls and good boys are inversely proportional, which means if the boy tell plus girl tell minus, if the boy tell minus girl tell plus, this thing will remember, sir. Hope it is clear. Now we'll see few questions and we'll wind up this concept. From the following balances, calculate the cash flow from operations. Okay. Bills receivable is there. See, profit made during the year, they have given it as 7,000. To this, we have to adjust working capital. How to adjust that, sir? Bills receivable is current asset. Opening was 5,000. Closing is 4,700, which means decrease in the current asset by 300. Decrease in the current asset by 300. Current asset is good boy. So, a good boy tells minus. Cash flow, girls tell what? Plus. Debtors, current asset. Opening 1,000, closing 1,250, which means 250 is addition. So current asset is a good boy. Liability means bad boy. Remember that. Bad liability, good asset. So 250 is increase. So good boy is telling plus. So girl will do minus. Okay. Next. Bills payable, current liability, increase or decrease? Increase. So bad boy, good boy, bad boy. If the bad boy tells plus, what the girl will tell? Oh, plus only, correct? So creditors, opening is 800, 600 is closing, minus 200. Good boy, bad boy, bad boy telling minus. It is minus. Outstanding expense, again the bad boy. Liability, no. So opening is 100, closing is 120, which means increase by 20, Girls will all tell plus prepaid expense. Opening 80, closing 70. Moral of the story minus 10. Minus 10. Accrued income is a current asset. Opening is 60, closing is 75 plus 15, but it is a good boy. So if the good boy tell plus, girl will do minus. Income received in advance is your liability, bad boy. So how much, sir? Opening was 80, closing is 25, so minus 55. What girl will tell? Boss plus, sorry, liability, no, bad boy. Bad boy minus, girl is also minus. That's it. Add increase in current liability. Your bills payable as well as outstanding expense. Like that you are going to do. End of the day we'll get cash flow from operations. Look at one more question here. Look at one more question here. Given below are the balance sheet of Veer and Sons. So given below is the balance sheet of Veer and Sons. They have given a balance sheet. Great. Capital you see is increasing. Other things let's see one by one. During the year, machine costing rupees 1000. Accumulated depreciation is 300. See here what they are trying to tell. Boss, the depreciation is done on the accumulated basis, provision basis. You are keeping it as a provision. Is sold for 500, which means 1000 rupees machine. The balance in the accumulated depreciation was 300. So you will write off that provision against machine now. So the machine actual balance is 700. You sold it for 500. Loss on sale of machine 200, which is already adjusted in the P&L. Remember that the provision for depreciation against machine was 2500 and closing is 4000. Net profit for the year amounted to rupees 4500. So net profit they only have given 4500. Okay, you are required to prepare a cash flow statement. We'll do it, no worries. So net profit for the period is how much, sir? 4500. For that, first what we will do, we'll take out the non-cash expenditure. So add back the depreciation. So how much, sir? See the working note number 1. Provision for depreciation account. Look there. Provision for depreciation account. Buy balance bought down. 2500 was there. Closing they are telling 4000. And I also told you that relating to the sold machine we are going to write off. Correct? So 2 machinery 300. So during the year by depreciation balancing figure is how much, sir? 1800. So you have to add back 1800. Loss on sale of machinery, working note number 2. See the machinery account. Opening was 10,500. Closing is 9,500. Relating to sold unit accumulated depreciation return of 300. During the year, loss on sale of machinery was how much? 200. Because I told you 10,000 it was, sorry 1,000 it was. Out of that 300 was related to that. So it became 700. That is sold for 500. Which means 200 is loss on sale of machinery. What you did earlier, you would have reduced while arriving at P&L, but you should add it back now, not relating to operations. Now go to the working capital changes. Working capital changes. See here. Creditors. Opening was 4000, closing is 4400. Creditor is a bad boy. They are telling plus 400. What girl will tell? Girl will also tell plus 400. Increase in current liability 400. Creditors. Mr. A's loan, financing activity, it's not a current liability. Loan from bank, not a current liability. Capital, leave it. Asset, cash, and that comes under cash and cash equivalent. Debtors is their current asset. Opening was 3000, closing is 5000. So So 2000, good boy is telling plus 2000, girl will tell minus 2000. So minus increase in the current asset, less increase in the current asset, debtors 2000. Stock opening 3500, closing 2500, good boy telling minus 1000, girl will tell plus 1000. Decrease in current asset plus 1000. Machinery is not a current asset. Land is not a current asset. Building is not a current asset. Those are investment accounts. Done. So we got to know how much is net operating cash flow. We got to know net operating cash flow. Done, sir. Next. Now, let's go to investing activity. Investing activity means assets only. Go to the assets and see what is happening. Machinery is there. Machinery is there. Opening was 8,000. Closing is 5,500. See the working note here. What is happening in the machinery account? Opening was 10,500. How, sir? Array, 2,500 was accumulated depreciation. While showing it in the balance sheet, we are not going to show accumulated depreciation in the liability side, asset in the asset side. Instead, while disclosing, not accounting, accounting wise both are different only. Accumulated will have its own balance, machine will have its cost. But while disclosing in balance sheet, we'll show machinery minus accumulated depreciation, final amount. But machinery will be reflecting at its cost value, accumulated will be there in the liability side. But while showing, we don't show one in asset, one in liability. We show it by netting it off, only for the sake of disclosure. Okay. So 2,500 was accumulated depreciation. For that 8,000 we added, so it became 10,500. One asset we sold, accumulated depreciation of that is 300, and loss on sale is 2,200, and closing balance is 9,500. How, sir? 5,500 is the closing balance what they have given, plus accumulated depreciation balance is how much, sir? 4,000. So it will become 9,500. Balancing figure is bank 500, which means we spent 500 this time. Sorry, we received 500 this time. So machinery is balancing. So if the machinery is balancing, moral of the story, there is no decrease or increase in the machinery as a cash flow so concerned. Other decrease increase is there, but as a cash flow nothing is there. Land opening was 4,000, closing is 5,000. Land no depreciation, so increase means it should be due to purchase of land. So 1,000 is the cash outflow. Investing activity, purchase of land, outflow 1,000. Done. Investing activity, machinery, sale of machinery. By sale of machine you received 500 rupees inflow. Building opening was 3,500, closing is 6,000. They are not talking anything about the depreciation and all. So whatever the increase is there, increase is directly relating to purchase of building. How much it is? 2,500. So add to the outflow, you consider it as 2,500. So inflow was 500 from the investing activity, but outflow was 3,500. Net cash flow from investing activity negative 3,000. Done. Next, sir. Going to equity and liability. Mr. A's loan. Opening was 2,500. Closing is nothing. Moral of the story, everything is repaid. Again outflow. Loan from bank. Opening was 4,000. Closing is 5,000. There is 5,000 rupees increase in the bank loan, which means inflow of 1,000 as a loan. Capital, if you say 12,500 and closing is 15,300. Let's see what is happening. Let's see the capital account here. Opening was 12,500, closing is 15,300. During the year, they told net profit is 4,500. Actually, opening was 12,500. Net profit during the year 4,500, which means the balance should have been 17,000. However, balance is just 15,300. Whether additional capital introduced? No. Capital is decreasing, which means capital went out. Capital went out is nothing but drawings. So drawings of 1,700 is a balancing figure. So it is a cash outflow in the financing activity. See, bank loan, you have taken 1,000 rupees. A's loan repayment, 2,500 outflow. Drawings 1700 outflow. Net cash flow from financing activity 3200. So net from the operating activity, inflow of 5900, investing activity, outflow of 3000, financing activity, outflow of 5200, net cash flow is 300 rupees negative. Opening was 1000, so closing is 700. Just check. Closing is 700. Yes, so correct. Done. Go to the next one. There are few questions. I'm doing it quick. Okay. We're not spending much time on this. We'll see this. Now, concentrate. Hope you understood the concept y plus y minus all those things. They have given equity and equity share capital, securities share premium, securities premium, general reserve P&L they have given. Try to understand both they have given, and also dividend also they have given. Provision for taxation also they have given. Nice question it is. Okay, they haven't given how much is the profit for the period. They haven't given how much is the profit for the period. Depreciation for the period also they have given. So how to ascertain how much is the profit for the period, sir? Listen here. Working note number 1. Let's open a general reserve account. Opening was 4500. Closing is 6500. Opening is 4500. Closing is 6500. To general reserve, if something is coming, it should be from the P&L only. So listen here. General reserve account. Opening was 4500. Closing is 6500. So balancing figure is from the P&L it is coming. So if you open the P&L account, you can see here to general reserve 2000. Same amount you should write here. Done. Next, dividend payable account. See the dividend payable account. What is happening? 3000, 3500. 3000, 3500. Correct? So opening was 3000, closing is 3500. Have they told anything about how much is paid during the year and all? No. So yesterday I told you one thing. If nothing is mentioned, how you should treat, sir? If nothing is told how much is paid or how much is for the period, always remember opening will be treated as paid, closing will be treated as declared during the period. So listen here. Dividend payable account. Opening was 3000. We treated it as paid during the year 3000. Which activity, sir? Financing activity. If at all we receive the dividend, sir, that is due to your investment. That will be investing activity. So it is not at all operating expense. No. Done. Closing, how much they are telling? 3500. That we are going to treat it as for the period. So if you see the P&L, dividend payable 3500. Done. Next. They have given P&L 3000, 8080. So opening is 3000, closing is 8080, and after all this adjustment, we get to know that net profit after tax is 10,580. Net profit after tax is 10,580. So we are going to take net profit after tax as net profit after tax as how much we got in this? 10,580. 10,580. For this, what we should do, sir? We should add back tax expense. Why, sir? Because actual tax paid should be reduced, not tax expense. While arriving at 10,580, what we have received expense for the period, add it back and reduce how much is paid. So add back how much, sir? How much you treated as tax expense. How can we find it out, sir? Use the provision for tax. Opening and closing they have given, nothing else. Opening and closing they have given, nothing else. So opening 2250, closing 4050. What do you mean by this, sir? Try to understand. If you open the provision for tax account, opening is treated as paid during the year, closing is treated as for the period. So for the period, how much is, sir? 4050. You should add back 4050. Last you should reduce 2250. How much is paid during the period? Next, sir. Next, one more this thing is there, no depreciation. We know how much is the depreciation. 11,120. Add it back. Depreciation of 11,120. Add it back. Now we'll come from one by one. See, equity share capital 30 was there. Now it became 35. Bonus issue hasn't happened. And also securities premium also 3,000 more. Which means was 5,000 rupees increase in the capital and 3,000 rupees securities premium is nothing but due to issue of shares. So 8,000 rupees financing activity cash inflow. 8,000 rupees financing activity cash inflow. So that 5,000 rupees is increase in capital, that is face value, and 3,000 rupees is premium on that. Basically 8,000 rupees increase in the share capital along with premium, which we are going to treat it as a financial activity cash inflow. Done. General reserve P&L already adjusted. If you see the debentures now, opening was 3,000, closing is 8080. Opening is 3,000, closing is 8080, which means sorry, that is P&L 0 and 7,000, which means 7,000 debentures has been issued during the year. We are going to treat 7,000 debenture has been issued during the year, and we are going to treat it as issued at the end of the period. If you assume it as issued at the beginning of the period, then you should make sure that as there is no outstanding interest in the balance sheet, interest is paid. So you should make sure you show in financing activity cash outflow, payment of interest. In the operating activity, add back payment of interest towards debenture, 6% of 7,000. Or else you can just treat it as debentures has been issued at the end of the period. So no interest adjustment, only you are going to show it as financial activity cash inflow. Sundri debtors, working capital. Sir, opening was 8,500, closing is 9,020. Opening was 8,500, closing is 9,020, which means 570 rupees. 570 rupees. Increase or decrease, sir? Increase. Bad boy, good boy, bad boy. Bad boy tell plus, girl will tell plus. Next, provision for taxation. See, no need to adjust provision for taxation again because you already adjusted in the earlier one. Special adjustment you have done, plus minus. You added back tax expense for the period. You reduce tax paid during the period. Correct? No need to adjust it again because it's already got adjusted. Proposed dividend already got adjusted. No need to adjust. Going to the asset, land and building. 23 was the opening, 39 is the closing, and depreciation for the period is 6,000. So if you see the land and building account, opening was 23,000, closing is 39,000, depreciation for the period is 6,000. Moral of the story, depreciation is 6,000, which is decrease in the asset value, 6,000. So around 45,000 is credit side. Around 22,000 is what you purchased during the period. So investing activity cash outflow. Going to plant and machinery, changes is there again. Opening is 8,540. Depreciation during the period is around 5,000. Closing they are telling it as 14,000, which means around 19,000. So debit side one item is missing of the extent around 10,460. So this is purchase of new plant and machinery. Investing activity cash outflow. Furniture, opening was 550, closing is 650, depreciation is 120. So opening is how much, sir? 550. Closing is 650 and depreciation is 120. So around 770, 220 rupees is what you purchased during the year. 220 is what you purchased during the year. Stock, current asset, good boy, bad boy, good boy. So good boy is telling plus or minus, telling plus because increase in that, but girl will tell minus. Okay. Sundry debtors, opening is 7,500, closing is 8,500, 550. So good boy, bad boy, good boy, telling plus or minus, plus, girl will tell minus. Bank balance, treat it as cash and cash equivalent. With that, cash flow statement, done. And we have completed almost all the chapters except that accounting standard chapter, which we are of course not going to do. So we came till the end of the marathon with one important topic remaining, that is consolidated financial statement, which is one of the very important chapter. And of course we are going very slow, not like any other chapter. We are going in depth of this chapter. We are going to complete this chapter because very important from examination point of view, and one of the easiest chapter, yet people will skip that. It carries at least 10 marks, yet people will skip it. I don't know why. One of the easiest chapter, so we are going to do it. Of course, we are going to see almost all the question of your ICSI material in depth. Okay, slowly, one by one. So might be for the in next 2 hours, we are going to wind up this consolidated financial statement concept. Okay, so now we are going to start with consolidated financial statement. Yes, now we are starting with consolidation of financial statement. Sir, what do you mean by consolidation, sir? Consolidation is nothing but people merging of what, sir? Financial statements. Okay. Merging of financial statement is known as consolidation of financial statement, sir. Sir, financial statement means what, sir? What and all will be included? It will be having a balance sheet. It will be having P&L. It will be having cash flow statement. Merging of all these is known as consolidation. Merging with what, sir? Holding company financial statements will be merged with subsidiary companies. Together we call it a consolidated financial statement. However, in your level, the consolidation of cash flow statement is not there. Consolidation of P&L, theory kind of things they have given, but questions they haven't given. So only and only concentration should be on consolidation of balance sheet. However, that P&L thing I will tell when and where it comes. Done, sir. Now, what do you mean by consolidation, sir? Again, merging of financial statement of subsidiary company with the financial statement of holding company will be known as consolidation of financial statement. Yes, sir. Who will do this, sir? So, you are telling, sir, holding company's balance sheet will be there. Yes. Subsidiary company's balance sheet will be there. Yes. Merging both of this will prepare one more balance sheet. Yes. Now, who will prepare this, sir? Holding company or subsidiary company? It will be prepared by holding company. So who will consolidate a financial statements? Holding company will consolidate a financial statements. Sir, but why, sir? Because try to understand, holding company investors will be there, no? They can't go and check each and every financial statement of the subsidiary company held by such holding company. For example, Reliance company's investors. As a Reliance company investor, we can't go and check 100 companies, no? So what we will do, 100 companies things we will merge it into one. But why you want to, sir? Why they want to? Reliance companies performance is straight away depending upon these subsidiary companies performance. Reliance performance is straight away related to these subsidiary companies performance. Okay, sir. Sir, you told it will be done by the holding company, merged by the holding company, blah 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 blah. Yes. But what do you mean by holding company, sir? What do you mean by subsidiary company? People, holding company means a company which has a subsidiaries. Wow, sir, what a definition you told. So holding company means what? Company which is having a subsidiary company. Now the question comes, sir, what do you mean by subsidiary company, sir? What do you mean by subsidiary company? Subsidiary company means company in which holding company. Subsidiary company means company in which the holding company controls the composition of board of directors. That is, in the subsidiary company, if 10 directors are there, let's say one holding company, HCO is there, HCO 10 directors are there. In the 10 director, HCO can appoint 6 directors, HCO can control 6 directors, HCO can change the 6 directors. Now we can tell that HCO has a control over composition of board of directors of HCO. Now we can tell that HCO is a subsidiary of HCO, HCO is a holding of HCO. Done, sir. Only this condition, sir? No. If it satisfies one more condition, then also it will be considered as consolidation. Subsidiary. Sir. So both should be satisfied. No. One among these. What is that? Exercises or controls more than 1/2 of the voting power, either at its own or together with one or more subsidiaries. So where the company exercises or controls more than 1/2 of the voting power, for example, HCO Limited is there. Of this, holding company holds, let's say 55% of the shares. Now we can tell HCO is a holding company, HCO is a subsidiary company, or let's say HCO has one more subsidiary, that is it holds 100% share in the ACO. It holds 100% share in the ACO. So HCO holds 40% share in the HCO and ACO holds 20% share in the HCO. Still HCO could be told as holding company of HCO because it is holding total more than 51% on its own or along with its one or more subsidiaries. Then it will become a holding company and subsidiary company. See there. Exercise or controls more than 1/2 of the voting power, either at its own or together with one or more subsidiaries. Done, sir. Done. Next, people, when a holding company holds 100% shares of the subsidiary company, then such a subsidiary company shall be treated as a wholly owned or fully owned subsidiary of the holding company, where holding company holds 100% shares in the subsidiary company. 100% shares in the subsidiary company, then we can tell that such a subsidiary is fully owned or wholly owned subsidiary of holding company. Yes, sir. Sir, what if it don't hold 100%, sir? Then what we call it as? We call it as partly owned subsidiary. Where a holding company holds 100% of the shares, we call it as a wholly owned subsidiary. Where the holding company holds less than 100%, we call it as partly owned subsidiary. Yes, sir. That is, if the company holds less than 100% shares but more than 50% shares, then subsidiary company shall be treated as a partly owned subsidiary. Subsidiary company shall be treated as a partly owned subsidiary. Okay. Now, sir, 1st April is there, sir. 1st April is there. 31st March is there. 1st April is there. 31st March is there. On the opening, we have 20% shares of the subsidiary. Okay. In the month of, let's say 1st October, we took other 35% of shares. Now, what is this 110, sir? 110 will be known as date of acquisition. That is when the holding company holds greater than 50% of the shares, the day when this greater than 50% shares criteria meets, the day we call it as a date of acquisition. The day we call it as a date of acquisition. That is the date on which holding company acquired a subsidiary company. Okay, sir. Okay. From 1st April till 110, what we call it as, sir? This will be called as pre-acquisition period. This will be called as pre-acquisition period. From 110 till 31st March, we call it as post-acquisition period. From the date of acquisition till the balance sheet date, we call it as post-acquisition date. Whereas from the opening date till holding company exercises 50% of the rights, or holding company owns 50% of the right, we call it as a pre-acquisition period. So from the opening till the 50% shares acquired, that period is called as pre-acquisition. After 50% acquired, we call it as post-acquisition. After 50% is taken, we call it as post-acquisition. Clear, sir? Done. Next what, sir? So listen here, in a financial year, opening date to date of acquisition, we call it as a pre-acquisition. Date of acquisition to closing, we call it as post-acquisition. The date on which holding company holds more than 50% of the shares of the subsidiary company, such date shall be known as date of acquisition. Remember guys, in this marathon itself, we are going to take and we are going to solve each and every sum of your consolidation. Don't worry. Each and every concept, each and every sum. Slowly. Interest of the partly owned subsidiary which is held by the other than holding company is known as minority interest. What do you mean by this, sir? What do you mean by this? Listen here carefully. Let's say this is subsidiary company, this is holding company. I mean, of course, it is a vertical balance sheet, but only for understanding purpose, I am doing this. This subsidiary company, this is holding company. Share capital is there in the holding company. Let's say 200 crores, rupees in crores. Okay, here also rupees in crores. Reserves and surplus is there, basically around 100 crores. Long-term liability is there around 200 crores and short-term liability is there around 50 crores. Non-current asset is there. Around 100. Current asset is there around how much it is? Give me a second. 200, 300, 500, 550. 550. Here also 550. So current asset is around 550 minus 100. Let's say 450. Current asset is around 450. Coming to subsidiary company, share capital is around 100. Reserves and surplus is around 100. Long-term liability is around 120. Short-term liability is around 80. Coming to the asset, non-current asset, it has around 200. So 200, 300, 400, no, 400, 400. Current asset is around 200. Done. Now holding company acquires. Let's say 100% of the subsidiary company by paying consideration of, let's say 250 crores or let's say 200 crores. We'll take case to case separate example. 200 crores. Now, the holding company is paying 200 crores. For what, sir, in the S company? They are getting assets, sir. Oh my God, they are getting assets of 400 crores just by paying liability. I mean, just by paying 200 crores, sir. Wow. Wait. This liability is there now. That will also become holdings only. Liability also becomes holdings only, no? Yes, sir. How much is liability? 200. So 200 crore is what, sir? Your share capital, reserves and surplus, also known as shareholders fund. So can I tell that holding company is paying consideration to acquire the net asset of the company, not asset, not liability, but to acquire the net asset of the subsidiary company. Okay. Net asset can also be known as shareholders fund. Net asset will also be known as equal to shareholders fund. Done. So listen here. Sir, now in our example, you told 100%. I agree. You told 100% we acquired. Sir, what if we acquired only 80%, remaining 20% is there? No. To them we should do some naming ceremony. No. What name shall we keep to them? We'll keep them a name called minority interests. We'll keep them a name called minority interest. That is interest of the partly owned subsidiary which is held by other than the holding company is known as what, sir? Minority interest. Interest of the partly owned subsidiary which is held by other than holding company is known as minority interest. For example, if the 100% of the company is there, then that shall be having two components. One is percentage of holding company plus percentage of holding of minority share interest holders or minority interest. Done, sir. Now, how to compute percentage of holding, sir? Pretty simple. Let's say subsidiary company has 8 lakh outstanding shares. 8 lakh outstanding shares. In these 8 lakh outstanding shares, if at all holding company holds 6 lakh shares, if at all holding company holds 6 lakh shares, then percentage of holding will be 6 lakh shares divided by 8 lakh. It doesn't matter how much money you paid and all, how much shares you own, that matters, which will come to 75%. Which will come to 75%. Now, minority interest is 25%. Now, minority interest is 25%. Done, sir. Done. So 100% of the company could be divided into percentage of holding company and percentage of minority interest. Done. Now, if you look at the balance sheet, now what happens, sir? Now what happens? Try to understand. You acquired 100% of the share capital of the company, or 100% you acquired. So your current asset was how much? 450. Your current asset was how much? 450. Now you have to pay around 200 cash now. So 200 will be treated as investment in subsidiary. Correct? In a holding company, 200 will be treated as investment. The current asset will become 250 now. Current asset will become 250. In subsidiary company, what change happens? Nothing. Why the change will happen? Someone out there getting a money from the holding company. What company has to do? Whether he is the shareholder, you are the shareholder, boss. What I have to do? Correct? Now, while consolidating, sir, what you are going to do? While consolidating, pretty simple task. I don't touch the shareholders fund now. I don't touch the shareholders fund of both the companies. Let it be. I will tell that. Now listen. Consolidated balance sheet. Long-term liability. Sir, subsidiary company 120 is there. Holding company 200 is there. I will take long-term liability as 320. Long-term liability as 320. Short-term liability. Sir, subsidiary company has 80. Holding company has 50. 130. Done. Current assets, sir. Subsidiary company has 200. We have 250. So current asset is 450. Non-current assets, sir. 100 and 200. Non-current asset 100 and 200, sir. Total 300. Okay. Now try to understand one thing. Here the investment 200 is there. There the same amount is reflected as share capital and reserves and surplus. There the same amount is reflected as share capital and reserves and surplus. Now what we will do is instead of showing more investment and more share capital, reserves and surplus, we don't consider share capital of the subsidiary company. we don't consider share capital of the subsidiary company. At the same time, we don't take investment also. Oofy. Sir, what if you paid more, sir? What if you paid less? Array, that thing will see later, no? That thing we'll see later. Remember, so much. Slowly, one by one we'll see. Net asset is 200, you paid 200 only. In that scenario, your investment, you are not going to consider holding company's investment, because that is holding company's investment in the shares of subsidiary, not all the investment. Only the investment in the shares of subsidiary will get cancelled with share capital of subsidiary. So investment nothing. Here if you go share capital, you will take only holding companies. Reserves and surplus, you will take only holding companies. 300, 620, 750. Here also 750. So remember here, one by one we'll see. Share capital in the consolidated balance sheet, holding companies will come, subsidiary companies won't come. Share capital in the consolidated balance sheet, holding companies it will come, subsidiary companies it won't come. Subsidiary companies shall be adjusted against the holding company's investment in subsidiary company. Subsidiary companies share capital won't form part of balance sheet because it will be adjusted against the holding company's investment in the subsidiary company's share. These are all about your share capital. Okay. Now the thing comes, sir, what if the difference amount are paid? Like your net asset is 200, you paid 300, or your net asset is 200, you paid 150. In that scenario, what to do? That thing we'll see now. Okay. Sir, when holding company pays consideration to subsidiary company towards the net asset of the subsidiary company as on the date of acquisition. So on the date of acquisition, your holding company pays consideration to subsidiary company towards what, sir? Towards a net asset of the company. Towards a net asset of the company. In our example, continuing our example, bit changes will do. What is it, sir? To acquire net asset of 200, you are paying 300 crores. To acquire net asset of 200, you are paying 300 crores. Why are you paying so much, sir? Why are you paying so much? Try to understand, people. Rupees 100 what you are paying extra. Rupees 100 crores what you are paying extra than what you are acquiring. Now this 100 crores, shall be 100 crores, what you are paying extra shall be treated as you paying extra. Why will you pay? Are you going to pay the company which is very good, or are you going to company which is worst? Extra to whom you will pay? Of course you are going to pay to the shares of the company which is very good. Now the company very good means that has a goodwill, no? Now extra 100 what you are paying, that you are paying to acquire goodwill. 200 of course you are paying to acquire shares. 200 you are paying to acquire share capital, shareholders fund. Whereas other 100 what you are paying, you are paying towards goodwill. That you are paying towards goodwill. Okay, sir, got it. Now, sir, what if it is 150 crores? You acquired 200 crores company at 150 crores. Net asset of 200 crore you acquired at 150. In this scenario, what is it, sir? Try to understand. 200 crores asset you are getting for 150, which means profit or loss, profit. Which means profit or loss, profit. Now profit is capital profit or revenue profit? Capital profit or revenue profit? It happens all the time. The answer is no, occasionally, which means it is capital profit. So we are going to treat this as capital reserve. We are going to treat this as capital reserve. Whatever the less amount may you got net assets, that will be treated as capital reserve. That is net asset acquired. Net asset acquired is lesser than the net investment, which means you paid more. then it will be known as goodwill. If the net asset acquired is greater than the net investment, then it will be known as capital reserve. Now the question comes. Sir, what do you mean by net asset? I already told you, net asset is nothing but net worth. Net worth is nothing but shareholders fund. Net worth is nothing but shareholders fund. One thing you remember, people. Are you going to pay? In my example, 1st April 2025, let's say 24, to 31st March 25. Now, on 1st October, you are acquiring. Date of acquisition is 1st October. Now, whatever consideration you pay, is it towards a net asset of 1424 or net asset of 11024? Of course, you are going to pay towards the net asset of 11024. For example, our company on 1st April, we had a asset of 20 crore. In between, we grew very much. On 1st October, our asset value was 40 crore. Now I am not idiot. To give my company 20 crore on 110. Of course, I am going to tell that day's value itself. Or you can tell you are paying that day's value. So always remember, net asset means net asset as on the date of acquisition. Net asset acquired means net asset on the date of acquisition. Remember this particular point. So what do you mean by this, sir? Option number 1. You can take total asset as on the date of acquisition, reduce the total liability on the date of acquisition. You will get net asset. No, sir. Any other idea? Or simply take the shareholders funds of the subsidiary company. No, sir. Any more idea? Shareholders fund will have what? Share capital plus reserves and surplus. Use any one of this, you will get a net asset only. Always. Either you can use total asset minus total liability, or you can use shareholders fund, or you can use share capital plus reserves and surplus. Done, sir. Done. Now what, sir? Now what? I told you goodwill or capital reserve will arise when net asset is acquired is less than or more than net investment. Net asset means what? That we learnt. Net asset means what, sir? That we learnt. Now, what do you mean by net investment, sir? What do you mean by net investment? Try to understand. To my subsidiary company, I am paying 220 crores. To my subsidiary company, I am paying 220 crores. Okay. Whereas subsidiary company in future paid me 30 crore rupees dividend. Sir, so what, sir? Dividend is your income, no? Dividend is your income taken in the credit of your P&L. Try to understand. Now your work is just to check whether this dividend is issued out of the profit available before date of acquisition. That is nothing but profit of pre-acquisition period. Whether this profit from which the profit is issued, whether that profit is pre-acquisition period profit or that profit is made after post-acquisition. Now, sir, how does that make difference? Try to understand. Boss, I paid 220 crores, I agree. Now you are giving me 30 crores, no? Now I will check in earning this 30 crore whether my efforts were there or no. What do you mean by efforts were there, sir? After I started holding, you earned profit. No, from that profit you are giving, or before me someone held. No, before me someone held. No, from that profit you are giving. Now, sir, we are giving from the profit which is earned when the someone was holding the shares, not you, which means my efforts is there. To call it as an income, my effort should be there. I should have earned it. Here, did I earn it? No, I didn't earn it. I purchased it from someone. I took the right of dividend from someone. When I held, that dividend is not relating to that profit. This dividend is relating to the profit in which other party is holding. My previous party is holding, which means, can I tell that out of 220 crores, whatever I paid, net, without my efforts, I am getting 30 crore as a dividend from that, which means, can I tell I just spent 190 crores? Can I just tell I just spent 190 crores? And I just like any cashback. You spent 1000. Without you doing anything, you got a cashback of 150. Without you doing anything, you got a cashback of 150. Now, how much is the cost of that? Cost of that is just 850, no? Same way, you spend 220 crores, I agree. But without your efforts, someone earlier person's effort, you are getting 30 crores. Net, can I tell in that company, then you invested just 190 crores. So this is how we are going to compute the net investment. This is how you are going to compute the net investment. So, sir, what do you mean by net investment, sir? Net investment means cost of investment you did minus dividend out of pre-acquisition period. Cost of investment minus dividend out of pre-acquisition period will give me net investment. Net investment. Done. This is your net investment and net asset concept. Okay. Sir, to acquire the control in the subsidiary company, how much extra or less you paid? That is known as, or the computation of that will be known as calculation of cost of control. Extra paid means goodwill, less paid means capital reserve. Extra paid means goodwill, less paid means capital reserve. Sir, calculation of that will be known as cost of control calculation, COC. That is nothing but, sir, now you told no, net investment minus net asset. Either you will get a goodwill or you will get a capital reserve. Exactly. So net investment minus net asset, you will get goodwill or capital reserve. That's what we are calculating. How, sir? I told you what is net investment. Come on, what is net investment? That is how much you invested, sir. Okay. Minus how much you received as a dividend from the pre-acquisition profit. Or post-acquisition profit means my earnings it is. Pre-acquisition is someone's earnings. I am getting it because I purchased the shares. So how to arrive at a net investment, sir? Cost of investment in the subsidiary company minus dividend from the pre-acquisition profit. Minus dividend from the pre-acquisition profit will get a net investment. Hope it is clear. Okay. But I told you this. Did I tell what is the meaning of net asset? Arey, you told no, sir. Net asset is something like shareholders fund. Yes. When shareholders fund on the date of acquisition. Yes. Now, how to ascertain what is the shareholders fund on the date of acquisition? Balance sheet, sir. Balance sheet will be there for 1st April and 31st March. When the date of acquisition is happening? Date of acquisition happening is on 110. On 110 what balance sheet? So how much is the net asset on 110? Ascertaining that will be known as like that net asset on the date of acquisition, the shareholders fund and reserves and surplus. Basically shareholders fund as on 110 date of acquisition will be known as a net asset. Will be known as a net asset. See here, how to ascertain that, sir? It will be having two things. Shareholders fund. Shareholders fund will be having two things. What are those, sir? One, share capital. Two, reserves and surplus. One, share capital. Two, reserves and surplus. First, share capital, it's peace. Share capital won't change. Share capital won't change unless and until new shares are issued. Correct? So, on the date of acquisition, we will easily get to know how many shares were outstanding in the holding subsidiary company. How many shares were outstanding in the subsidiary company? Share capital means it will be in the face value. So, we'll consider, for example, we are holding 80%. Minority interest is holding 20%. That minority interest I will come later. Now, we are holding 80%. Minority interest is holding 20%. Now, let's say 8 lakh was the opening share capital. Share capital didn't change. Then 80% of this 6,40,000 is share of the holding company in the share capital of the subsidiary company. 1. Now comes reserves and surplus. Which reserves and surplus should be taken, sir? Which reserves and surplus should be taken, sir? Listen here. This is opening. This is closing. This is date of acquisition. Opening, closing, date of acquisition. This is called as pre-acquisition dividend. Pre-acquisition period. This is called as post-acquisition period. Now, consolidation, when you are doing somewhere here, closing date. You are doing consolidation on closing date. Now, you have to find out how much is the share capital share on this date or any date, because that is our control only, plus how much is the share in the reserves and surplus before this date of acquisition. In reserves and surplus, amount will be there, no? In that amount, how much is relating to before 110 and how much is relating to after 110? After 110 means my effort is there, boss. I acquired, I built a company, my effort is there. But before 110, my effort is not there. I am paying for that. And then I am purchasing it. So, one I am paying towards share capital. Other I am paying towards reserves and surplus of the pre-acquisition period. So your net asset, what you are investing, will include two things. 1. Share in the share capital of the subsidiary. 2. Share in the pre-acquisition reserves and surplus of subsidiary. Share in the pre-acquisition reserves and surplus of the subsidiary. Together, when you take out net asset acquired from the net investment you made, you will get what, sir? You will get either goodwill or either you will get capital reserve. You will get either the goodwill or you will get the capital reserve. If what you acquired is more than what you invested, then it is of course a capital reserve, capital profit. What you acquired is less than what you paid, then of course you paid something towards the goodwill only. So that will be goodwill. Done, sir. And always remember, as per AS 26, your intangible assets, goodwill should be written in books only when you pay for it. You can't write a self-generated goodwill. So, if the holding company is paying for that goodwill, then only holding company can treat it as a goodwill in its asset. Okay. Now, we'll see few questions slowly, one by one. Concept based we'll go, you will understand. Okay. Slowly we'll go, no worries. If it takes 10 hours also fine. But it's getting us 10 to 15 marks. So, we have to be careful in this. Easy concept. Okay. Now, we'll see one illustration. Look at this question now. From the following balance sheet of H Limited, that is holding company, and S Limited subsidiary, prepare a consolidated balance sheet of H Limited and S Limited. Okay. If you see here carefully, subsidiary company has 2 lakh rupees share capital where the shares are of rupees 10 each, which means how many shares do they have, sir? 20,000 shares is outstanding. Correct? Yes, sir. Sundry liabilities is there. Leave it. Asset, you see, there is an investment in the H Limited. Investment, they invested 20,000 shares of rupees 10 each. So they have invested in the 20,000 shares of the S Limited. So how much we are holding? We are holding 20,000 shares. How much was the outstanding shares of S Limited? 20,000 into 100. Answer will be 100%, which means S Limited is our wholly owned subsidiary. S Limited is our wholly owned subsidiary. So now, and there is no goodwill or capital reserve because net asset acquired is only share capital is the net asset they have. Correct? Only share capital is the net asset they have. So net asset acquired is share in the share capital is 2 lakh rupees and the net investment is 2 lakh rupees. So moral of the story, no goodwill, no capital reserve. So in the subsidiary company, are we going to take the S Limited's capital also now? The answer is no. We are going to take only and only holding company's capital, which is 5 lakh. Sundry liabilities are there now, sir. Sundry's liabilities, that one, that we are going to merge until we find some adjustment. I will teach you some adjustment. Till then, chill. Asset, Sundry assets, sir, 6,25,000. Investment, sir, investment won't come there. Capital and investment got cancelled. Total, if you see, liability is 625, asset is 625. That's it. That's it. Simple. One more question. One more question we'll see. Okay. Okay. See here. From the following balance sheet of H Limited and its subsidiary S Limited as on 31st December 2022. So what is the balance sheet date, sir? 31st December 2022. Prepare a balance sheet, they are asking. Shares of rupees 50 each. Holding company has 5 lakh rupees share capital. Subsidiary company has 2 lakh rupees share capital. Now which means holding company 10,000 shares. Subsidiary company 4,000 shares. Creditors, they got 1,20,000. Reserves, holding company there is no reserve. Subsidiary company there is a reserve. There is a reserve, keep in mind. Accumulated P&L, holding company 50, subsidiary company 30. Asset, if you go, sundry assets, holding company 350, subsidiary 260. Also investment is there of rupees 3 lakh is been invested where 4,000 shares were acquired. H Limited purchased shares in S Limited on 31st/12/2022. So this is date of acquisition. Sir, is the date of acquisition and the balance sheet date both are same? Yes, sir. Both are same. So everything shall be treated as pre-acquired. Yes, pre-acquired. From next day it will be post-acquired. So today whatever is there in the balance sheet, everything is pre-acquired. So try to understand. Date of acquisition is 31/12/22. Balance sheet date is 31/12/22. How many percentage we are holding, sir? We are holding 4,000 shares. How much was outstanding, sir? 4,000 into 100, which will come to 100%. So we are holding 100%. So let's compute cost of control first, because we don't know how much is the net asset we are acquiring, but we know how much is the net investment. Net investment is 3 lakh, no doubt in that. Net investment is 3 lakh. Net asset shall we compute? Share in the share capital of the company. How much is the share in the share capital of the company, sir? 2 lakh. Share in the reserves and surplus of the subsidiary. How much it is, sir? Reserves and surplus is 40,000. 40,000. On the date of acquisition itself, they have 40,000. On the date of acquisition itself, they have 40,000. Because date of acquisition, balance sheet date is same. So in between, if it's there, that we will see. One by one will go. Now, date of acquisition. So how much it is? 40,000. So your net asset acquired is 240,000. Your share in the net asset of the subsidiary is 240,000, where you have invested 3 lakh rupees. That is reflecting in your investment. So 60,000 rupees is what you are paying extra, will be towards a goodwill. Now how you are going to show the goodwill, sir? Goodwill will be shown on the asset side. Try to understand, this is happening only and only in consolidated financial statement, not in standalone. In standalone subsidiary financial statement, capital will be there in subsidiary books. Investment will be there in holding company. Only and only it is happening in the consolidated financial statement. See here. Cost of investment 3 lakh. Dividend out of pre-acquired profit, nothing. You got net investment. Share in the share capital of the subsidiary, 2 lakh into 100%, 2 lakh. Pre-acquired reserves and surplus. There were two reserves and surplus. One is reserves, one is P&L. Reserves 10,000 was there, 100% is ours only. Sir, how do you know pre-acquired? On the date of balance sheet it is. Acquisition is on the date of balance sheet. So everything is pre-acquired. P&L 30,000 was there, 100%, 30,000. Goodwill. So consolidated balance sheet, if you see, what happens, sir? In the consolidated balance sheet, what happens? Share capital, only holding companies will come. There is 5 lakh. Correct? Creditors, both will come, 120. Reserves and surplus, again, shareholders fund, only holding companies it will come. Nothing is there in the holding company. P&L, again, holding companies it will come, 50,000. Done. Asset side, if you go, Sundri assets, around 6-10,000 it will come. Investment, nothing. So if you see here, goodwill is there. Goodwill will come. How much, sir? 60,000. 60,000 is a goodwill. Total asset is 670,000. Liability is how much, sir? 670,000. It's matching. Goodwill will come in the asset side as a non-current asset. Intangible asset. It is intangible, which means you can't touch, but you can feel its existence. Share capital, creditors, reserves, nothing. P&L will come. Sundry assets, goodwill will come. Done. One more. Listen here. From the following balance sheet of H Limited and S Limited as on 31st December 22, prepare a consolidated balance sheet. Shares of rupees 100 each. H Limited has 6 lakh share capital, so which means number of shares is 6,000. S Limited has 4 lakh share capital, number of shares are 4,000. Creditors we have 2 lakh and 50,000. Reserves is around 40,000, 20,000. P&L is around 70,000, 15,000. Done, sir. Total. Sundry asset they have given. Investment in 4,000 shares of S Limited they have given. First question what you should do is, you should check when is the date of acquisition. Date of acquisition is 31st December. They have given there. On 31st December. When is the balance sheet date? Balance sheet date is also 31st December. What is the moral of the story? Moral of the story is whatever is there on these dates is nothing but pre-acquired. Everything is pre-acquired. There is nothing post-acquired. Done. Next point is what, sir? Next point is finding out how much is the share of holding, how much is the share of subsidiary minority interest. How much shares we are holding, sir? We are holding 4,000 shares. How much was the maximum shares of subsidiary? 4,000 only into 100, which means it is 100%. We are holding 100%. Done. Next step is what, sir? Next step is to find out how much is our net investment. Net investment, as there is no pre-acquired dividend distribution and all, is there 410,000. Net investment is 410,000. Okay. Now net asset acquired. Share in the share capital of subsidiary. 4 lakh is the share capital of the subsidiary. In that 100% is also ours only. 4 lakh. Share in the reserves and surplus of the subsidiary. Reserve is there 20,000. In that 100% is also ours only. And reserves is pre-acquired reserves. Okay. P&L also, pre-acquired P&L 15,000 is there. In that also 100% is ours only. So all these are the things I have acquired. 435,000. To acquire this 435,000, how much did you pay, sir? 410 I paid, which means around 25,000 is my profit capital reserve. My profit capital reserve. I'm going to show it under reserves and surplus. Hope it is clear. So consolidated balance sheet, how it looks, sir? Share capital, only holding companies it will come, 6 lakh. Creditors, 250. Reserves, of course, holding companies only will come. Shareholders fund, which is pre-acquired, won't come here. P&L, again 70,000, only holding company. Sundry asset, 9,85,000. Investment won't come. And also in the liability side, in the reserves, there is capital reserve of around 25,000. So total how much it is, sir? 6 lakh, 7 lakh 50, 7 lakh 50, 8 lakh 20, sorry, 7 lakh 50, 8 lakh 20, sorry, 8 lakh 50, 9 lakh 20, 9 lakh 60, 9 lakh 85. So liability side it is 9 lakh 85, asset side it is 9 lakh 85,000. That's it. See here. Date of acquisition was 31st December 22. Balance sheet date 31st December 22. Percentage of holding 4,000, 100%. Cost of control computation, cost of investment in the shares of the subsidiary company 4,10,000, whereas dividend from the pre-acquired profit is 0. So net investment is 4,10,000. Share in the net asset now, minus share in the net asset. In net asset, two things will be there. Share capital and pre-acquired reserves and surplus. Share capital was 4 lakh. Our share is how much? 100%. So 4 lakh into 100%, you will get 4 lakh. Pre-acquired reserves and surplus, both reserves and surplus, whatever was there, everything was pre-acquired because date of acquisition itself is last day. So it is 20,000 into 100%, 20,000, 15,000 into 100%, 15,000. So net, your share of net asset is 435. Capital reserve, you can tell it as 25. In the consolidated, if you see, share capital only holdings come. Reserves and surplus, only holding companies will come because the other reserves and surplus got adjusted. P&L also only holding companies it will come because other P&L got adjusted. Capital reserve 25,000 and creditors 250,000. Done. This is the very basics. Hope you got bit of hold here. Now we'll go for one more item, that is dividend, treatment of dividend, and also reserves and surplus and minority interest. If we do so much, almost all the things are done. Later small things will come. When and where it comes, I am going to explain you that time. Okay. Then we can see remaining questions. Done? Yes, sir. Now concentrate. It is very important. Very important to concentrate, people. Please concentrate. Now, how to treat the dividend, sir? Which dividend? Not holding company's dividend. Holding company's dividend, what holding company has to do? Nothing. Subsidiary company, what it has to do? Nothing. Because subsidiary company can't hold the holding company share. So listen here. We are talking about subsidiary company's dividend, which is received by the holding company. How to treat it? Sir, dividend issued out of pre-acquired profit, post-acquired profit. Dividend is acquired out of pre-acquired profit and dividend is acquired out of post-acquired profit. If the dividend is acquired out of pre-acquired profit, I already told you what to do. That is, reduce it from the cost of investment while arriving at a net investment. Correct? If at all subsidiary company issues some dividend, then the dividend you should not show it as your income in the P&L. If at all subsidiary company issues any dividend out of pre-acquired dividend, you can't show it as your income because it is not your income. It's not your income. It is governed under AS 13, investment. In investment, they tell, boss, you got a pre-acquired dividend, then you paid for it. So if at all you are paying for shares, if at all you are paying 300 rupees, but you are getting a pre-acquired dividend of 10 rupees, which means you knew that 10 rupees is not yours. Net, that was supposed to go to someone else, but instead of them, you are receiving because you hold a share, which means while paying 300, you paid 290 towards your share, 10 towards the dividend. So don't treat this 10 rupees as your income. You paid for it, you got it back. That's it. Only 290 is your investment. So always remember, whenever the whole subsidiary company gives some dividend out of pre-acquired reserves and surplus, then reduce it from the cost of investment while arriving at a net investment. Sir, what if it is out of post-acquired profit, sir? What if it is out of post-acquired profit? Then of course, boss, my effort is there. It's my income. Then you can treat it as your income and credit it in your P&L. Treat it as your income and credit in your P&L. Done. Sir, yes. How do we get to know whether the dividend is issued out of pre-acquired profit, post-acquired profit, sir? They will give in the question. Or they will give in the question, sir, always? Sometimes. Then, how to ascertain, sir, whether it is pre-acquired or post-acquired? How to ascertain dividend is given out of pre-acquired or post-acquired? That is, if the question is silent about the profit appropriated towards dividend, from which profit you are giving dividend, then what you should do, sir? One. It could be treated this way. You are going to treat it as declared out of current year profit, and any deficit previous year reserves are used. So always remember, if the question is silent about which reserve is used, P&L reserve or general reserve, which money is used for the dividend purpose, if this is silent, always remember one thing. First, you are going to think as it has been issued out of current year's profit. It is issued out of current year's profit. If at all the shortage is there, then you are going to treat it as that shortage has been bought from previous year profit. This is only when question is silent. What is one assumption? One assumption is, that is, boss, you issued out of current year profit. If at all the shortage was there, it has been bought from the opening balance, previous year reserves. Listen here. Declared out of current year profit, and any deficit previous year reserves are used. Current year profit, let's say rupees 60,000. Okay. Dividend declared is rupees 80,000. Always remember, dividend declared means not only of the holding company you should check. Always remember, if the holding company is holding 80% and you are getting 80,000, then dividend declared by subsidiary is not 80,000. Dividend declared by subsidiary is 1 lakh, because for minority also they should give, no. You can't just give dividend to one class of shareholders. If you issue, you should issue it on 100% shares also. On 80%, 80,000, on 100% question mark, 1 lakh. Now, for the time being, current year profit is how much, sir? 60,000. Dividend declared is how much, sir? 80,000. Now, assumption number one. This 80,000, out of this 80,000, 60,000 has been from current year profit. Other 20,000 is from the past year profit. 60,000 is from current year profit. Other 20,000 is from past year profit. Okay. Now, one thing is pretty simple. During the year you acquired. Now, this 20,000 is of last year. Which means this is not even a question to ask whether it's a pre-acquired or post-acquired. This is not even a question to ask whether it is pre-acquired or post-acquired. People, this is always pre-acquired because we acquired in this year. This profit is of last year. So straight away we can tell this 20,000 which we used last year's, that is pre-acquired. Pre-acquired. Okay, sir. Current years you are using 60,000, no? Current year using 60,000, no? This is post-acquired, no, sir? This is post-acquired, no, sir? The answer is big no. What? Why, sir? Because try to understand, people. From 1st April, till 31st March, you have made a profit of 60,000. Somewhere in the month of, let's say, 1st January, you are acquiring a share. 1st January, you are acquiring a share. Now try to understand. Till the date of acquisition, it is free only, no? Now this 60,000 is earned throughout the year. Now what you are going to do? 60,000 in this, how much is earned in first 9 months? That is April, May, June, July, August, September, October, November, December. Out of 60,000, how much is earned in the next 3 months post? So around 45,000 is treated as pre, around 15,000 is treated as post. Moral of the story, out of 80,000 declared, except 15,000, everything is pre-acquired. That is around 65,000 is pre-acquired. Hope it is clear. Always remember, current year profit, that doesn't mean that everything is post-acquired. Suddenly we get excited. Okay, sir, that is post-acquired. No. Acquisition is happening somewhere in between. Profit started earning from 1st April. If acquisition happens on 1st October, then 6 months is pre, 6 months is post. No. 1st December, 9 months is pre, 3 months is post. Accordingly, we should divide the profit. Done. Assumption number 2. Sir, declared out of previous year profit. And only deficit, that is current year profit, is used. So, assumption number 2. Sir, which assumption we can do, sir? Any assumption. You should write and come. That's it. Better assumption number 1. Assumption number 1 is better. See here, as per this example, dividend declared is 80,000 only, but reserves and surplus last year balance 50,000 we had. So what we are going to do now, sir? In this 80,000, 50,000 is out of last year profit, no doubt. Last year that wasn't even our subsidiary, which means it is of course the pre. 50,000 is pre-acquired. Now the other 30,000 is declared now. This is out of current year profit. Now this should be divided among pre and post, like what we did last time. 30,000 got divided into 2. In 9 months, how much we earned? In 3 months, how much we earned? In 9 months, we earned 22,500. In 3 months, we earned 7,500. So that 9 months will be pre-acquired. 7,500 is post-acquired. This is the treatment of dividend. Come on again. Dividend, people. If it's a pre-acquired, then just reduce it from the net investment. That's it. If it's a post-acquired dividend, credit it to P&L because it's your income. Sir, how to determine pre or post? No question mein no hint is given. Then what we should do is assumption number 1. Boss, whatever the dividend is there, first we use the current year profit, next we use the last year profit. Now last year profit is post-acquired only because we are acquiring in current year. Current year profit, we can divide it into 2 parts. How much is pre-period, how much is post-period? Whatever is pre-period, pre-acquired, how much is post-period, post-acquired. Done. Second assumption. First we issued out of last year profit. Extra if any required, that we used current years. Now last year's post-acquired, take it out. Whatever extra is used, in that we are going to divide current years. Current year pre-acquired, current year post-acquired. Post-acquired post, pre-acquired pre. That's it, sir. That's it. Now, reserves and surplus. Reserves and surplus could be 2. Pre-acquired, post-acquired. You already know pre-acquired what to do, sir. Pre-acquired will be treated as a part of net asset. Pre-acquired reserves and surplus of subsidiary will be treated as part of net asset, which means this is considered while calculating goodwill or capital reserve, which means it already got adjusted. Then when it got already adjusted, then what you have to do? Nothing. Ignore it because it got adjusted in the cost of control. See here. Adjust it while arriving at a cost of control. That's it. It will not be considered in the consolidated balance sheet. Try to remember this. Pre-acquired dividend won't form part of consolidated balance sheet because it will be adjusted in the cost of control. Because from investment you are taking 3 lakh. From investment you are taking 3 lakh. At the same time, asset side you are taking 2 lakh rupees share capital, 1 lakh rupees reserves and surplus. Both should go, no? This will also go. Otherwise, balance of balance sheet. That's why. So pre-acquired reserves and surplus, if any, make sure you adjust it to COC. It won't form part of consolidated balance sheet. Sir, if it's a post-acquired, sir, then it is yours only. That got adjusted nowhere. Just add it to the holding company's reserves and surplus in the CBS. Just add it to the reserves and surplus. That's it. Holding company reserves and surplus will be there. Subsidiary company reserves and surplus will be there. Which reserves and surplus? Post-acquired reserves and surplus. Together we'll show it as a reserves and surplus in the consolidated balance sheet. Will be added to the reserves and surplus of the holding company in the consolidated balance sheet. That's it, sir. That's it. Come on. Reserves and surplus. What to do? Reserves and surplus. What to do? Post-acquired, pre-acquired. Pre-acquired, adjust it to cost of control. Post-acquired will be treated as a normal reserves and surplus and shown in the consolidated balance sheet. Sir, dividend what to do, sir? Dividend, check pre-acquired or post-acquired. If it's pre-acquired, adjust it to NI. Post-acquired, then credit it to your costing P&L as a income. Capital, sir, holding company's capital will come. Subsidiary company's capital won't come because subsidiary company's capital and pre-acquired reserves and surplus getting adjusted towards the net investment of the holding company. That's it. Okay. So whatever we saw just now is just of the 100% subsidiary, that is wholly owned subsidiary. So how it will differ when it is a partly owned subsidiary, that we are going to see now. Okay. Let's see that now. Okay. Now we'll see how the partly owned subsidiary thing affect the consolidated balance sheet. So in this scenario, people, what we should do is we should calculate minority interest share. How to calculate that, sir? Share in the share capital of subsidiary. For example, if we are holding 80%, minority shareholders are holding 20%. If we are holding 80%, minority shareholders are holding 20%. Now, while computing cost of control, how much share capital got adjusted? Only 80% got adjusted. Remaining 20% will be treated as what? Minority interest. Remaining 20% will be treated as minority interest. Done. Share in the share capital of subsidiary. Okay. Now, coming to reserves and surplus. Pre-acquired reserves and surplus. In the pre-acquired reserves and surplus, how much got adjusted? 80% got adjusted. Remaining 20% is what, sir? Minority interest. Post-acquired reserves and surplus, that didn't get adjusted in the cost of control. Okay, sir. So what? So it will come as a reserves and surplus of the holding company. Only holding company share, which is 80%. Remaining 20% is whose share, sir? Remaining 20% is minority interest share. Try to understand what is happening. Share capital, 80% is ours. That will be considered for computation of COC. 20% is minority. That will take there. Pre-acquired P&L, pre-acquired reserves and surplus, 80% is ours. That will come in our COC. 20% is minority interest. That will be there. Because minority interest people, 20% people were there before we came also. They are there after we came also. which means they have a share in the pre-acquired profit as well as post-acquired profit. They have the share in the pre-acquired profit as well as post-acquired profit. So what is the minority interest, sir, or how it will be computed, sir? Minority interest will be computed as share in the pre-acquired share capital of the company, that is subsidiary, share in the share capital of subsidiary, share in the pre-acquired reserves and surplus, also a share in the post-acquired reserves and surplus, because they were there before we came, they are there after we came. Okay, sir. Where we will show the minority interest, sir? Minority interest will be shown as a other non-current liability in the cash flow consolidated financial statement. How the minority interest will be shown, sir? Minority interest will be shown as a other non-current liability in the consolidated financial statement. Okay. Now majority of the things. Okay. Now we'll see. Final. All adjustment will be there in one question. No. Now how to look at that question? First, we should check what is the date of acquisition. First, we should check what is date of acquisition. Later, we should check how much is percentage of holding, how much is percentage of minority interest. Using that, we should compute how much is cost of control, how much is minority interest. After that, we should check is there any special adjustment like revaluation, bonus issue, etc. that I will tell later. So far, we have learned till step number 4. That's it. After doing step number 5, we are going for the consolidation. That's it. Yes, sir, that's it. So, what are the certain assumptions to be made while preparing a consolidated financial statement? Four important assumptions what are to be made while preparing a consolidated balance sheet. Consolidated balance sheet. Let's see one by one. In question, there is a general reserve. In question, there is a general reserve. But it is not mentioned whether it is opening or this general reserve is done during the year. Why is it that important, sir? If it's opening, then straight away we can tell pre-acquired, correct? If it's during the year, then again we have to divide pre and post. Jatre, correct? Now, if the question is silent about opening balance of the general reserve, it is assumed as closing balance itself is a opening balance. Try to understand. If they don't tell out of the general reserve balance how much is the opening balance, then we are going to treat how much is closing is there. No, that itself is a opening, which means whole general reserve we are going to treat it as a pre-acquired reserves and surplus. Pre-acquired reserves and surplus. Now, sir, P&L account, they have given closing, they have given how much is closing, but they haven't given how much is opening. Then how much shall be treated, sir? How much shall be treated as that, sir? If the question is silent about opening balance of the P&L account or profit or loss during the period, then the closing balance shall be assumed as a profit or loss for the period and opening balance is nil. For example, they have given P&L in the balance sheet of the subsidiary. Closing balance sheet, no, they usually give closing balance sheet. P&L they have given rupees 80,000. Rupees 80,000. They didn't tell how much is opening. Also, they didn't tell how much is earned. How much is earned during the year. Then try to understand what we are going to assume is whatever is there in the P&L now. 80,000. This is earned during the period. That is P&L of the period. Opening balance was nil. We are going to assume this way. If at all they give during the year it is 60,000. Then straight away out of 80,000, 60,000 is of during the year, which means 20,000 is of last year. If they don't give nothing like this, then sir, what if general reserve, sir? General reserve opening closing, how to adjust that, sir? General reserve, if they give closing 1 lakh, opening they didn't tell anything. In that scenario, we are going to treat Opening is rupees 1 lakh only. During the year, nil. Opening is 1 lakh only. During the year is nil. So people, general reserve. If the question is silent about general reserve, then treat it as opening. If the question is silent about P&L, then treat it as profit during the period and opening was nil. If the question is silent about bonus is issued out of general reserve or P&L, if the question is silent about whether bonus shares are issued out of general reserve or P&L, then assume it as general reserve balance is used first. Wherever necessity arrived, P&L balance is used. If the question is silent about whether general reserve balance is used first or P&L balance is used first, then assume general reserve balance is used first, then P&L balance. This is what even we assume, general assumption it is. This is what even assumed when doing bonus issue. If you remember, I used to write off bonus amount, general reserve first. If anything was required, then I used to bring the P&L, although both are of the same nature. Now, if the question is silent about dividend, that is whether it is given out of P&L or general reserve, it is given out of P&L or general reserve, then always and always assume that it is appropriated from the P&L first. It is always and always assume that it is appropriated from the P&L first. With this, majority of the consolidation things are done. We'll see now. Last charts we'll see how to adjust all these things. Okay, how to adjust all these things. Also, there are certain intercompany accounts and all is there that we'll see. Before that, we'll see how the share capital, reserves and surplus will be there. Share capital of the holding company will form part of course, consolidated balance sheet. No doubt in that. Here, holding company is not even in question. Holding company's capital is not even in question. Holding company's capital will form part of consolidated balance sheet. Subsidiaries company's capital. Share of the holding company, we adjusted it to COC. So it won't come in the balance sheet. It won't come in the consolidated balance sheet. Share of minority interest. It is added to minority interest. If you remember, three things were added to minority interest. Share in the share capital, share in the pre-acquired reserves and surplus, share in the post-acquired reserves and surplus. Now it will be added to the minority interest and it will be shown in the non-current liability. Of course, no, if you are taking out 100% and you are just adjusting 80%, remaining 20% balance will remain. That balance should not remain means transfer it to some other account called non-current liability account called minority interest. That's it. So come on again, share capital, holding company share capital, of course it will form part of the consolidated balance sheet. However, subsidiary companies, it won't form part of balance sheet. Then how it will be, sir? Holding companies anyhow it will get adjusted to cost of control, whereas your subsidiary companies share of minority interest shall be added to minority interest, which will be later reflected in the non-current liability. Going to reserves and surplus. Reserves and surplus could be divided into two. Pre-acquired reserves and surplus, post-acquired reserves and surplus. Pre-acquired reserves and surplus, post-acquired reserves and surplus. Pre-acquired reserves and surplus, that could be further divided into share of holding company, share of minority interest. That could be further divided into share of holding company, share of minority interest. If it's a share of holding company, adjust it to cost of control. I already told you all these things. Adjust it to cost of control. If it's a share of minority interest, it will be added to minority interest. Later it will be shown as a non-current liability. Going to post-acquired. Share of holding company, it is your income added to the reserves and surplus. Whereas share of minority, again it will be added to the minority interest and it will be shown in the non-current liability. Minority interest concept will arise because of the assets of the subsidiary and liabilities of the subsidiary are recorded at 100% in the consolidated balance sheet, although although holding company doesn't hold 100% share in the assets and liabilities. Sir, what do you mean by this, sir? What shocking you are giving? Try to understand. If you take a subsidiary company, non-current asset is 100, non-current liability is 300. Non-current asset is 100, current asset is 300. Non-current liability is 200. Current liability is, let's say, 50. Now holding company holds 80%. Holding company holds 80%. Now, while recording it in the consolidated balance sheet, you are not going to take 80% of current asset, 80, 300 into 80%, 240. Here liability 160, 40, like this you are not going to take. You are going to take whole 100%. Why, sir? Try to understand, no? Try to understand, no? Let's say A company is there, or let's not complicate. H company is there, holding company. S company is there, subsidiary. H company holds 80% shares in the S company. Now, there is one land in the S company which is valuing rupees 100 crores. There is one land in the S company which is valuing rupees 100 crores. Now 20% of this power control is with minority interest. 80% of the control is with holding company. Now try to understand. Although we have a ownership of 80%, 100% control is with us only. How, sir? We will tell, we'll build a building in it. We'll build a commercial building in it. Minority interest will tell, boss, we'll build a flats over here. Residential property will do. Who will win? Okay, we'll go for a voting. No, let's go for a voting. 20% will vote for a flat. 80% will vote for building. Who will win? Of course, the holding company. So try to understand. Although you are not a 100% owner, but still you have control, no? Although you are not a 100% owner of that, still you have control over it. That's why in consolidation, subsidiary companies' assets and liabilities, irrespective of how much is held by the minority interest, whole amount shall be treated as total asset, total liability. You are not going to divide asset and liability into minority and holding company. Whole asset will be added to the consolidation. Whole liability shall be added to consolidation. So that's the reason. Now asset side, although you hold 80%, you have taken it 100%. Now liability side, some 20% should come. No, that's what the minority interest is. So minority interest concept will arise because of the asset of subsidiary and liabilities of subsidiary are recorded at 100% in the consolidated balance sheet, although holding company doesn't have 100% share in such asset and liability. Ownership won't be there, but control wise we are going to take. Okay. Now, sir, certain intercompany accounts will be there. In that scenario, eliminate in the consolidated balance sheet. What, sir? What do you mean by that, sir? Try to understand. Subsidiary company is a debtor for 50,000 in the holding company book. Now subsidiary company is a debtor for rupees 50,000 in the holding company's books. Okay. Holding company is the creditor in the books of subsidiary for 50,000. Now, instead of adding this 50,000 in creditors, adding this 50,000 in debtors, just eliminate it, no? So if there are intercompany transactions are there, just eliminate it. Just like in your P&L, if they give certain purchases are made from the holding company, eliminate that purchase. In the holding company, eliminate the sales. So you are not going to show it as debtor as well as creditor. But sometimes what happens, in one book creditor is shown at different amount. In one book debtor is shown at different amount. Holding company, in the holding company, subsidiary company is shown as a debtor for 50,000. In the subsidiary company, holding company is also shown as creditor only. Correctly they are showing. But amount is 30,000. Amount is 30,000. Now, why the 20,000 difference is coming? Boss, subsidiary company sent it to holding company, but holding company not yet received. So, subsidiary point of view is correct. Yes, boss, money went out. So, we have credited your account. Sorry, debited your account. Holding company point of view is also correct. Still money is not received. Boss, that's why we didn't debit your account. Okay. In that scenario, what to do, sir? In that scenario, eliminate the cash in transit by debiting it to the cash and cash equivalent and then eliminate intercompany account balance. What you should do, sir? From the holding company, debtor of whole 50,000 you take out. But only 30,000 balance is there, no sir? Array 50,000 you take out, no? Sir, but extra 20,000 went out. Don't worry, that you show in cash and cash equivalent as cash in transit, 20,000. Now proper. So in consolidation, what you will do, sir? You will take out full amount. Whatever the is there, that remaining amount will be shown as cash in transit in the cash and cash equivalent. Hope it is clear. Anyhow, questions are there. I will show it then. Don't worry. Okay. That you don't worry. Now there is bonus issue and adjustment of stock reserve. 2 more adjustments are there. If the 2 more adjustments are done, then your consolidation is done. Now it is adjustment of bonus issue. Okay. Yes. Now we are going to understand how the bonus issue will be affecting the consolidated balance sheet. People, what is bonus issue, sir? Bonus issue is free shares given to existing shareholder. One thing you remember, now holding company is also a shareholder in subsidiary company. So now we are talking from the point of view of subsidiary company issuing bonus to holding company. How we are going to treat that? That we are going to check here or see here. Okay. See what happens, sir? When the bonus is issued, issuing companies reserves will be decreased. Share capital will be increased. Hope you remember the bonus issue where we used to debit CRR, one reserve it was, securities premium, one reserve, and general reserve, P&L. This we used to debit, which means this we used to decrease. Reserves, debit means decrease. To bonus to equity shareholders, later equity shareholders to share capital we used to do. So decrease in this, increase in this. Correct? Yes, sir. Now, whatever the subsidiary company issues as a bonus, that could have been received by the holding company, received by minority interest. Yes, sir. It would have been received by the holding company or by minority interest. Now, if at all it is received by the holding company, cost of investment won't change because percentage of holding won't change. Where it is received by the minority interest, there also percentage of interest won't change. Why, sir? Try to understand. Now let's say subsidiary company has 1 lakh shares. Now holding company has 60,000 shares. Minority interest has 40,000 shares. Holding company has 60,000 shares. Minority interest has 40,000 shares. Now, minority, what subsidiary company did is they issued a ratio shares is to 1:2. That is 1 share for every 2 shares held. Now holding company will get 30,000 shares. Minority interest will get 20,000 shares. Here it will become 50,000 extra. Now, earlier what was the ratio, sir? Earlier what was the ratio of holding company? Holding company, it was 60,000 divided by 1 lakh. 60%. Minority interest 40,000 divided by 1 lakh, 40%. After bonus, sir, after bonus, holding company 90,000 divided by 150,000, 3 by 5, again 60%. Subsidiary company 60,000 divided by 150,000, 2 by 5, again 40%. So try to understand, people, whenever the bonus is issued, percentage of holding won't change. Percentage of holding won't change. Hope it is clear. Yes, sir. Then sir, now how to treat the bonus, sir? How to treat the bonus? All you have to check is whether bonus is issued out of a pre-acquired reserves and surplus, whether it is issued out of a post-acquired reserves and surplus. Whether it is issued out of pre-acquired reserves and surplus, whether it is acquired out of post-acquired reserves and surplus. Sir, if it's issued out of pre-acquired reserves and surplus, if it is issued out of pre-acquired reserves and surplus, then holding company, no change in cost of control. Minority interest, no change in final amount. How, sir? I will tell. Listen here. Before bonus, this is the situation. 1 lakh shares are the outstanding of rupees 10 each. Reserves and surplus available is 5 lakh. Before bonus, subsidiary company issues bonus at 40%, which means they are going to issue 4 shares for every 10 shares held, or you can tell 2 shares for every 5 shares held. Holding company is holding 70% right now. Minority interest is holding 30%. And holding company is holding 70% by paying rupees 10 lakh. So net investment is how much, sir? Net investment is 10 lakh. Now, sir, what is the cost of control before bonus? Assuming reserves and surplus as a pre-acquired. Net investment is how much, sir? 10 lakh. Done, because there is no pre-acquired, dividend from the pre-acquired reserves and surplus. Okay. Share of net asset is how much, sir? Share capital is how much? 1 lakh into 10 lakh. We hold 70%, which will come to 7 lakh. And reserves and surplus how much, sir? 5 lakh is there. And 70% will be the amount what we are holding, and it will become 350,000. Net we can tell our capital reserve of 50,000. Correct? Yes, sir. Now, sir, if the bonus is issued, does our net investment change? Of course no. Share in the share capital, of course it will change, sir. Percentage it won't change, amount will change, because now the share capital of the subsidiary is not 10 lakh anymore, it is 14 lakh. Because 40% bonus is issued, share capital got increased by 14 lakh. Done. Now we hold 70% of 14 lakh, which will come to 9 lakh 80,000. Reserves and surplus, sir. Before bonus, reserves and surplus was 5 lakh. Bonus we issued to the extent of 4 lakh, which became rupees 1 lakh. Now it is 1 lakh into 70%. 1 lakh into 70%, which will come to 70,000. So net capital reserve will change? No, sir, it will remain same. So earlier also 50, now also 50. What I am trying to tell, when the bonus is issued out of pre-acquired reserves and surplus, what is happening here? Next, minority interest shall we calculate? Before 10 lakh into 30% in the share capital, 3 lakh, 5 lakh into 30% in the reserves and surplus, 150,000, together 450,000. After bonus, sir, share capital is 14 lakh, so 14 lakh into 30%, 420,000, 1 lakh into 30%, 30,000, 4 lakh 50,000. No change. No change. Sir, what if reserves and surplus is treated as a post acquired? They are telling no. Reserves and surplus. The bonus is issued out of reserves and surplus as a post. Now try to understand. Let's calculate the cost of control of the holding company. Net investment is 10 lakh only. Yes, sir. Share in the share capital, before bonus I am talking, 10 lakh into 70%, 7 lakh. Share in the pre-acquired reserves and surplus. There is no pre-acquired reserves and surplus as such, nil. So we can tell our goodwill is 3 lakh. Correct? Sir, after bonus, net investment is 10 lakh only. Share in the share capital of the company. After bonus, share capital is not 10 lakh anymore. It is 14 lakh. So 70% of 14 lakh will come to 980,000. So share in the pre-acquired reserves and surplus, anyhow it's not there. Goodwill will come to 20,000. Try to understand. Here changing. When you treat pre-acquired, when you treat bonus is issued out of pre-acquired reserves and surplus, no changes. From reserves it will go to share capital. That's the only difference. Reserves will get decreased. Share capital will get increased. That's the only difference. And both forming part of calculation of COC, that won't change. But here what is happening? Reserves and surplus won't form part of calculation of cost of control. But share capital got increased. So automatically share capital changed. Reserves and surplus didn't change. Share in the reserves and surplus. Automatically our COC changes. Minority interest, sir. Minority interest, try to understand. Share in the share capital they have, which is 10 lakh into 30%, 3 lakh. Share in the pre-acquired reserves and surplus, 0. Share in the post-acquired reserves and surplus, that is 5 lakh into 30%, which will come to 150,000. Together you can tell you have around 450,000 rupees as a minority interest, which should be shown in the non-current liability. Correct? Yes, sir. Why it should be shown as non-current liability, sir? Because in the asset side and liability side, you are not taking your subsidiary company's assets and liabilities at whatever you are holding, 70%. No, you are taking it as a 100% only, because you have 100% control, although you don't have a ownership. Yes, sir. Sir, after bonus, sir, after bonus, how much will be the minority interest? 14 lakh into 30%, which will come to 420,000. Share in the pre-acquired reserves and surplus, 0. Share in the post-acquired reserves and surplus. Out of 5 lakh rupees, people, out of 5 lakh rupees, 4 lakh is gone towards issue of bonus. 1 lakh is remaining. So 1 lakh into 30%, 30,000. So 420,000 plus 30,000, 450,000. Moral of the story, whether bonus is issued out of pre-acquired, bonus is issued out of post-acquired, minority won't change. Minority interest won't change. However, if at all, it's from the point of view of holding company's cost of control, if the bonus is issued out of pre-acquired reserves and surplus, nothing will change, because from the reserves and surplus, which is considered for the calculation, it is going to the capital. But if at all it is post-acquired, that post-acquired reserves is not considered for calculation, but share capital got increased. So your net asset will increase. Share in net asset will increase. So now we will understand this. If at all issued out of the pre-acquired reserves and surplus, if at all it is issued out of pre-acquired reserves and surplus, then holding company, no change in cost of control, boss, but minority interest, change in the final amount. No change in the final amount. When it comes to issued out of post-acquired reserves and surplus, boss, goodwill will decrease or capital reserve will increase, because your net asset will increase. Value of net asset acquired will increase. So goodwill will either decrease or capital reserve will increase. Minority interest, no change in final amount. That remains same. Ditto. Okay. That is all about your bonus. If you had understood, great. If you haven't understood, don't worry. when we see the sum, we will understand it better. Now we are almost near our last two adjustments. One is for the revaluation, one is for the stock reserve. One is for the revaluation, one is for the stock reserve. What is it, sir? Try to understand. Holding company might send some goods to subsidiary company. Subsidiary company might send some goods to holding company. Now let's assume holding company is sending goods to subsidiary company, cost of which is rupees 1 lakh to the holding company. They sent it at a selling price of 150,000. They sent it at the selling price of 150,000, which means we are sending at 50,000 profit. Sir, net, if you think from the group company point of view, that is holding company plus subsidiary company, when will you realize this 50,000, sir? Did you realize this 50,000? Of course, no. Where did you realize? Subsidiary is also yours, holding is also yours. If at all you sell it to final customer, then only you can tell that this 50,000 is recovered. This 50,000 is realized. Which means, try to understand, in the closing stock of the subsidiary, you are going to value it on the basis of course, rupees 150. Sir, but it is at a selling price, no sir. Array, selling price of holding. Think from the point of view of subsidiary. For the subsidiary, 150 itself is a cost. For the subsidiary, cost itself is 150. They are buying from the holding at 150. So cost itself is 150, people. So closing stock will be valued at the rate of 150,000, not 1 lakh. Not 1 lakh. So automatically can I tell that more closing stock in the subsidiary? Yes, sir. Value is more than cost from the group company point of view. Correct? See the example, you will understand how to adjust that. Let's say subsidiary company received 1,50,000 goods from the holding company. Yes, sir. In that 60% is sold, 40% is not sold, which means to the extent of 90,000 in it is sold. Whereas other 60,000 is unsold. Correct? Yes, sir. Try to understand, people. Is this 60,000 complete cost, sir? Yes, complete cost to the subsidiary. But group company point of view, is it the cost of closing stock? The answer is big no. Then how much it is, sir? When it was 150,000 selling price, cost was just 1 lakh. Yes. Now 60,000 is the selling price of that. Cost will be 40,000. Cost will be rupees 40,000. Which means closing stock is from the group company point of view. Array, from the standalone subsidiary, no problem at all. From the group company point of view, it is not realized. So from the group company point of view, you can tell that, boss, rupees 20,000 overvalued. Rupees 20,000 closing stock overvalued. Overvaluation of closing stock leads to more profit. Overvaluation of closing stock leads to more profit, which means there is 20,000 unrealized profit in your profit of subsidiary. In your profit of subsidiary, there is 20,000 unrealized profit. Sorry, in the profit of holding. Because this 60,000 is taken as a selling price in the holding, no? Where the cost was just 40. So, now, in the consolidation, what you should do, sir? In the consolidation, closing stock, consider it as 40,000 only. That is, treat it at cost only. Closing stock, take it as 40,000 only. Whereas the other 20,000 is there, no? Which is already there in the holding company's P&L. In consolidation, P&L, holding company, let's say 5 lakh is there. Now for the consolidation purpose, reduce 20,000 from it and you take only 4,80,000. So in the inventory side, closing stock side, take only cost of that. In the reserves and surplus, holding company's profit, for the sake of consolidation, take it as 480. Standalone, it remains same what it is. Only for consolidation, take it as 480,000. Take it as 480,000. That is, reduce it from the holding company's profit while preparing consolidated balance sheet. Actually speaking, if at all subsidiary company sends the goods to holding company, the thing will change. The adjustment will change. But in our study mat, they clearly given whatever the case it is, stock reserve will be there, no? Unrealized profit, that should be reduced from the closing stock and taken it to consolidation, and that will be reduced from the holding company's profit and taken it to consolidation. So you are also going to do in that way itself. I don't want to tell you the adjustment, other adjustment now for the time being. So whatever it is, how much ever unrealized is there, just transfer it to, just reduce it from the closing stock value and remaining value take as a closing stock, and that unrealized whatever amount is there, that reduce it from the holding company's profit and take it to the consolidation. Sir, what are the steps involved, sir? Calculate the stock reserve in the closing stock of the company, that is subsidiary company or a holding company, whatever it is. Eliminate such a stock reserve from the closing stock, and reduce such a profit from the sending company. Now we'll see few questions. Now we'll see one question. Later we'll go to the last adjustment, revaluation, and also the same adjustment should be given in the consolidated P&L if they ask. If they ask also in consolidated P&L, how much you should take, sir? Closing stock. Closing stock you should take at cost. Closing stock you should take at cost. See here. From the following, prepare a consolidated balance sheet of holding limited, that is H limited, and its subsidiary S limited. Okay. There are shares of around 5 lakh rupees. Share capital is how much? 5 lakh rupees, 3 lakh rupees. This is H limited. This is S limited. One is H limited, one is S limited. How many shares are there, sir? 50,000 and 30,000. 50,000 and 30,000. Other liabilities 140 and 20. Other liabilities 140 and 20. Total comes to 640, 320. Total comes to 640, 320. Done, sir. Now try to understand this point very carefully. Sundri assets are there. Great. Investment in shares of S limited is 24,000, which is around 2,40,000. Now my question is, how much was the outstanding shares of subsidiary limited? 30,000, sir. So we are holding 24,000 shares out of 30,000 shares, which means we are holding around 80% of the shares. So minority interest is 20%. Minority interest is 20%. Done. What are the steps involved in this, sir? Pretty simple. First we'll calculate the date of acquisition. They haven't given date of acquisition, so we are going to treat whatever the balance sheet is there. Balance sheet is there as per date of acquisition only. Percentage of our holding is how much, sir? 80%. Minority interest is 20%. Computation of cost of control, sir. Computation of cost of control. They have only share capital. They have given only share capital. So share in the share, how much we invested? 240,000 we invested, sir. Okay. Share in the share capital of subsidiary is how much, sir? 3 lakh into 80%. 3 lakh into 80%, which will come to again 240,000. So share in the net asset is how much, sir? 240 only, because there is no reserves and surplus as such. So cost of control, nothing. Going to minority interest. Share in the share capital is how much, sir? 60,000. Share in the reserves and surplus how much, sir? Nothing. So how much is the minority interest value, sir? 60,000. Now this will be taken to the current liability. Non-current liability, sorry. This will be taken to the non-current liability. Done, sir. Now in consolidated, are we going to consider subsidiary share capital? The answer is no. Only holding companies will consider 5 lakh. Before other liability, we have one more non-current liability. What is that, sir? That is nothing but minority interest around 60,000. Minority interest was around 60,000. And there is other liability. We have 140 of ours and 20 of subsidiaries, or 20 We have only 80% share, no sir. So 16,000 we should take. The answer is wrong. We should take 100%. That's why minority interest will come. If we take only 80%, there is no point that minority interest comes here. So you should take completely. So other liability around 160,000. Your total is around 560, 620, 720,000. Going to the asset side, Sundri asset 720,000. Investment nil, because investment in the shares of subsidiary won't form part of consolidated balance sheet because it got adjusted against net asset acquired. So asset liability matching. See here. Done. Now we are going to one more important concept, that is revaluation of assets. Revaluation of assets. Okay. This is also one more important concept. So what and all we have learned? Important concept: dividend, reserves and surplus, share capital, intercompany things, bonus, correct, and stock reserve. Now we are going to revaluation of asset, and this will be the last adjustments so far given in your material. If at all you know all these adjustments, easily you can score 10 to 15 marks in this particular consolidation. Yes sir, what do you mean by revaluation, sir? We are revaluing whether our asset value is really the same how much is reflected in the books. Whether our asset value is really the same amount how much is reflected in the book or no. We are going to revalue that. One thing you have to keep in mind, whenever the holding company buys a subsidiary company, are they going to value their asset and liability whatever is in the same manner whatever is there in the balance sheet? Of course no. They will get those things valued. Based on that only they will tell how much we should pay to your company. So always remember, at the time of revaluation, at the time of acquisition, usually revaluation will happen. Okay. Sir, when the revaluation is done, result could be two things. One, increase in the value of asset, that is more than book value. For example, your asset value is 10 lakh in the books, but when you revalued, you got to know market value of that, or the realization value of that is 12 lakh rupees. Fair value is 12 lakh rupees. Now this 2 lakh rupees is a extra. Asset value is increasing, means gain or loss? Of course gain, sir. Of course gain. So how you are going to treat it, sir? You are going to treat it as a revaluation reserve. How the accounting is done, that I will show later. Now, if at all, in book value, the asset value is 10 lakh, but actually fair market value is just 8 lakh. Now, or let's say 8 lakh 50,000 to avoid a confusion. Now 1 lakh 50,000 is there, no? 1 lakh 50,000. This is your revaluation loss. This will form part of your P&L. Always remember, when it is a gain, we are going to transfer it to reserves. When it's a loss, we are going to transfer it to P&L. Now, book value of asset right now is 10 lakh. Book value of asset is 10 lakh. Let's say it is revalued at 7 lakh rupees. It is revalued at 12 lakh rupees. Book value of asset is revalued at 7 lakh rupees, revalued at 12 lakh rupees. First we'll go for 7 lakh rupees. It was 10 lakh rupees, boss. You revalued it to 7 lakh. Moral of the story, you undervalued it by 3 lakh. Correct? Yes, sir. Now, you are going to write it off from the value of the asset. That is, asset will decrease in the asset, you have to credit. So that particular asset account you have to credit. Debit what, sir? You should write it off to P&L. Unless and until you have some revaluation reserve pending in your books, then first you write off to that revaluation reserve, and later extra is there, then you take it to P&L. Otherwise, you take it to P&L directly. Done, boss. What if it is increased, sir? That is, asset is valued at 12 lakh, where in book it was mentioned as 10 lakh, which means 2 lakh rupees is revaluation gain. Then asset value will increase, so asset account debit. Revaluation reserve, not P&L, you are going to transfer to revaluation. That will also increase, is a reserve, nature of capital, increase in capital credit. So entry we are going to pass is asset account debit to revaluation reserve account. Done, sir. Done, sir. Now, how we were going to treat that revaluation reserve, sir? How we are going to treat that revaluation gain? Try to understand. You should check as per the question, whether changes are recorded in the financial statement or no. Whether changes are recorded in financial statement of subsidiary company or no. Also, you should check whether changes are recorded in financial statement of subsidiary company or no. Usually in question they will tell revaluation changes already made in the books of subsidiary company. Revaluation changes is not made in the books of subsidiary company. They will tell like this. Based on that, you should think. Now, changes are already recorded. Then no need to record anything now. Same value is taken in the CBS. Same value is taken into consolidated balance sheet because changes is already implemented. Sir, revaluation reserve will be there, no? Then in the reserves and surplus, yes, it will be there. That how you are going to treat, sir. Try to understand. When you are revaluing it, when you are acquiring it, let's say there is one building. In book it is around 1 crore. Actual market value is 3 crore. Now you revalued it to 3 crore. When, sir? On the date of acquisition. Now from 1 crore to 3 crore the value went. Why did it go? Because they held it since last 10 years. That's the reason. Or because you acquired it. Of course, they held it till last 10 years. That's the reason. Do you have any efforts? In making it 3 crore? Of course, no. Which means this 2 crore rupees, whatever you are getting extra, that is effort of previous shareholders. So treat it as a pre-acquired reserves and surplus and consider it for the calculation of cost of control and MI. That is the treatment when the changes are recorded in the financial statement of subsidiary. Now, when the changes are not recorded in the financial statement of the subsidiary, then in consolidation what you should do? What you should do is you should check whether depreciation rate can be ascertained or cannot be ascertained. Whether depreciation rate can be ascertained or it cannot be ascertained. Let's say depreciation rate cannot be ascertained. Using the data given in the question, you cannot ascertain the depreciation rate. Then add the revaluation gain to asset and show it asset at a revalued amount. What you should do, sir? You should add the asset into revaluation, asset gain into value of asset and show it at a revalued amount because it is not yet added. Okay, sir, when you revalue your asset, automatically one more item came, that is revaluation reserve. How to treat with this, sir? Treat revaluation reserve as pre-acquired reserve and consider it for COC and MI ditto. Same adjustment. Only adjustment here is asset value will increase directly. How much ever the revaluation gain, so much. Sir, depreciation rate can be ascertained, sir. That time what you should do, sir? Book value of the asset plus revaluation gain, just like last one, minus additional depreciation to be provided. Sir, what do you mean by this, sir? Try to understand, people. Our depreciation rate is 10%. Opening value of the asset was 10 lakh. Now Now it is revalued to 12 lakh. It is revalued to 12 lakh. Now for the sake of consolidation, should I take the asset at 10 lakh or 12 lakh, sir? Should I take the asset as 10 lakh or 12 lakh? Try to understand. This asset is revalued at 110. Revalued at 110. But it is shown on 31st March. That is end of the financial year also 10 lakh only. Now, can I tell I depreciated to the extent of only around 1 lakh rupees earlier? Book value means basically 11 lakh was the around 10 lakh should come as answer. Some amount it is. But don't you think if you revalue, your value of asset will increase? In between the year, value of asset got increased. Yes, sir. But you showed a depreciation less only. Yes, sir. Now what you should do, sir? Add back. I mean, treat it as a additional expense. That is book value of asset plus revaluation gain minus additional depreciation to be provided due to revaluation. Sir, depreciation should be calculated from which date, sir? From the revaluation date. From the revaluation date till the closing date. Because till the revaluation date, it is at a book value only, no doubt. But from this date, it got changed, no? From here to here, if the depreciation is not covered, then cover it. Give the additional depreciation. Done, sir. If you are not understanding this revaluation, don't worry. When we see the question, you will understand clearly. Now, revaluation reserve, treat it as a pre-acquired and consider it for the calculation of COC and MI and reduce the additional depreciation from the P&L of the subsidiary because that is not yet reduced. Additional depreciation, reduce it. Done, sir. Sir, cumulative preference dividend will be there. No, sir. Cumulative preference dividend. What do you mean by this, sir? If you don't have the profit this year, you can pay the dividend to the preference shareholders next year. If you don't have the profit this year, you can pay it to them next year. Now, how to treat that kind of dividend, sir? Now, share of the holding company. In that dividend, in that cumulative preference dividend, share of the holding company, you are going to check how much is till the date of acquisition, how much is after the date of acquisition. Treat it like a normal dividend only. How much is out of pre-acquired, how much is out of post. How much is till the date of acquisition, how much is till the after the date of acquisition. Reduce it from the cost of investment. So pre-acquired reserves and surplus should be reduced with such cumulative portion of COC. Correct? Now, after the date of acquisition, treat it like a post-acquired dividend. When it comes to till the date of acquisition, add it to the minority interest. After date of acquisition, no requirement because you already paid to minority interest. So no more liability is there. You already paid that, no? You already paid, no more liability is there. So while calculating minority interest, accumulating dividend portion should be reduced from the pre-acquired reserves and surplus. Same. All these things you will understand now while solving question one by one. Okay? One by one question. Slowly we are going to fully fledged question. That is the beauty of ICSI questions here. Try to understand. Usually ICSI, what they do is they don't give you like straight away one question of 14 marks, 20 marks. One question they give, big question for 10 marks and all. That is coming from the issue of shares only directly. Reissue, forfeiture, everything will be there. But when it comes to consolidation, they are asking part by part questions so far. Like how much is minority interest, how much is cost of control, like that they are asking. So here the prime importance is given to that split calculation rather than consolidated balance sheet. Anyhow, we are going to do it. Don't worry. Now we'll see all the question, whatever is remaining. Every question of your ICSI material slowly, easily. No worries. Look at this question now. From the following information, prepare a consolidated balance sheet. So they have given few things here, like share capital is there, reserves is there, 50,000, P&L 20, creditors 30. So shares of rupees 10 each, sir. How many shares are there? H Limited 20,000 shares and S Limited 10,000 shares. Asset, sundry assets, investments, 6,000 shares of S Limited. So how much is our percentage of holding, sir? 6,000 shares divided by 10,000 shares into 100. 60%. So minority interest 40%. H Limited acquired its shares in S Limited on January 1st, 2022 when the reserves of S Limited stood at rupees 4,000 and its P&L account is 5,000. So it acquired the shares in S Limited on January 2022 when the reserves of S Limited stood at 4,000. So reserves. Now how much it is? 20,000. But on January 1st January 22 when we acquired, opening balance, we acquired on that day only, no? How much was the opening balance, sir? 4,000, which means 16,000 is post-acquired in it. 4,000 is pre-acquired, 16,000 is post-acquired. Done. Next, sir. Profit and loss, it was 5,000 balance. Now it is 10,000. So pre was 5,000, post is 5,000. Simple. So let's do it. First let's calculate the cost of control. How to calculate the cost of control, sir? Net investment, we have invested 80,000. This is net investment. Share of net asset, share in the share capital, 1 lakh into 60%. 1 lakh into 60%, which will come to 60,000. Share capital 60,000. Reserves, pre-acquired reserves, right? Share of pre-acquired reserves, how much it was? 4,000. So 4,000 into 60%, 2,400. Share in the pre-acquired P&L, how much it is? Opening was 5,000. So it is around 3,000 rupees. So your net asset is around 65,400. Goodwill is 14,600. Goodwill is 14,600. Done, sir. What else? Your minority interest. Minority interest is how much, sir? Share in the share capital, that is around 40,000. Share in the pre-acquired reserves and surplus. So that is 4,000 into 40%, which will come to 1,600. 5,000 into 40%, which will come to 2,000. Share in the post-acquired reserves, which is basically around 4,000 is opening, means 16,000 is post-acquired. So 16,000 into 40%, which will come to around 6,400. And 10,000 is the closing, which means around 5,000 was opening. So 5,000 is earned during the year, post-acquired. So 5,000 into, see, everything whatever earned during the year is not post-acquired. For that you should check the date. Here opening balance sheet date only we purchased. So whatever is earned is post-acquisition. So that is 5,000 into 40%, around 2,000. So 40, 41,600, 43,600, 44, 50, 52. 52,000 is this thing. Now, while merging, sir, share capital, sir, only 2 lakh shall be taken. Reserves, only holding companies 50 will be taken, no doubt in that. Plus minority interest, only post-acquired reserve will be taken. See here, I will show it. Date of acquisition 1/1/22. So pre-acquired during the period is 0. Balance sheet date is 31st 12/22. Post duration is 12 months. Because from the date of acquisition till the balance sheet date, we held it for 12 months. Percentage of holding 60, minority is 40. So general reserve 20,000, in that opening is 14, during the year is 16,000. Now in that 4,000, holding company related 2,400, minority 1,600, holding companies will be adjusted to COC, minorities will be added to minority. During the period 16,000, in that holding company is 9,600, that will be coming in the consolidated balance sheet. Around 6,400 is minority interest, that will come in the minority interest. P&L 10,000. In that opening is 5,000. Holding company 3,000, minority 2,000. Holding company pre-acquired will be adjusted to COC. Minority will be added to minority interest. During the year 5,000. So that is post-acquired completely. So in that 3,000 is relating to holding company, that will form part of the reserves in the consolidated balance sheet. 2,000 is relating to minority interest, that will form part of your minority interest. Balance sheet. Balance sheet, always remember people, share capital, see there, only holding companies will come. General reserve, holding companies will come, plus holding company share in the post acquisition will come, that is 9,600. P&L 20,000 is of holding, plus holding company share in the subsidiaries P&L post acquisition 3,000. Non-current liability, minority interest will come, and all other item, listen here very carefully, creditors will be taken 30,000 plus, not our share of creditor in subsidiary, full 50,000, asset full 370,000, investment nothing. Goodwill will come to the extent of 14,600 or what, so whatever we calculated. This is the balance sheet. Assuming it is clear. Assuming it is clear, we are going to the next one, which has the adjustment of revaluation. See, all the illustrations got covered. After all the illustrations got covered, we have covered our case studies there, no? Case studies in your study mat. That also we have covered. See, all the case studies are also covered. All the case studies are also covered, and practice question I expect you guys to do it on your own, because nothing extra is there, everything is ditto. We'll see now. So slowly we started seeing the few adjustments now. So we'll proceed that way only, no worries. You will understand everything. No urgency. Slowly we'll take it down. Okay. Now, this is relating to revaluation of asset and all. Revaluation of asset. The following are the balance sheet of P Limited and its subsidiary Q Limited as at 31st March 2023. Done. Equity they have given 16 lakh, 4 lakh, and equity of rupees 100 each. So P Limited has around 16,000 shares outstanding. Q Limited has around 4,000 shares outstanding. Yes, sir. Then P&L around 2 lakh and 80,000. External liability is around so much. When it comes to equipment, 10 lakh 380,000. Investment 3,600 equity shares in Q Limited on 1st April 2022 we have invested. Make it as 2022 in your study material, not 2010. Other assets they have given. On 1st April 2022, P&L account of Q Limited showed a credit balance of 32,000, and the equipment of Q Limited was revalued by P Limited 20% above its book value of rupees 4 lakh. Actually, there was a book value of 4 lakh, but no such adjustment is affected in the Q Limited. So you should make that effect happen, then you should think of consolidation. Prepare a consolidation as on 31st March 2021. Okay. So what is happening, sir? The share acquisition is happening on the opening date itself. So during the year, there is no pre-post. Whatever was there previous year is a pre. Whatever happened during the year is a post. Correct? Yes, sir. Few simple steps we have to follow. Before that, let's go and adjust certain things. See here. What is the date of acquisition, sir? 1/4/2022. Balance sheet date is 31st March 2023. 12 months period. In the 12 months period, pre-acquired is 0. post acquired is 12 months. How much we are holding, sir? We are holding 3,600 shares at the by giving 5,60,000 rupees. So 3,600 divided by 4,000, which will come to 90% of the subsidiary share is held by us. So 10% is held by minority interest. Now try to understand. Try to understand what they have told. Here they are telling value of the asset as 380,000. Value of the asset as 380,000. Here they are telling book value was 4 lakh. Book value was 4 lakh. It is valued 20% above the book value, but the such adjustment is not yet made. So try to understand. On opening, our asset value was 4 lakh. On opening, our asset value was 4 lakh. On closing, all of the sudden it became 380,000. Sir, what magic, sir, it is? How is that even possible, sir? Revaluation adjustment is also not made. How is that possible? People, this 20,000 is nothing but how much depreciation we charge during the period. How much depreciation we charge during the period. So using the information, don't you think we can ascertain the depreciation percentage? Of course we can ascertain, sir. How much it is, sir? Rupees 20,000 divided by 4 lakh, which will come to 5%. Rate of depreciation is 5%. Wow, that's it, sir. That's it. Okay, now how to adjust it, sir? Now how to adjust it? Try to understand what is happening. Sir, they told that 20% is the revalue on the book value. So revaluation is how much, sir? Revaluation gain is 80,000. Revaluation gain is 80,000. At the same time, remember one thing, guys. Remember one thing. If at all we have taken the revaluation amount already, then the depreciation would be calculated on 4,80,000 into 5% into 12 by 12. Because on the opening date only all these things are happening. So our depreciation would have been 24,000. Our depreciation would have been 24,000. But as we took it as only 4 lakh, our depreciation is 20,000. Which means depreciation of 4,000 rupees is not adjusted. Depreciation of 4,000 is not adjusted. Now you are going to treat it as additional depreciation. How we were going to adjust this, sir? You are going to adjust this in your P&L. See here. Revalued amount is 480. Revaluation gain is 80,000. Now, in the revaluation gain, how much is holding company's gain, sir? 90% of it. How much is minority interest? 8,000. Revaluation gain is pre-A, correct? So pre-reserves, what you should do, sir? Holding company related, take it to the calculation of COC. Minority interest, take it to the MI. Remember one thing, this you won't find while finding out the COC and MI, you won't find it here. But don't forget, you should consider that. Don't forget. Done. Now, depreciation amount is how much, sir? 20,000. Depreciation rate is 5%. Additional depreciation to be charged to the post-acquired P&L, because revaluation happened on the date of acquisition. After that only the depreciation starts, no? Which is post-acquired period. So that should be charged to post-acquired. How much is the additional depreciation, sir? 4,000. That should be charged to post-acquired profit. So, sir, now how much is the amount to be taken to the CBS, sir? Book value, it is shown as 380. Correct? Book value, it is shown as 380. No doubt. Additional depreciation, we have revalued it, because of which 80,000 got increased. 80,000 got increased. Correct? However, 4,000 we showed a lesser depreciation. That if we reduce now, net our asset value is rupees 4,56,000. This shall be taken for the sake of consolidation. This shall be taken for the sake of consolidation. So for the sake of consolidation, it is 456,000. Done. Revaluation is so much. Now we'll see one by one. P&L, they are telling 80,000, and also they are telling on 1st April it showed a credit balance of 32,000. So listen here, P&L 80,000, opening was 32, completely pre. During the year 48,000 is earned. It should be completely post now, because there is no pre-period in it. 48,000 was there. Whether we have adjusted depreciation to this, of course we have adjusted already, but we have adjusted additional depreciation, no. Now reduce that additional depreciation. Net your profit is 44,000. Now pre-acquired profit we are going to divide between holding company and minority interest. Holding company, parent company, will be holding 90% of that, so that will form part of your cost of control calculation. 28,800 will be considered for your cost of control calculation, whereas 3,200 will be treated as minority interest. When it comes to this 44,000, holding companies related will form part of the consolidated balance sheet, and minority interest will be treated as in the minority interest, post acquired profit. Okay. Now, sir, computation of cost of control. How much we have invested, sir? Net investment. We have invested 5,60,000. Is there any dividend from the pre-acquired reserves? Nothing. Correct. So straight away 5,60,000 minus share in the net asset of the subsidiary. That is in the net asset we have share capital, we have reserves and surplus. Which reserves and surplus, sir? Pre-acquired reserves and surplus. First, share in the share capital, sir, 4 lakh into 90%, which will come to 360,000. Share in the pre-acquired reserves and surplus. Try to understand how much is our pre-acquired reserves and surplus. 32. In that our share is 28,800. I am going to take the 28,800. And any other pre-acquired reserves and surplus is there, sir? No, sir, only P&L is there, so that should be there. The answer is wrong, because there is a revaluation reserve. I told you, as it won't be there in the question, you might forget it, but remember, revaluation reserve is there. 72,000 should be adjusted to COC. So we are going to adjust this 72,000 also. So the share in the net asset is 4,68,000. So you have acquired asset of 4,68,000 by paying 5,60,000. You paid extra. Why do you pay extra, sir? Of course you pay extra towards a goodwill. Done. Minority interest, sir, share in the share capital, 4 lakh into 10%, 40,000. Share in the pre-acquired reserves and surplus, that is share in revaluation reserve as well as P&L. Share in post-acquired P&L, 4,400. You will get minority interest. If you see the balance sheet, share capital, only holding companies will come. P&L, share of holding company in the holding company will come, of course, full, plus share of holding company in the post-acquired P&L. Non-current liability, minority interest is there, and external liabilities full will come, no adjustments as there. Goodwill of 99,200 and equipment will come as 10 lakh holding company, and 456 is subsidiary. Why 456? I explained that time only. Other asset. That's it. See this one. The summarized balance sheet of H&S Limited as on 31st December 2022. Balance sheet date is 31st December 2022. They have given a share capital, shares of rupees 10 each. We have 15 lakh and around 3 lakh, which is 30,000 and 1,50,000 shares respectively. Subsidiary and holding. Reserves 240 and 90 thousands. P&L is there 180 and 120. Asset they have given so and so and so. We have a investment of around 24,000 shares in S Limited. We hold how many percentage, sir? Now 24,000 shares we hold out of 30,000 available. So we hold around 80% of the shares. Hold around 80% of the shares. So minority interest is 20%. Now we'll see the adjustment. S Limited has had reserves of around 90,000 when H Limited acquired the shares in S Limited, but the P&L balance was fully earned after the purchase of shares. What they are trying to tell, sir? They are trying to tell the reserve is there. No, reserve 90,000. 90,000 was there pre-acquired, it seems. So 90,000 is what, sir? Pre-acquired. Whereas P&L 1,20,000 completely earned after acquisition, post-acquired. Post-acquired. Yes Limited decided to issue the bonus out of the post-acquisition profit. They have given from where? Post-acquisition profit in the ratio of 2 shares for every 5 shares held. So now how many shares are there outstanding? 30,000 into 2 by 5. 12,000 shares. So 12,000 into 10, which will come to rupees 120,000. Rupees 120,000 is what we need. Do we have so much, sir, in the post acquired? Of course, we have exactly 120,000. So nothing will be left in the post acquired P&L after issue of bonus. Calculate the cost of control before the issue of bonus and after the issue of bonus. Sir, will that change, sir? Yes. I told you, if the bonus is issued out of pre-acquired, then from reserves it will go to share capital. Both were considered for the calculation of COC, so it won't change. However, if it is post-acquired P&L, of course it will change. See here. Percentage of holding 24, 30, 80%. Computation of cost of control before and after bonus. Before bonus and after bonus. First, let's calculate before bonus. How much is our net investment, sir? We have invested 420,000. There is no recovery of the dividend as such. Share in the net asset. Share capital is 3 lakh. Before bonus, 3 lakh. So 3 lakh into 80%, 240. Share in the pre-acquired reserves and surplus. They are telling reserves and surplus, 90,000 balance is there in the reserves. Everything is pre-acquired. So 90,000 into 80%, which will come to 72,000. Net goodwill is 1,08,000. Goodwill is 1,08,000. Computation of cost of control after bonus. After bonus, still our investment didn't change, 4,20,000 only. Share in the net asset, share in the share capital. Try to understand, people. Earlier it was 3 lakh. Earlier it was 3 lakh. Then what we did, sir? For 30,000 shares, we issued bonus. That is around 12,000. So our outstanding became 42,000, which means our share capital became 4,20,000. Now our share of 80% is 80% of 420,000, which will come to 3,36,000. Pre-acquired reserves and surplus, again that 90,000 is there, that will come. Done. That's it. Sir, minority interest, sir, minority interest, sir, minority interest. Let's calculate and show you guys. Before issue of bonus, share capital was 3 lakh. In that 20% was theirs. So that would be 60,000. Pre-acquired reserves and surplus was around 90,000. Pre-acquired reserves and surplus was around 90,000. So share of 20% on that will come to 18,000. And post-acquired reserves and surplus before bonus was 120,000. So whole 20% share in that 120,000 also considered for minority interest. Minority interest calculation, pre-acquired reserves and surplus plus post-acquired reserves and surplus. So 120,000 into 20%, which will come to 24,000. How much is minority interest, sir? 78, 82, 102,000. Sir, after bonus, share in the share capital, we got to know share capital will become 420,000. So 420,000 into 20% will come to around 84,000. Share in the pre-acquired reserves and surplus, it's not changing, so it is 18,000. Share in the post-acquired profit, out of 120,000, nothing will be left over, so it will be 0. So it will be 102,000 only. 102,000 only. Sir, if the question they don't tell, sir, bonus is issued out of pre-acquired profit or post-acquired profit, what you should assume, sir? I told you yesterday a few assumptions. In that one assumption is, if they don't tell in question, bonus is issued out of which profit, we should treat it as it is issued out of pre-acquired profit first. If at all dividend they give and they don't tell post-acquired or pre-acquired, first you should treat it as issued out of post-acquired, or current year P&L, not even post-acquired. Current year profit, if any excess money is required, past year profit. We'll see one more question. from the following balance sheet of holding company and its subsidiary as on 31st March 2022. Balance sheet date is 31st March 2022. Prepare consolidated balance sheet. Share capital is there, sir, of the rupees 10 rupees each. So it is around 1,50,000 shares in the holding company, 60,000 shares in the subsidiary company. General reserve is there. Both general reserve is there. P&L is also there. Sundry creditors 150 and 120. No, it is sundry creditors, sir. Why, sir? Creditors cannot be sundry, so correct. Outstanding expenses 60,000, 30,000. Great. Going to the asset. Goodwill is already there. Goodwill is already there. In that scenario, what to do, sir? I will tell. This is not this goodwill, some other goodwill. Done. Machinery is there. Stock is there, debtor is there, cash at bank is there, investment 48,000 shares in Nest Limited. So how much we are holding, sir? 48,000 divided by 60,000 into 100, which will come to 80%. When the control was acquired, Nest Limited has 120,000 in the general reserve. In general reserve, how much they had, sir? Out of 180,000. Balance is there now 180,000. In that 180,000, 120,000 they had when they acquired shares. Opening is 120. 90 is 19 profit and loss. Now how much it is, sir? Now how much it is? 210,000. No, 210,000. In that 90 they had it in a opening balance only. Opening balance, or you can tell it as pre. Immediately on purchase of shares of H Limited, H Limited received 48,000 as a dividend from H Limited. Immediately means you are getting it on the date of acquisition. Date of acquisition, that question itself won't arise. Whether dividend is out of post-acquired or pre-acquired. Because as on the date of acquisition, whatever is there, everything is pre-acquired. No. Whatever is there, everything is pre-acquired. So of course, this 48,000 is issued out of pre-acquired. So make sure you are going to reduce it from the net investment, which was credited to the P&L account. We credited it to the P&L account, which is wrong. We should be reduced from the net investment, and we credited it to P&L. No, in holding company, we should reduce the profit. We treated it as profit. We reduce the profit. Done. Debtors of H Limited include 60,000 due from H Limited. So H Limited debtors are there now. Sorry, H Limited debtors 360,000. In that 60,000 is the amount to be received from the H Limited, whereas H Limited shows 45,000. So H Limited's Sundry creditors 120,000. In that 45,000 is holding company. Arey, how is that possible, sir? Cash in transit. I told you yesterday. What you should do, sir? From the debtor creditors, take out 45. In the cash and cash equivalent, add 15,000. The difference is being accounted as check in transit. Okay. Percentage of holding 80%, minority 20%. Dividend of H Limited is how much, sir? Try to understand what is happening. H Limited received 48,000. So that doesn't mean that dividend distributed is 48,000 from the subsidiary. H Limited, as a 80% shareholder, they are getting 48,000. 100% means together how much they would have paid? They would have paid total 60,000. From reserves, it would have gone 60,000. This is one of the important adjustment. Now, P&L 210 was there. P&L 210 was there. In that they are telling 90,000 is pre-acquired. Correct? And post-acquired is 180,000. But they also told that on the date of acquisition itself, immediately you are getting a dividend. Can I tell this 90,000 is paid off pre-acquired? So pre-acquired profit remaining is 30,000. Pre-acquired profit remaining is 30,000. In that holding company 24,000. Minority interest 6,000. Holding companies adjust to COC. Minority interest. Post-acquired 180 is there. In that holding company 144. Minority 36. 144 you are going to take it to the consolidated balance sheet, whereas your 36,000 also treated as a minority interest. General reserve 180 is there. They are only telling pre is 120, post is remaining balance 60. In that holding share is 96, minority is 24. Holding share, what you are going to do, sir? Holding share, you are going to adjust it to cost of control. Minority interest will form part of your minority interest. Holding company 48,000 in the post acquired. This thing is basically forming part of reserves and surplus in the consolidated balance sheet, whereas this 12,000 rupees minority interest again will form part of minority interest. So try to understand cost of investment 570,000 minus pre-acquired dividend of 48,000, 522,000. Share in the net asset, share in the share capital is 480,000. Share in the pre-acquired general reserve around 96,000. Share in the pre-acquired P&L 24,000. Net around 6 lakh rupees is the net asset acquired. You are paying 5 lakh 22, which means you are getting at a benefit of 78,000 profit. Which profit? Capital profit. So we are going to treat it as capital reserve. Computation of minority interest, people. Share in the share capital they have taken, share in the pre-acquired reserves, share in the post-acquired reserves, both will come. We'll get minority interest. Sir. But in consolidation, goodwill is there, no sir? Yes, goodwill is there. So now this capital reserve, what to do, sir? You have two options. Left to you guys. You have two options. What to choose? It left to you guys. There is no compulsion as such. Option number 1. Okay, you have capital reserve. Show it in your reserves and surplus in the consolidation, so and so. Goodwill will automatically form part of your books as it is earlier, 120,000. Or you do one thing. To the existing goodwill or capital reserve, adjust the new goodwill or capital reserve. For example, 120,000 is goodwill. To that, you take out how much ever the capital reserve you are getting. 78,000. So 120,000 is there. From that 78,000 you reduce. So around 42,000 is there. Now show the goodwill at not at 120,000 but at 42,000. You can do this. Or you can show goodwill at 2 lakh only. Sorry, goodwill at 120,000 only. Whereas in the liability side you are going to show non-current liability and minority, in the reserves and surplus, capital reserve, so and so. Also in the non-current you have to show the minority interest that you can't adjust. And also here one more thing. Cash and cash equivalent will become how much, sir? Cash and cash equivalent will become how much, sir? Cash and cash equivalent will become 60,000 of holding plus 30,000 of subsidiary plus cash in transit 15,000. 105,000 consolidated. Done. Going to the debtor, holding company 360 was there. In that 60 was subsidiary. So we are going to consider only 3 lakh because that got adjusted already. Plus 4 lakh 80,000. 7 lakh 80,000. Going to this one, creditors, holding company 150 is there. In that 150, subsidiary company is having 45,000 balance as a holding company. So 105,000 plus 120,000. Sorry, holding is, holding is 150, no? Holding is 150,000 plus subsidiary company out of 120 creditors, 45 is holding on 45 is holding only. So it would be around 75,000. 2,25,000. Hope it is clear. With that, all the illustrations are cleared. Now, considering so many aspects, we are going to see few cases also, few case studies also now. Okay. Look at this question. Share capital they have given. Shares of rupees 10 each. So around 5 lakh and 2 lakh is there, which is basically 50,000 and 20,000. Securities premium is there. General reserve is there. Surplus is there. That is nothing but your P&L basically. Creditors is there. Sundry asset is there. Investment 15,000 shares in S Limited, 295,000. You are required to compute the minority interest and cost of control assuming H Limited acquired shares in S Limited on 31st March 2022. Balance sheet is also of the same date. So moral of the story, we are acquiring also on the same day and balance sheet is also of the same day. Whatever is it is, everything is pre. Everything is pre, nothing is post. Done. No much adjustments are there here. Out of 20,000, we hold 15,000 shares. So we hold around 75% of shares. So minority interest is 25%. Straight away, if you ask me to compute the cost of control, basically 295,000 is our net investment. Correct? There is no dividend as such, received, etc. So share in the net asset of this thing. So 2 lakh is the share capital of the subsidiary. In that we hold 75%, which will come to 150,000. Done. Security premium is also pre only. So 10,000 into 75%, which will come to 7,500. General reserve 50,000 into 75%, which will come to around 37,500. And P&L around 20,000. In that 15% will come to around, 75% will come to around 15,000. So your net asset is basically 7,500, 45,000, 45,000, 60,000, 2 lakh 10,000. Your net asset, share of net asset is 2 lakh 10,000, whereas your net investment is 295,000, which means you paid extra. Why did you pay extra, sir? Because you are getting 85,000 of goodwill. You paid extra to acquire a goodwill at the rate of 85,000. Calculate minority interest, sir. Shares is around 2 lakh, in that 50,000. Securities premium around 2,500. General reserve is around 12,500. And your P&L is around 15,000 is this one, means 5,000 is this one. Correct? So how much it is, sir? 15,000, 20,000, around 70,000. Around 70,000. 85,000 goodwill and minority interest is 70,000. Done. Going to the next one. Bit adjustments are there over here. See here. From the following balance sheet of X Limited and Y Limited, as on 31st March, work out net amount due to minority interest, that is value of minority interest and cost of control. And listen here, balance sheet is of 31st March 2022. Share capital, if you see, 15 lakh and 5 lakh, so 5,000 and 15,000. General reserve is there, P&L is also there, creditors are there, asset is there, investment 4,000 shares in the subsidiary, so around 4,000 divided by 5,000, which will come to around 80%. So minority interest is 20%. The assets of the Y Limited included equipment worth rupees 150,000. So asset of the Y Limited is there, no, 795,000. That includes equipment worth rupees 150,000, which was revalued at 125,000. So this got revalued. Undervaluation, overvaluation, sir. Undervaluation. The investment of X Limited were in the shares of the Y Limited, and the same was acquired in 1st July. So it is acquired on 1st July. So from the 1st April till 31st March, somewhere here you will get 1st July. Correct? Pre-acquired period is how much, sir? July, April, May, June, 3 months. Post-acquired is how much, sir? September, October, November, December, January, February, March. Around 9 months. July, August, September, October, November, December, January, February, March. There is no opening of general reserve and P&L. So basically, moral of the story, there is no opening. So both are post only, no, sir. The answer is wrong. If you think this way and if you consider both as post, the answer is wrong. Because the acquisition date is not the date of balance sheet or the opening date of balance sheet. Acquisition is happening somewhere in between. So this general reserve and P&L should be split between pre-acquisition, post-acquisition. Date of acquisition is 1/7/21. Balance sheet date is 31st/3. Pre-acquisition is 3 months. Post-acquisition is 4 months. Percentage of holding is 80. Minority interest is 20. Now general reserve and P&L, if you see, General reserve and P&L, if you see together it is 175,000 that we can divide into pre and post on the period basis. Pre and post on the period basis. Pre is 175,000 into 3 by 2. Post is 175,000 into 9 by 2. Which will come to 43,750 and 131,250. At the same time, listen here very carefully. There is a loss of 25,000 revaluation loss. Sir, in the given question, can we find out a depreciation? The answer is no. Can we find out a depreciation? The answer is no. Because we don't know the opening, we don't know the closing, we know nothing. Only revaluation gain is known, so only that you adjust. So what will happen, sir? Pre-acquired reserves will reduce it. So around 18,750 is what is remaining in the pre-acquired. And post-acquired is 131,250. From the pre-acquired, we are going to divide it between how much is holding companies, how much is minority interest. Holding companies will be adjusted to COC, minority will be minority interest. Out of 131,250, how much is holding, how much is minority? Holding is 105,000, minority is 26,250. Holding companies will be treated as the reserves in the consolidated balance sheet, whereas minority interest together, everything together, minority interest will be treated as non-current liability. See here, we invested 560, share in the share capital, we got around 4 lakh and minority is 1 lakh. Pre-acquired reserves and surplus 15,000 and 3750. Post-acquired reserves and surplus won't be considered for the calculation of COC, but will be calculated for the considered for the calculation of MI. We'll get how much is a goodwill, how much is a minority interest. Going to case number 3. Going to case number 3 again. Listen here. Following are the balance sheet of H Limited and subsidiary. Around 6 lakh and 2 lakh is there of the shares rupees, 10 rupees each. So around 60,000 shares and 20,000 shares. General reserve is 340 and 80. General reserve is 340 and 80. 80 is there. P&L 60 is there already. TP is there. Asset, if you go, machinery 390 is there, 135 is there. Furniture 80 and 40 is there. Investment 80% shares in the H Limited at cost, which is 340,000. So investment is 340,000. Stock they have given 180 and 120. Trade receivable is 50-30. Cash and bank is 70-50. Please mark this question as LMR. Surplus in the P&L of H Limited stood at 30,000 on 1st April 2021, where general reserve remained unchanged since that date. Try to understand. Out of the P&L 60,000. Out of the P&L 60,000. 30,000 is opening. 30,000 is opening, sir. Pre-acquired, the answer is no. Opening. Because when you are acquiring, 1st October you are acquiring. Opening means 1st April. Remember that. Is it pre-acquired, sir? Of course, pre-acquired only. But opening. In the remaining 30,000 is there now. In the remaining 30,000. In that also, pre and post will get divided. Pre and post will get divided. That I will show. General reserve remain unchanged throughout. So 80,000 is there now. Everything is pre-acquired only because that is opening balance itself. No changes happened after acquisition. H Limited acquired 80% of the shares as on 1st October at the rate of around 340,000 as mentioned above. Okay. H Limited plant and machinery. Listen here. H Limited plant and machinery, which is stood at 150,000 on 1st April 2021, was considered as 180,000 on 1st April 2021, which means you are revaluing. Revaluing how much, sir? 30,000 if you think as a revaluation gain. The answer is no. The answer is no. Then, sir, try to understand now on 1st October what is the value of the book value of the asset. How much was that, sir? That's what, no? They only given no 180. 180 on 1st April. 180 on 1st April. April, May, June, July, August, September. 6 months is over from that date. So what was the book value as on 1st October? Try to understand. 135,000 was opening. 135,000 was opening. I mean remaining, whatever they have given. They are telling it is revalued at 180. Now 150 was opening. For 6 month depreciation would have done, no? How much is the rate of depreciation, sir? How much is the rate of depreciation? How to compute that? Pretty simple. Without considering the changes in the revaluation, our opening was 150,000. Yes, sir. Closing is 135,000. Yes, sir. Depreciation, how much is charged, sir? Depreciation charge is 15,000, which means can I tell depreciation rate is 10%? Can I tell depreciation rate is 10%? Yes, sir. Depreciation rate is 10%. On the date of revaluation, what was the book value of the asset? Please don't consider it as 150,000. Sir, in the previous question, we considered opening date itself was the acquisition date. Opening date itself was the revaluation date. Here, revaluation is happening after 6 months. So, what is the book value of the asset after 6 months? Pretty simple, people. 1,50,000 minus depreciation for first 6 months. 1,50,000 into 10% into 6 by 12. So it will come to rupees 142,500. It will come to rupees 142,500. Done, sir. Now it is revalued to what, sir? It is revalued to 180,000. Please mark this adjustment as last minute revision. It is revalued to 180,000. Revaluation gain is not 30,000, it is 37,500. Revaluation gain is 37,500. Done. Now, sir, how much is the additional depreciation? Compute. How to compute, sir? Pretty simple. For the first 6 months, we had a asset worth rupees 1,50,000, correct? For that, how much is the depreciation? Into 10% into 6 by 12. Depreciation is 7,500. Depreciation is 7,500. For the remaining 6 months, we have the asset of 180,000. So on that, how much, sir? Into 10% into 6 by 12, which will come to 9,000. Total depreciation was supposed to be 16,500. But how much depreciation provided, sir? 15,000. So additional depreciation to be provided 1,500. Additional depreciation to be provided is 1,500. So we are going to show all these things here. Percentage of depreciation we computed. Book value of the plant and machinery as on 1/4/2022 is how much, sir? 150,000. Book value on the date of revaluation is after deducting the depreciation, which is 7,500. So book value is 142,500. Book value is 142,500. Revaluation gain is 37,500. Everything is pre only. In that, holding company how much, sir? Share 30,000. Subsidiary minority interest 7,500. This will go where, sir? Computation of COC. This will go where, sir? It will go to minority interest directly. Depreciation to be charged. First 6 month value of the asset was 150. On the 10%, 6 by 12, 7,500. For the next 6 month value of the asset was not 150, it is 180. So accordingly, additional depreciation to be provided is 1,500. Amount of plant and machinery to be considered, sir. Amount of plant and machinery to be considered. We had 150,000. For that, revaluation happened. How much, sir? 37,500. So rupees 187,500. Depreciation for the period. Which depreciation, sir? Old depreciation, new depreciation? Of course, new depreciation. How much it is? 16,500. No, we computed somewhere 16,500. So we should consider it as 171,000. We should consider it as 171,000. General reserve, they are telling everything is pre only because that didn't change. So 80,000, holding company is 64, minority it's 16. P&L if you go, opening was how much, sir? Opening was 30. So everything is pre only in opening. So holding company 24, minority interest 6,000. During the year it is 30,000, sir. In that pre is how much, sir? Pre is half of that because 6 months. 15,000. Post is 15,000. In that pre, holding company 12,000, minority 3,000. How to adjust that? Holdings will be COC, minority will be minority. Other post, if you come 15,000, in that 1,500 is what, sir? Additional depreciation. So remaining is 13,500. That will be divided among holding company and minority interest. 10,800, 2,700 CBS and minority interest. Accordingly, we have computed our cost of control and a minority interest. not going to show it again. Hope it is clear. Going to the next one. Balance sheet of H Limited and S Limited. They have given share capital, general reserve, P&L. Asset side, if you see, they have a investment of 162,400 with the share capital of 60%. We acquired shares of 60%, which means minority interest is 40%. Preliminary expense is there in the asset. Actually, it is not asset, fictitious asset. Preliminary expense is what, sir? Preliminary expense is expense incurred at the time of incorporation of the company. When the subsidiary company got incorporated, are we a shareholders? The answer is big no. Then if we aren't a shareholder, do you think it is pre? No, sir. It is. Sorry, do you think it's post? No, sir. It's pre. If it's a pre, what we should do, sir? From the pre-reserves, you reduce this. From the pre-reserves, you write it off and take it as a remaining pre-reserves. You take it for the calculation of COC and MI. Okay. H Limited acquired on shares on 1st April 2021. So opening date itself. So whatever is there, everything is pre. Whatever is there, everything is pre. No. Not closing, no. Not closing. So whatever opening was there, everything is pre. Whatever during the year, everything is post. General reserve and P&L showed the balance of 40,000 and 80,000 respectively. So general reserve now how much, sir? 50,000. In that 40,000 is pre, around 10,000 is post. No need to divide 10,000 into again pre and post because the date of acquisition is 1st April. P&L now the balance is around 35,000. In that 8,000 is opening, so around 27,000 is earned during the year. No part of preliminary has been written off during the year. So what you should do, sir? From pre, you have to write it off. Prepare a consolidated CR. General reserve 50, opening is 40, remaining is 10. So whole opening will be treated as pre, whole during the period is treated as post because the date of acquisition is somewhere beginning of the year. So in that holding company, how much, sir? Minority interest. Holding companies will straight away going to the COC, minority will be going to minority. During the year 10,000 is there, sir. Then that holding company 6,000 will go to reserves and surplus, consolidated balance sheet, minority will go to minority. P&L 35,000 was there. In that opening was how much, sir? 8,000. During the year 27. During the year is completely post, opening was pre. And as I already told, preliminary expense you should write off against a pre-profit, that is 8,000. So it will become 6,000. So 2,000 is remaining. That shall be divided among holding company and minority interest in their respective ratio. 27, which is post-acquired profit, that shall be divided among holding company and minority interest in their respective ratio. Accordingly, we are going to compute cost of control and minority interest. Accordingly, we are going to compute cost of control and minority interest. Hope it is clear. Next, we are going to case number 5. How many cases do we have, sir? In total? Done. Last case. Last. With that, whole our CS executive marathon is also done. Okay. Yes. On 31st March 2022, the balance sheet of the major limited and its subsidiary minor limited is as follows. Equity share capital, general reserve, P&L. Sometimes what happens, guys, listen here. They will give somewhere investment here. For example, investment in the shares. We invested 2 lakh. They will give like this. We invested how much? 2 lakh. In the investment, they will give it as, let's say, 2 lakh 80. In the investment, they will give it as 2 lakh 80. Now try to understand, out of 2 lakh 80, only 2 lakh is relating to investment in the shares of subsidiary company. Other 80,000 is normal investment. So for the adjustment of COC, you are going to consider only 2 lakh, not 2 lakh 80, because above they told at what you acquired. So this 80,000 will form part of your consolidated balance sheet. Don't eliminate this also. This is some normal general investment. Remember that if they give like that. Listen here. On 31st March 2022, the balance sheet of major limited and its subsidiary minor limited, they have given equity share capital, they have given it as 8 lakh and 2 lakh. Done. They didn't tell share is of how much value. Let it be. Let's see what they're asking. They only told how much we have acquired, so no need for that. General reserve is there, P&L is there, remember this. Going to asset, and always remember minority interest is there means still asset and liability will be taken at both at 100% value only. Fixed asset there is there, and investment is there, stock is there, and other current is there. Draw the consolidated balance sheet as at 31st March 2022 after taking the following into consideration. Major Limited acquired the shares on 31st July. So balance sheet date is when, sir? 31st March. So if you consider this as a timeline, somewhere in the 1st April, the balance sheet, the financial statements, financial year starts. It goes till year on somewhere on 1st to 31st July. On 31st July, we have acquired the shares. April, May, June, July. 4 months is pre-acquired. Other 8 months is post-acquired. Minor Limited earned a profit of rupees 45,000 for the year. So try to understand. P&L they have given 55,000, no? In that 55,000, 45,000 is off the period, which means opening is 10,000. Okay, sir. So 10,000 is pre, no, sir? Yes, 10,000 is pre. 45,000 is post, no, sir? The answer is no. Why, sir? Because this is during the year, which means from 1st April till 31st March of 12 months. You are going to divide it between 4 month and 8 month. You are going to divide between 4 month and 8 month. 4 month will be pre, 8 month will be post. 4 month will be pre, 8 month will be post. Listen here. Listen here carefully. And also on 31st March, the half of the goods were lying as unsold in the godown of Major Limited. See, in January 2022, Minor Limited sold to Major Limited goods costing 15,000 for rupees 20,000. So Minor Limited it's selling to Major Limited. Still no adjustment changes will come as per your CS executive syllabus. But actually the reverse entry should be, the thing should be ulta, but you can't help. So try to understand what they are telling. It is sold at 15,000 and 20,000 it seems, which means 5,000 is the profit. Now what they are telling, sir, half of the goods were lying in the godown, which means in the 20,000, 10,000 is still there in the closing stock. In the 20,000, 5,000 is the profit element. In the 10,000, how much will be the profit element, sir? 2,500 will be the profit element. 2,500 will be the profit element. So what you should do, sir? Nothing. In the closing stock, you should take it as 7,500. Try to understand. Holding company, how much is the stock? 105,000. In that 105,000, I am going to divide between 2. 95,000 normal stock. 10,000 stock relating to subsidiary, stock from the subsidiary. This 95 will come as it is. This is from someone outside. This 10,000, instead of 10,000, it will be taken as 7,500. It will be taken as 7,500. Done. At the same time. Profit of this profit shall be reduced by 2,500. Profit shall be reduced by 2,500. See here. Date of acquisition, pre-post, percentage of holding, unrealized profit, amount of closing 10,000, cost is so much, stock reserve is so much. Stock reserve of 2,500 should be reduced from the P&L of the holding company as it is unrealized profit, and reduce the same from the value of closing stock. Basically, sir, I know. Now the profit is not there in the holding company's P&L. It is there in the subsidiary company. But still, as per your syllabus, they have clearly given no other adjustment. They have particularly told only like this. So listen here. General reserve, they didn't talk anything about it. So what I told, they didn't tell anything about it. You are going to treat it as opening only, not during the year. So 70,000 I am going to divide between how much is holding, how much is minority interest. P&L 55 is there. In that I am going to divide as how much is during the period, how much is opening. Opening they only told it as 10,000. That is completely pre. In that holding company 7,500, minority interest 2,500. During the year 45, again I am going to divide it between pre and post. 15 and 30. So that 15 and 30 shall be divided like this. Done, sir. Computation is like this. So this is all about it. So in the consolidation, this stock shall be considered as 102,500. 102,500. Hope this marathon is of some help for your last minute revision. Correct? If you like the marathon, please drop us a comment, and if you need any different kind of things, or you guys need like, sir, we want something extra, or we want like some discussion to be done in this way, or anything, any suggestion or any requirement is there, just let us know in the comment box, so we'll be working towards it. Correct? Yes, sir. Hope you guys are already into studies and you are studying very well. Please, people, last few days are remaining, double your effort. Nothing will happen. If you study for 16 hours for 1 or 2 weeks, you won't die. Don't worry. Nothing will happen. Just increase your effort, and hope you guys all will clear with the very good marks. So I wish you guys all the very best, and please let us know how did the marathon go. And yes, we'll meet you guys in the professional level. Yes, bye bye.